All right, we'll get started. Some remarks here, and I know my colleagues do too, but we have Commissioner Johnson who's with us remotely, and then the others obviously here in person. And I'll give my remarks, we'll go down the line, and then we'll kick off with the first panel. And I know we're going to have some people coming in and out throughout the day because we have multiple panels to discuss, and obviously folks joining us virtually. So good morning, and welcome to the Voluntary Carbon Markets Convening. I want to thank my colleagues, Commissioner Johnson, Goldsmith, Romero, Mercier, and Pham for joining us today. I also want to thank and acknowledge the members of the Climate Risk Unit and our distinguished keynote speakers, which I'm very excited about, multiple moderators and panelists. I want to extend a gratitude to David Gillers, the CFTC's Chief of Staff, and the CRU Director, and Abigail Knopf, a special counsel in my office, and the CRU Deputy, and all of the staff of the Climate Risk Unit for their work in initiating and putting this convening together. There's been an outpouring of interest since I announced the convening last month, and I believe this interest is a testament to the strength of public-private partnerships aimed at determining how the derivatives markets can facilitate the transition to a net zero economy. There is now a common understanding that climate change presents an emerging and increasing threat to financial stability and can cause subsystemic shocks and wide-ranging ripple effects to the U.S. financial system and the larger economy. However, climate change also presents opportunities as we work to ensure decisive and cohesive leadership over the markets and institutions charged with monitoring and managing the risk, capital, and asset allocation. The derivatives markets overseen by the CFTC are used for hedging a range of risks in the traditional commodity as well as interest rate, FX, credit, and equity markets. These markets also serve as powerful information resources for hedgers and investors when it comes to price discovery, market transparency, and facilitating the allocation of capital towards sustainable investments. Market participants from across all sectors, including the agricultural, industrial, and financial sectors, will increasingly turn to the derivatives markets as they manage the impact of both physical and transition risks related to climate change. I'm very proud of my own efforts over the last several years in support of the Commission and industry efforts as former sponsor of the CFTC's MRAC, whose Climate-Related Financial Market Risk Subcommittee report, which was released in 2020, Managing Climate Risk in the U.S. Financial System. And I'd be remiss if I did not mention former Commissioner, CFTC Commissioner Bart Chilton, who many years ago exemplified the role policymakers have the potential to play and the efforts also of the Bank of England, the Network for Greening the Financial System, the Financial Stability Board, IOSCO, and many others who are working towards achieving sustainable finance and resilient financial markets. At the heart of their efforts, and in the pages of the MRAC Subcommittee's climate report, is the concept of partnerships. The CFTC is uniquely poised as the regulator at the forefront of climate-related risk management, as firms and individuals will increasingly turn to the derivatives markets to mitigate climate change-induced physical and transition risk, and seek price discovery for new and evolving risk management products. Recognizing the CFTC's leadership and vigilance in overseeing these markets, I announced the creation of the Internal Climate Risk Unit in March 2021 to thoughtfully leverage the agency's resources and expertise to better understand the role of derivatives in pricing and mitigating climate-related risk, and support the orderly transition to a net zero economy through market-based initiatives. In addition to designing and executing today's meeting, I'm pleased to announce the CRU's leadership in drafting a request for information on climate-related market risk. The request for information will also seek responses on questions specific to data, scenario analysis and stress testing, risk management, disclosure, product innovation, voluntary carbon markets, digital assets, greenwashing, financially vulnerable communities, and public-private partnerships and engagement. The Commission may use this information to issue new or amend existing guidance, interpretations, policy statements, and regulations, or take other potential Commission action. The voluntary carbon markets are growing exponentially. Last year, the voluntary carbon markets exceeded $1 billion in value for the first time, and some forecast the additional financing from carbon markets could exceed $1 trillion by 2050. In November 2021, the 26th UN Climate Conference of the Parties, or COP26, concluded in Glasgow with a new set of initiatives to advance the Paris Agreement's goal of limiting global warming. Among the key outcomes was an agreement on the so-called Article 6 rulebook to facilitate international trading of emissions reductions. Article 6 of the Paris Agreement had previously set out a framework for cooperative approaches to achieve national carbon reduction and removal targets, but the absence of an agreement on specific implementation guidelines rendered it inoperative. The Article 6 rulebook ushers in an exciting new era for international carbon markets. The private sector has demonstrated its leadership and ingenuity by initiating, among other efforts, the Task Force on Scaling Voluntary Carbon Markets to accelerate the growth and adoption of voluntary markets. Multiple carbon offset derivatives contracts are already listed on the CFTC's regulated exchanges today, and more are expected in the future. The CFTC must build its capacity to ensure the ongoing integrity of these markets, identify and pursue any potential fraud or other abusive practices in the underlying markets, and promote responsible innovation and fair competition. In other words, we are now past the point of wondering whether our derivatives markets are implicated by the voluntary carbon markets. The answer, very clearly in my view, is yes, and we as a regulator have an imperative to examine these markets to assess credibility and integrity. Multiple private sector-led voluntary carbon market initiatives are underway to address the integrity of the supply and demand for carbon offsets. It's critical that voluntary carbon markets support high-quality, data-supported carbon offsets that meaningfully reduce or avoid carbon emissions. It's also critical that we acknowledge that carbon offsets are only one tool to mitigate emissions and should only be used when all other means have been exhausted to mitigate emissions. There is enormous potential for companies in all sectors to meet sustainability goals and net zero commitments. But emission reduction is not a one-size-fits-all undertaking. While carbon offsets may provide an efficient and cost-effective means to check that box and populate the balance sheet, if those offsets do not represent true abatement, either because they lack integrity or the underlying infrastructure lacks transparency, then VCMs remain in a perpetual limbo akin to being stuck in a regulatory sandbox. Today's convening aims to provide a public forum for a wide variety of market participants in the voluntary carbon markets to examine the issues related to the supply and demand for high-quality carbon offsets with a focus on integrity, infrastructure, and credibility. To reiterate, the CFTC is here as a market regulator to ensure, where appropriate, that VCMs grow in a responsible way with appropriate supervision and necessary guidance and guardrails. Indeed, our efforts today demonstrate a very intentional first step towards increasing U.S. participation in international cooperative efforts. As I've mentioned, as the derivatives regulator, we have an imperative to understand how these markets operate. And the purpose of today's convening, in addition to reaching a better understanding of the markets, is to pose the underlying question that really permeates every panel, and for which we are very eager to hear your input. What role should the CFTC play in these markets? We are here today to further ensure that the right choices are made and to take the necessary steps to understand and support, where appropriate, responsible innovation to tackle the climate challenge. Again, I'm honored and pleased to welcome all of you here today. I am very grateful for all of you to be here today and provide your expertise and input. And with that, I'm going to hand it over to my colleague, Commissioner Johnson, for any comments that she may have.
Good morning. Thank you, Chair Behnam. On May 20th, 2021, a little over a year ago, citing the increased frequency and severity of, quote, extreme weather risk leading to supply chain disruptions, President Biden issued an executive order acknowledging the significance and urgency of the need to address the intensifying impacts of such climate events, including, quote, physical risk to assets, publicly traded securities, private investments, and companies, as well as transition risks. In addition, the executive order on climate-related financial risk underscored the need to study and assess pathways to participate in the global transition toward solutions to address underlying concerns while maintaining, if not enhancing, the competitiveness and growth of the U.S. economy. Undoubtedly, voluntary carbon markets will play an important role in these efforts. I am grateful to Chair Behnam for his leadership as previous sponsor of the MRAC committee, his continuing partnerships with FSOC and other domestic federal regulatory agencies, as well as international regulators, the Bank of England and IOSCO, among others, and for convening this very important gathering today. I look forward to hearing from each of you and as experts and stakeholders who have taken your time to join, educate, and advise us as we undertake next steps as the singular regulator of our markets. Thank you so much for joining us. I'm so sorry I cannot be present with you today.
Thanks, Commissioner Johnson. And now, Commissioner Goldsmith Romero, please.
Good morning and welcome to the CFTC. I especially want to thank the chairman for his leadership in this area, and the staff and all of the participants who are here today. As expressed in President Biden's executive order on climate-related financial risks that my colleague just cited, a whole-of-government approach will lead to greater understanding of the financial risks that climate change poses, and to the development of effective strategies to mitigate those risks. The CFTC should be at the forefront of financial regulatory efforts to understand and identify actions to mitigate climate-related financial risks that impact CFTC-related regulated markets. When I testified at my confirmation hearing, I said that as our markets evolve with emerging issues like climate and digital assets, regulators must be thoughtful and deliberate. It is important to learn the facts, to listen to all sides, to understand consequences of any action, and collaborate with other regulators. Being thoughtful helps keep markets resilient, transparent, and free of fraud and manipulation while promoting responsible innovation. Today is an opportunity to learn, to listen, and understand. First, the Commission can benefit significantly in understanding physical climate risk directly from those in our markets who bear the risk. Second, the United States has an opportunity to be a leader in the emerging voluntary carbon and sustainability markets, and public input can help realize that opportunity. As a market regulator, the CFTC's mission is to promote the resilience, the vibrancy, and the integrity of our derivatives markets. Commodities markets have been impacted by significant climate disasters, such as wildfires, hurricanes, flooding, and other disaster events that have caused devastating financial losses to farmers, ranchers, and producers, losses that have impacted our derivatives markets. In determining how to promote the resilience and the vibrancy of these markets, it is appropriate for the Commission to seek data and input on climate-related physical risk from those in our markets who bear the brunt of that risk and the public. And the Commission should be thoughtful and deliberate in any future action and consider potential consequences on farmers, ranchers, and producers. Additionally, the Commission's role extends to promoting responsible innovation, which includes the evolution of climate and sustainability products in our markets. There is a growing global market demand for derivative products that could serve as a hedge against both physical risks of climate change as well as transition risk as companies move toward a net zero environment. With a growing number of companies making net zero pledges, there is notable interest in carbon offset or sustainability products. However, concerns about transparency, credibility, and greenwashing may hamper the integrity and growth of these markets. I look forward to your input on whether there are customer protections, guardrails, or standards that the Commission should consider as part of its mission to promote market integrity and transparency and to keep our markets free of fraud and manipulation. I'm interested in hearing what special or unique circumstances, considerations, or challenges these carbon markets present. I am particularly interested in hearing about customer protections, standards, or guardrails that are needed in order to achieve transparency, credibility, and integrity. And I'm interested in thoughts on the appropriate role of the CFTC to promote responsible innovation in these markets. As the sponsor of the Technology Advisory Committee, I am also interested in any input and thoughts, whether at this event or after, about how technology could play a role in promoting scaling up of these markets. I look forward to the discussion, and I appreciate all of you for taking the time to share your insight.
Thank you. And Commissioner Mercier?
Good morning, and thank you all for being here today. I know you're taking time out of your very busy schedules to be here, and we greatly appreciate it. And we really appreciate the fact that you're here to share your perspectives with us today. I think it's really important to have this discussion in the public, so I'm glad we are doing this. I have no doubt that the discussion today, as outlined in the agenda shared with us just last night, will be very compelling. But I'm primarily interested in hearing explanation about how this impacts the work we do here at the CFTC, especially the role that this will have in our legacy agriculture contracts. Growing up on a farm, I watched drought, flooding, and violent weather destroy our livelihood in a matter of hours. I distinctly remember many mornings riding in my dad's truck, surveying what was left of our cornfields after a hailstorm, or seeing the burnt spikes of the wheat that turned too soon because of extreme heat and lack of rain. For production agriculture, the financial risks of climate and extreme weather is and has always been real, and our farmers and ranchers have been using legacy agriculture contracts to hedge those risks since the inception of those markets. However, our role as derivative market regulators fits very narrowly into this broader discussion. And I hope we can highlight that today so that there's no confusion at the end of the day as to what we can and cannot do here at the CFTC. Again, thank you all for being here and for sharing your knowledge and expertise with us today.
Thank you. And finally, Commissioner Pham.
Good morning, and thank you to all who are here in the room and watching online. I'm so pleased that you could be here with us today because it's always great to see the CFTC engaging with the public prior to engaging in any policy making or rulemaking. It's critically important that we get the benefit of all participants' technical expertise and knowledge. I'm especially looking forward to hearing about market-driven solutions in the voluntary carbon markets. Derivatives are a powerful risk management tool, and I believe in the power of the markets to provide solutions. Climate-related issues in our markets do need to be thoughtfully studied. They impact so many important stakeholders, from market participants to end users and up and down the value chain, and as my colleague Commissioner Mercier just powerfully explained. I do think that any action beyond roundtable discussion needs to carefully consider the impact on small entities, and we cannot unduly burden the substantial numbers of growers, producers, and other end users who depend on our markets for risk management and price discovery. After all, that's the original purpose of our markets and of this commission. Thank you. I look forward to the discussion today.
Thanks, Commissioner Pham. And now we have, I think, the great benefit of hearing from the chairs of the Senate and House Agriculture Committee, who were gracious enough to put together a few minutes of remarks before we kick off with the first panel. So I'm going to hand it over probably to the folks behind that black glass window and see if they can kick up first. Chairwoman Stabenow's comments.
Thank you, Chairman Behnam, and thanks to the Commodity Futures Trading Commission for hosting this important event on how carbon markets can help address the climate crisis. In his time as commissioner and now as chairman, and even before that as a member of my staff, Russ Behnam has been extremely forward-thinking on this issue, and I really appreciate it. In fact, he was one of the first regulators to talk about the financial risk presented by the climate crisis. As we develop solutions to this global challenge, we need to bring all parties to the table and explore every avenue to meet our climate goals. Financial markets, and particularly derivatives markets, have an important role to play. Carbon markets provide valuable incentives for industry to reduce emissions, and they drive revenue for farmers and foresters by paying them for the climate-smart work they do on their land. Environmental markets more generally allow producers to hedge the risks associated with the climate change. When combined with other policies such as clean energy standards, incentives for things like electric vehicles, made in Michigan, by the way, and adoption of more bio-based products and renewable fuels, we can really start to make a difference. But participants must have confidence in these markets if they're going to be effective. That's why I'm working to pass the Growing Climate Solutions Act. Farmers, foresters, landowners are already generating credits and value. They need the USDA to provide the tools, the integrity, and the assurance that their hard work is not wasted. With USDA taking a more active role, we will see more projects and more participants. And this approach is overwhelmingly bipartisan. My bill received 92 votes in the United States Senate and has the support of major farm groups, environmental champions, and influential companies. It will bring greater accountability and, in doing so, increase confidence in voluntary carbon markets. The CFTC shares these same goals, I know. As chairwoman of the CFTC's Oversight Committee, I know that CFTC is vigilant about promoting integrity in the derivatives markets, and I'm excited to see the results of today's meeting. I look forward to continuing to work with you to tackle this critical issue. Thanks.
Thank you, Senator Stabenow, and hopefully to Chairman Scott's comments.
Hello, everyone, and thank you for inviting me to speak at this historic event. And I'm delighted to be here. And this is making history, because this is the CFTC's first ever Voluntary Carbon Markets Convening. And I'm glad to be with you at this historic occasion. First of all, I really appreciate the attention you're giving to this topic, and I look forward to hearing what comes out of this important hearing. This is a very important issue for agriculture, for our forestry, for our whole nation and the world. And at my very first hearing as chairman, I pledged to explore every opportunity I had to mitigate climate change and the significant risk to our agriculture production. And in September of last year, we explored the potential that voluntary carbon markets could play in that mitigation through my very first Agriculture Committee hearing. Our ecosystem service markets, including carbon markets, provide an interesting value proposition to our farmers, to our producers, our business interests, and the public at large. These markets have the potential to create new, fantastic economic opportunities while also tackling the greatest challenge of our time, which is climate change. And also by rewarding our farmers and our ranchers and our foresters for implementing practices that sequester carbon markets, our markets can create an opportunity for our farmers, for our producers to capture new financial income streams. And in addition to their economic potential, voluntary carbon markets have the potential to capture the significant mitigation available within the agriculture and forestry sectors. However, given the variation that exists in today's markets, serious questions remain over the quality of some of the carbon credits that are currently being generated. And likewise, many questions remain about our farmers, our producers' participation in markets, including how to fairly compensate our farmers and producers. Make no mistake about it. I want everybody to know this is very important to me personally as the chairman of our Agriculture Committee, because we've got to treat and make sure our farmers and our producers are treated fairly when it comes to income possibilities from participating in our carbon markets. And also, I'm very concerned about the ability of our smaller farmers to participate and also how to reward the existing stewardships, among others. To capitalize on these excellent opportunities, markets must be developed with the appropriate safeguards in place to secure the intended outcomes so that customers and the public will trust them. And they should rest upon a reliable and transparent accounting and verification framework. Very important. Verification is key. And to ensure that they are developing the environmental and climate benefits that we all desire, that we all want. Markets should seek to compensate farmers appropriately for their role in storing carbon and reducing harmful emissions. I can't emphasize it enough, the verification and making sure that our farmers, our producers, are compensated fairly. And we must ensure that our landowners are fully informed and that our landowners are aware of their role in providing carbon offsets. As a whole, it is a tool within the larger conservation toolbox worth exploring. Now, moving forward, it is also my hope that we can explore how carbon markets can work alongside our Farm Bill conservation programs in our efforts to further mitigate climate change. These programs play a leading role in providing and improving farm productivity, profitability, and environmental stewardship, and can go hand in hand with voluntary carbon markets. So I want to thank you again for having me. And I want to thank you for having this important historic convening. You know, agriculture and the CFTC have the key roles to play in the development of voluntary carbon markets. And I look forward to continuing, and as chairman of our House Agriculture Committee, I look forward to being a helping hand in our forward progress of dealing with not only our nation's most serious issue, this is a world issue, and we deeply appreciate the CFTC and our agriculture industry and our House Agriculture Committee for helping to provide leadership in this most important and necessary issue, climate change. Thank you.
Thanks to Chairman Scott. And I'm going to hand it over to Abigail now to take over with logistics and kicking off the first panel.
Thank you, Chairman. Just a few logistical and administrative reminders. Participants, please press the button to activate your microphone when you speak. This meeting is being simultaneously webcast, and it's important that your microphone is on so that the webcast audience can hear you. Also, please lean into the microphone when you speak and keep your phones away from the console. If you would like to be recognized during the discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand and the moderator will recognize you and give you the floor. Virtual participants, please use the raised hand feature in Zoom if you would like to interject. If you use abbreviations or technical terms, please explain them the first time they are used. There will be a transcript of this roundtable, which will be posted on the CFTC website. Additionally, before we begin today, we would like to remind participants and attendees that this is a public convening for which the purpose of today's event is for the CFTC to receive information and opinions from the individual panelists on issues related to the voluntary carbon markets. The CFTC is not seeking consensus advice from the panelists, and this convening is not a meeting under the Sunshine Act. Additionally, none of the statements made during the convening should be construed to constitute or imply endorsement, recommendation, or favoring of any organization, products, or services of the United States government, the CFTC, or any CFTC employees. As noted in yesterday's press release, there will be a public comment file open until June 15th for the public to submit comments on today's discussions. And with that, I will now introduce our first moderator who is joining us virtually today. Kelly Kazire is a fellow with the Bezos Earth Fund, where she works to identify strategies and solutions for ambitious corporate action and carbon markets. She was most recently Vice President for Global Climate at the Environmental Defense Fund, where she led EDF's work on international climate agreements and global cooperation through carbon markets. Kelly was a lead climate negotiator for the EU for more than a decade and served for 3 years as the co-chair of the Article 6 negotiations under the Paris Agreement. She currently plays a leading role in several voluntary carbon market initiatives, including the VCMI, Voluntary Carbon Markets Integrity Initiative, and the ICVCM, the Integrity Council for the Voluntary Carbon Market. Kelly will moderate our first panel today, which will discuss carbon offset standards and quality initiatives. Kelly, the floor is yours.
Good morning, everyone. Can you hear me okay?
Yes, we can.
Thanks for having me. I'm delighted to be here to moderate our first panel on carbon standards and quality initiatives. Voluntary carbon markets are recently booming, and as a result, we see the emergence of initiatives focused on ensuring that the VCM delivers high quality.
Apologies, Kelly. The audio is a little muffled.
Okay. Let me just try and turn myself up. Is that better?
We're gonna check in with our tech team.
Apologies.
Unfortunately, there's nothing we can do for your audio coming in. It will be on your end.
Okay. Let me try a different microphone.
Okay.
Is that better?
Do you have two
Maybe
links
you just
open? I see you twice in Zoom.
So what I can do is I'll have the audio go through my phone. Is that better?
Yes, much better. Thank you.
Okay. So, good morning, everyone. Thanks for having me today. Sorry about that, technical problems. I'm sorry. I'm delighted to be here to moderate our first panel on carbon standards and quality initiatives. Voluntary carbon markets are recently booming, and as a result, we see the emergence of initiatives. Sorry, I've got an echo on my side now, which I'm just We see the emergence of initiatives focused on ensuring that the VCM delivers high-quality emission reductions that are aligned with the goals of the Paris Agreement. In addition to the work of the major standard-setting bodies, and we're lucky to have the major American standard-setting bodies represented today on our first panel, there are other initiatives underway, and these are working well to establish high-quality standards for the voluntary carbon market. I think these have just been mentioned, but to mention them again, they include the Integrity Council for the Voluntary Carbon Market, which focuses on establishing core carbon principles and an assessment framework for VCM projects, and the Voluntary Carbon Market Integrity Initiative, which focuses on the role of carbon credits in real and meaningful company climate action. These and others are certainly a good place for financial regulators to look when considering their next steps. So without further delay, I will turn to our panel. First, we have Stephen Donofrio. Stephen is the head of the Global Carbon Market Trade and Transparency Platform Ecosystem Marketplace. He has more than 15 years of experience in voluntary carbon markets and sustainability disclosure, previously with leading climate action organizations, including the Chicago Climate Exchange and CDP. This morning, Stephen is going to give us an overview of the voluntary carbon market to give us context and to kick us off. Stephen, over to you.
Thank you. Thanks, Kelly. Well, first, let me thank the CFTC for organizing today's roundtable. Thank you to Chairman Behnam, the Commissioners Johnson, Romero, Mercier, and Pham. Thank you very much for having everybody here today. Also to my distinguished colleagues, many of those who've been in this market longer than I, around this table and also online in the virtual audiences. it's a pleasure to have this opportunity, I think, collectively to be together and to talk about where we can see the market going in the future. Also the risks, the opportunities, and everything in between. Thank you, Kelly, for your opening remarks. I will do my best to provide an overview of the voluntary carbon markets in 8 minutes. If I do start to go over time, just let me know, and I'll cut myself off. Just so everybody has a familiarity with who Ecosystem Marketplace is, we are a nonprofit initiative of Forest Trends, which makes us uniquely positioned as an independent, neutral platform for collecting all carbon market trade data from the over-the-counter market as well as exchanges over the years. And we do this through, historically, it's been an annual survey. We've now moved into an online system where we're collecting trade data on a more frequent basis. And our ambition over the next 6 months is to be able to report pricing and data and information on as frequent as monthly or as needed going forward. We come to this with about 2 decades of experience tracking the market, providing reports, content, insights that hopefully a lot of the colleagues in this room have had a chance to digest, a lot of colleagues have contributed to, and we're very grateful for the collective support that we get in order to do our work. What we end up being able to produce, not just these annual reports, the state of the voluntary carbon markets, which are free to download, available on our website, providing price information by project type, standard, country, all other details that might be of interest to potential investors, buyers of credits, as well as product developers and regulators. We primarily get our data on sales from product developers and intermediaries and investors. And it's confidential data that gets disclosed uniquely to us, which we then turn into aggregated analysis and information. Just briefly in numbers, just a few numbers here. We now have over 200 organizations worldwide that are reporting to us from over 40 headquarter countries. The credits that are transacted and are reported to us are originating in over 100 countries. These credits, as I mentioned about standards, I have a couple of standards with me on my panel today. The majority of standards that exist and are represented by the data that we have, you will see in the information. And as was mentioned, we recorded that the market hit over $1 billion last year, and we're going to be releasing very soon the full 2021 calendar year update of the market, which even further accelerated past $1 billion. I was asked to give an overview of the history of the voluntary carbon markets. I do not have the time to go through all of these details. But the reality is for all of us that we have been working at this for potentially 3 to 4 decades. If you consider the early days of experimentation by NGOs and governments to establish payments for ecosystem services. And early days where we go back to 1992 to 1997, Kyoto Protocol, and then the ultimate U.S. withdrawal from the Kyoto Protocol arguably can be attributed to the fact that we now have such a robust voluntary carbon market. If the United States had not pulled out of the Kyoto Protocol, likely would have been a part of compliance programs, and the voluntary market would not exist in the same way it does today. So there are many organizations that had a role in doing that. I won't go back through all of these years that you see here, but what is clear to be able to demonstrate is that the market has had ups and downs. It's reflected changes in policy at the domestic level or international negotiations level. It's reflected changes in technology and opportunities, to invest both domestically here in the United States, in North America, which is really in the early days where the supply and demand for the voluntary market came from. After a few years in, realizing we need more volume and more opportunities for supply, buyers began looking overseas and product developers began looking overseas. And that brings us, through a whole shift of investing into new types of projects that are large-scale forest conservation, like REDD+, into today where nature-based projects and solutions are clearly dominating in terms of interest from project developers, investors, and off-takers. That doesn't mean that renewable energy or technological type of projects are not a part of the market. They very much are, and I'll talk about that also in just a moment. So in more recent years, it was mentioned by Kelly that there have been some advancements in terms of identifying opportunities for improving integrity in both the supply and demand side through various initiatives. I'll leave my panelists to talk about the more recent developments in the market from that front, as well as talk about the Paris Agreement, Article 6, and the implications of that. What I do want to focus on is just how we've seen the market grow and also, as I mentioned, have peaks and valleys in the past decade plus. What is most notable is that in 2019, the market started to really turn. We saw that after the Paris Agreement was signed in 2015, there was a bit of a lull. But then as market confidence really came back into the play because of net zero commitments and carbon neutrality commitments from the demand side, recognizing that there is an urgent need to invest into emission reductions today through various types of opportunities, including market-based approaches. And so that opened up a whole opportunity for not just new projects to be purchased and credits originating from those projects be purchased, but also projects that have been originated prior to 2018 or 2017 that still had valid emission reductions associated to them, even coming from the Clean Development Mechanism, which was part of the Kyoto Protocol. So as we saw in 2021, 3 quarters through the year, we were on track towards $1 billion in market notional value. It ended up far exceeding that, and as I mentioned, we'll be reporting that final number very soon. And what I think I want to highlight is just the move that we've seen the market as catering to 2 or maybe fundamental factors in terms of the contract structures. One being these long-term natures, design of corporate commitments around climate action, net zero goals that are 20, 30, 40 years, carbon neutrality goals that are multiple years in advance, require thinking today about how to secure emission reductions into the future. So what was largely a spot cash market is now also becoming a cash forward market. And as we've seen in the last year with exchanges coming back into this market, offering futures products as well. So we're really excited to see how that continues to evolve and how the market appetite for securing long-term strips is accelerating. And I know I'm running close on time, and I wanted to highlight this one slide here, which just provides a glimpse into one slice of the information, looking at product categories. I've broken this down into nature-based versus technological. There's relatively a split in terms of volume, but as you can see by pricing, the prices are what change the market value. It also is important to recognize that we're looking at hundreds of millions of tons of traded CO2. So when we're averaging out projects that, for forestry, for example, that range from below $1 a ton to some of them over $200 a ton, we average that together. That's the volume weighted average prices that we're seeing here today. Renewable energy is notable in the significant amount of volume that is transacted. However, it's also important to recognize that the price per ton has been declining over the past several years. Again, I won't dive into more of this. We do have reports that are available publicly, and I know I need to move on to finalize my comments. There is a growing conversation around availability of supply in the market and whether or not there's enough supply to meet demand. We have a consolidated database of over 14 standards in their registry data. And what we've compiled here and what I've shown here is year to date. This is up through April of this year. How issuances, the green bar, has progressed over the past several years in 2021, hitting a milestone, a marker in terms of number of issuances. But year to date, we've seen the amount of issuances decline while the pace of retirements appears to be staying steady. And so we're eager to see how more supply can come online faster. I know the standards are working diligently with their project developers and project proponents to improve efficiency in the process. But it's also about new methodologies, new project types, new technological approaches, understanding how we can bring more and more projects online. So I'll leave my comments there. I'm very happy to answer questions in the Q&A, and thank you very much for the time.
Thank you, Stephen. Next, we have the pleasure of hearing from Sonia Gibbs. Sonia is the Managing Director and Head of Sustainable Finance for the Institute of International Finance, or IIF. The IIF was project sponsor for the original task force on scaling the voluntary carbon market, and Sonia now sits on the board of the governing body that emerged out of that task force, which is the Integrity Council for the voluntary carbon market. Sonia, over to you.
Thanks, Kelly. It's great to see you and other Integrity Council board members here today, and thanks to the CFTC for inviting us. Tremendously important topic. I'm going to skip right to slide 5 because Stephen's done a great job setting out the backdrop, so I'll skip all the scene setting. I don't know who's handling the slides, or do I do that myself, or are you? Perfect. Okay. Just moving ahead like that. All right. Wonderful. Hey, fantastic. Technology win. Fantastic. Okay. So, as Stephen has set out, voluntary carbon markets have faced challenges around fragmentation and perceptions of quality. And this is where the Integrity Council for the Voluntary Carbon Market, the ICVCM, comes into it. The explicit purpose of this council is to ensure that voluntary carbon markets accelerate a just transition to 1.5 degrees centigrade by setting out a definitive set of global threshold standards, making a global benchmark for carbon credit quality. And they draw on the best possible science and expertise available so that high-quality carbon credits can channel finance to genuine and additional greenhouse gas reductions and removals that go above and beyond what could otherwise be achieved. So, it's really important to note that the voluntary carbon markets are not a primary solution for fighting climate change, and that's an argument that is heard a lot in climate debates, right? So it's a complementary tool to reduce and remove emissions over and above what would otherwise be possible, and it can also help channel capital from mature economies, who are obviously responsible for the bulk of carbon emissions, to emerging markets that are most impacted by climate change. And it can also, voluntary carbon markets can also help accelerate innovation and uptake of emerging breakthrough technologies. And of course, one of the challenges to voluntary markets is that they've been lacking the consistently high integrity necessary to achieve its full potential. So without integrity, we really can't scale voluntary carbon markets. And we use the acronym CLEAN here, which we thought was very clever, to describe our vision of a high integrity market: catalytic, local, empowering, additional, and nature positive. So all really important attributes. But to get there, we've got to address all 3 pillars of what it means to be in high integrity voluntary carbon market. And first, we got to know that credits are doing, as the British say, what they say on the tin, because there is a definitive threshold standard for high quality credits. Second, we've got to have the confidence and transparency in the pricing of high-quality credits, trading in a market that's based on rigorous standards and sound market infrastructure. And finally, integrity means, of course, that buyers are making legitimate claims, using these high-quality credits as part of a credible net zero pathway. And what the Integrity Council does is focus on the first 2 of these pillars, but we work closely with organizations like the Voluntary Carbon Markets Integrity Initiative, the VCMI, that are focusing on this 3rd pillar, demand-side integrity. So in this work, we're really grateful to have the help of so many market experts, our moderator, Kelly, and a number of speakers here today: Nat Keohane, Alexia Kelly, David Antolioli right here, Jeff Schwartz, Mark Kember. So it's great to have so much expertise in this endeavor. Our mandate: the Integrity Council is mandated to establish, host and curate a set of core carbon principles, the CCPs, that are a definitive set of global threshold standards. We provide governance and oversight over standard-setting organizations on how they adhere to the CCPs, as well as on market infrastructure and participant eligibility. And we help coordinate and manage interlinkages, connect the dots, I think, between so many individual parts of the market and define a roadmap for responsible growth of voluntary carbon markets. So, the core carbon principles, the CCPs themselves, this is central to the work, obviously. And we've got a world-class expert panel. We're very hard at work, 24/7, making sure that we're integrity-led, grounded in the science. The core of the standard is the CCPs, high-level principles supported by an assessment framework setting out the detailed criteria for each principle. And if you think this is easy, think again. There's a lot of controversy around all of these principles and standards, and this expert group is hard at work fleshing these out. So there's two parts. First, quality principles for carbon credits, like additionality, permanence, and so on. And second, integrity principles for carbon crediting programs, including how the programs are governed, and robust independent validation, verification, and so on. So, our core focus for the first half of this year has been to develop these CCPs, and in July, we are going to launch a rigorous and inclusive public consultation phase overseen by the British Standards Institute, and they are part of our executive secretariat for the board, and that's going to run for 60 days. We hope to hear from all of you in the course of this consultation. And the next phase is going to be to apply the CCPs, both to assess carbon crediting programs and to assess types of carbon credits by sector so we can issue accreditation where appropriate. And meanwhile, we'll pilot our assurance model leading to ongoing market oversight and enforcement. So power to name and shame, ultimate sanction to withdraw accreditation. We're going to engage widely across the market, working to secure broad acceptance and take-up of the CCPs and ongoing connections and liaison with regulatory bodies, including the CFTC, IOSCO, and so on, in order to make sure that these CCPs are well understood and socialized. And we're going to collaborate with other organizations to foster transparency and good infrastructure, and ensure that the market can really play its part in fostering an orderly, fair, and affordable climate transition. So I know we're going to be short on time, so I won't spend a lot of time, but this is just an overview of the structure of the Integrity Council. Got a really broad range of expertise on our board of directors, on the expert panel, and a distinguished advisory group. Here's our board of directors Facebook. You can see it all here. Our wonderful chair, Annette Nazareth, and I just wanted to mention a word here to commemorate the passing of Hugh Seeley, who many of you will know, who was Annette's our co-chair on the board of directors, who suddenly passed away this year, and we miss him greatly. And he was a wonderful man, and Annette is doing yeoman's work in carrying on. Importantly, we have 3 places for representatives of Indigenous peoples and local communities. And this has been a real goal and challenge for us in establishing this kind of expertise and presence on the board. It's tremendously important to have representation from these groups. Here is an overview of our executive panel, 12 leading carbon market experts, lots of technical and sector expertise, including in nature-based activity, energy, agriculture, climate policy, and so on. And we have a wonderful, distinguished advisory group across all types of posts. Many of these people are going to be familiar to you. And we've most recently welcomed Hindu Ibrahim to the Distinguished Advisory Group. And she's president of the Association for Indigenous Women and Peoples of Chad. So it's a really fantastic group, and it'd be well advised to take a look at these folks who will be our ambassadors for the Integrity Council and the CCPs. And this is just a representation of the initial sponsors of this work, and the ongoing support of these organizations is tremendously important across the carbon markets value chain. So I'll stop here, call for feedback and implementation when our public consultation launches in July, and we really look forward to hearing from you all on your responses. Thank you.
Thank you, Sonia. Next, we have the opportunity to hear from the major American voluntary carbon market standard setting bodies. And first we have David Antonioli, the Chief Executive Officer of Vera. David, apologies for slaying your last name.
That's okay. Thank you, Kelly. Thank you for the invitation, and thank you, Chairman Behnam and Commissioners Johnson, Goldsman, Romero, Mercier, and Pham for the opportunity to speak here. It's a real honor, and hopefully we can, elucidate and articulate a little bit about what the carbon markets are all about. In my presentation, if we can get it up there, please. I think, no, that's the next guys. Maybe we'll go back. Let's see. Here we go. We're going backwards, but we'll get there eventually. Here we go. Let me just talk a little bit about who we are so you understand the context. We're a nonprofit organization established in 2007, established in the United States in 2009, and our job really is to certify the outcomes of environmental and social projects. And we do that through our standards-based programs, of which there are many. The most important one is, or our flagship program, is the Verified Carbon Standard, which is the world's leading carbon credit standard used in the voluntary carbon market. We've issued 934 million credits for more than 1,800 projects, and in the US there's 48 million credits from almost 100 projects. So it's a wide variety of projects around the world. Many of them are also certified to our sustainable development standards, the Sustainable Development Verified Impact Standard and the Climate, Community, and Biodiversity Standards. As Sonia mentioned, and Stephen also alluded to, many of these projects have non-carbon benefits that are also important for projects to be able to demonstrate. So they're reducing poverty, they're addressing adaptation challenges, they're helping communities thrive. And so many projects want to, or choose to certify and demonstrate that they're also not just reducing greenhouse gas emissions, but also providing important benefits for communities. At the risk of running into the belly of the beast here, I will articulate a little bit or explain what we do so that you can understand the context in which we operate. Our program, the VCS program, has four major components. At the core of it is the VCS standard, which is basically the set of principles that all of the credits that we certify need to meet. And so these are elements that you might have heard, such as additionality, permanence, the fact that you need independent auditing, the fact that projects need to be transparently listed. These are all core principles, to borrow a phrase from Sonia, that all of our credits need to meet. And they get operationalized through the three different elements of the program that are what we call the programmatic elements of the VCS standard. The first one are the accounting methodologies. So in order to define and measure the emission reductions, you need to have an accounting methodology that sets out exactly what sort of data parameters you're going to gather, on what basis. It sets out the project boundary, what the baseline scenario is, and really is a tool and a methodology that one needs to follow in order to determine and prove that you've reduced the emissions that you claim you have. And then one of the key pillars of the program is that it needs to be independently verified. And so we have a number of auditors that work under our supervision, and they need to make sure that that the projects are following the rules. So we ourselves don't verify the projects themselves. We oversee auditors who are doing that on a regular basis. We do check on the auditors' work, and we work with the accreditation entities to make sure that they have the capacity and the training they need to be able to audit under this work. And then finally is the registry system. So if you go to this link right here, the Vera Registry, you can find out pretty much anything you ever wanted to know about any of the projects that we've certified. And that is, that's the information on or you can find all of the auditors' reports, the project descriptions, how many credits they've issued, whether they've been retired, and on whose basis. And the registry really is a key element of the program and the system to make sure that we avoid double counting, and there's full transparency behind all of the credits that we issue. And so together, these really form the basis for what we do. And so that's really the key components of the VCS program that's fit together to create the VCS program. And then the carbon credits really come from the idea that a number of corporates sought to understand and take action on climate change in a way that was missing from the regulatory bodies. So they do continue to be an important tool, but we see it as a complementary tool to internal reductions and potentially government action as well. And we're starting to see acceptance of the carbon credits from the voluntary market in other markets worldwide. The voluntary carbon market as a whole and the infrastructure that we've built, we believe is a ready-made, easily scalable infrastructure that can finance reductions at scale. And in many ways, it can support national climate efforts around the world. And I did want to point out that these are two very important initiatives. Sonia already mentioned it. We talked about the VCMI, but these really are about the supply and the demand side of things. And I think that on the supply side, just to echo what Sonia was saying, the ICVCM really will hopefully create a threshold level of performance that carbon credits will meet and give the market the confidence it needs to invest in them. And on the VCMI side, that's the demand side, where I actually think that there's quite a bit of more confusion around what are the claims that companies are making, whether, what is really a carbon neutrality claim, what does it really mean, or climate friendliness. Those claims really need to be identified and articulated and defined in a much more clear way, and that's really the work of the VCMI that we're looking forward to seeing the outcomes of that. And then finally, in terms of regulatory implications, as I mentioned before, the voluntary market has historically come from the idea of corporates taking action to address climate change. But there's an increasing maturity and momentum behind the voluntary markets that's creating initiatives that are harmonizing the quality standards and increasing transparency, which we think will be very powerful and very helpful to drive climate action. The voluntary markets really are not a single activity, but a mosaic of activities. And what we're seeing is that there's potential for asymmetrical information that may provide the framework for proper regulatory action. We think that there's a lot of work that could be done in respect of ensuring, again, that the claims that companies are making in respect of climate change are accurate and really do hew to a consistent level of performance. There's a bit of potential here in terms of advertising or consumer protection that could be provided. And there's also financial and securities regulations to promote market stability and confidence to ensure investor protection. Thank you very much. I'm glad to answer any questions at the end of the session.
Thank you, David. Next, we have Mary Grady. Mary is President and CEO of Environmental Resources Trust at Windrock International, where she oversees the American Carbon Registry as well as the architecture for REDD+ transactions, ART. Mary.
Thanks, Kelly, and thank you very much to the Commission. Well, David did a great job of explaining in a very simplified way the work that we do as a carbon standards body in terms of overseeing the development of quantification methodologies for the measurement, monitoring, reporting, and verification of emission reduction and removal activities, overseeing the independent third-party verification, and managing a registry where there's a transparent view into the projects themselves, as well as the issuance of serialized credits, the transfer and retirement of those credits, and everything behind them. So ACR was founded in 1996. We've been doing this work as described for over 2 decades. And we, in addition to working in the voluntary carbon markets, we're an approved offset project registry for the California Air Resources Board. We've been working with the Air Resources Board for over 10 years now to help them implement the cap and trade program in the state. And we're also approved by the International Civil Aviation Organization, ICAO, to supply units to the carbon offsetting scheme for international aviation, the CORSIA. ACR's geographic focus is almost exclusively in the US, and our sectoral scope in terms of crediting ranges from forestry, improved forest management, reforestation, as well as industrial projects, such as those that capture and store carbon, those that capture methane, and also a transition to low global warming potential refrigerants. As Kelly mentioned, the other program that is managed by our group under Winrock International is the Architecture for REDD+ Transactions, or ART. And ART's geographic focus is international. However, the sectoral scope is focused on crediting national and subnational governments in forest countries for reducing emissions from deforestation and forest degradation, which is called REDD+. So I think, the backdrop for the quality discussion, I like to assume that the intent for quality in carbon markets has always existed. It's really just been an evolving concept. Stephen described this foundational history of the Kyoto Protocol and its own carbon mechanism, the Clean Development Mechanism, or CDM, under the United Nations. And I think that the unfortunate inception of the lack of trust in markets is a consequence of this implementation of this market that started more than 20 years ago. The CDM was set up to channel carbon finance through markets to developing countries to decarbonize their own economies. And it's been an experience in learning by doing. There have been really a lot of good outcomes, maybe not some good outcomes. I would say much more heavily weighted towards good outcomes. And there's no question there have been lots of lessons learned. One of those lessons learned is that the quest for perfection can stifle innovation. And another lesson is that a centralized approach doesn't always deliver the best outcome. It can create bottlenecks, it can create inefficiencies, and it stifles innovation. The reason this is important to understand is because, as Stephen outlined, the fact that the US was not part of the Kyoto Protocol meant that we had to develop our own carbon markets. And the foundation of a lot of the carbon markets in the beginning in the voluntary space was actually the CDM. So we used the basis of the CDM and then expanded, and the voluntary market became, all of these markets outside of governments. And this non-CDM voluntary carbon market really is innovative by nature, and we grew to fill a gap in sectors that the CDM did not address, such as the land use and forestry sector, and also filled a gap in geographies, since we were including all countries in the ability to generate credits. The voluntary carbon market has been agile to adapt and improve. The standards bodies that have evolved have enhanced transparency, and we've tested different approaches to measurement, monitoring, reporting, and verification of carbon credits, and those evolutions continue with technological advances. Most recently, we've seen the emergence of crediting programs that are focused at jurisdictional scale forestry for reducing deforestation rather than at the project level. So these are the kind of evolutions that we're able to do in this space, which is different than something that's under a centralized program. The overall result, and then David alluded to this, is actually a convergence in compliance and voluntary carbon markets, as the major carbon market standards have all been approved by and adopted by international carbon compliance markets, such as the International Civil Aviation Organization's CORSIA, as well as by carbon markets in California, Colombia, South Africa, and others. So the independent standards, such as those that are around the table today, we're really operating across markets. We register projects and we issue credits. Those credits can then be used by both compliance and non-compliance actors. So in this ongoing quest for quality across the markets, the challenge we're presented with is how to accelerate the legitimate climate action by governments, corporates, and civil society, and while we're scaling those actions to reduce and remove emissions. And what we've learned is that it's hard to have a one-size-fits-all top-down prescriptive approach to carbon integrity. We're dealing with different geographies, different social and economic realities, and what will work in the North is not likely to work in the South. So the idea that we really need to be realistic about is setting standards that ensure integrity while also allowing for innovation. This is why the global community under the UNFCCC shifted from the centralized approach under the Kyoto Protocol to the decentralized approach under the Paris Agreement. And the global carbon markets have followed suit and are now converging on rules around functional equivalency for quality. So how to harmonize all of these different approaches to ensure that we have comparability and fungibility in credits across markets, and that we are able to have confidence in the quality of all of those. Thank you very much.
Thank you so much, Mary. I'd like to finish the panel in the next 13 minutes in order that we have time for about 15 minutes of questions. But I want to make sure everybody has time to say what they need to say, because this is a really important introductory first panel that sort of sets the context for the day. But if the next speakers could try to keep it to about 6 or 7 minutes, then we'll have some time for questions. Next, we have Kristen Gorgenpour, who is the Vice President of Programs of the Climate Action Reserve. Kristen, over to you.
Thanks, and appreciate the opportunity to speak this morning. So I'll start off with just providing kind of an overview of the Climate Action Reserve and kind of our history and kind of our approach to offset crediting. So we were launched in 2001 as a result of California's legislature action to really spur climate mitigation and focusing on like voluntary reporting. And then in 2008, we kind of made a switch to kind of focusing on project level offset accounting and thinking about how can we really bring high quality offset standards to the market, and kind of what does that look like. And so we've done that through a standardized approach, which I'll talk about in just a minute. So the reserve does have kind of 3 programs that it does operate, similar to some of the other standards here speaking today. So one program we do have is we serve as an offset project registry, serving to kind of help California implement their cap and trade program. We also have a program called Climate Forward, which focuses on ex-ante crediting. And so essentially crediting kind of future emissions in recognition of future GHG impacts. And then our other main program is our voluntary offset program, which is primarily focused in North America. And so with that program, what we've tried to do is really focus on high quality standards and thinking about what is the best way to go about doing that. And at the heart of that process is really like a public stakeholder process for kind of developing methodologies through a standardized approach. And so when I talk about a standardized approach, I'm really talking about 2 things. One is looking at a standardized approach from the perspective of additionality and thinking about what is the criteria that will demonstrate that these projects are actually additional and should be credited for purposes of carbon. And thinking about, and getting away from this project specific assessment and kind of taking that subjectivity away. We also kind of view standardization through looking at the quantification approach and thinking about how we standardize baselines, and the business as usual approach, thinking about just the quantification of thinking about emissions factors and just approaches to quantification. And so through this process, we think it kind of makes a very clear perspective of what should be included and credited as an offset. And it also provides some certainty to the market to understand kind of, what is the amount of credits that are going to be issued? What are the activities that need to be engaged in to actually get those credits? So taking a little bit of a step out and kind of looking at our program and kind of where we're working in North America, we are seeing huge growth even within just our registry itself. We currently have over 500 account holders that are either developing projects within our system or transacting our credits. And to date, we've issued 171 million credits, both under the compliance offset protocols as well as the voluntary side. So there's a very huge opportunity that we're seeing in North America. There's lots of investment within this space, new financial power essentially coming in and kind of thinking about how do we leverage this market? How do we kind of move forward with implementing projects? And so that provides opportunity for kind of innovation in the space. We are often thinking about what are the new protocols that we can develop by maintaining like these high standards. But because there are new players coming into the market, there are lots of challenges associated with that, and different approaches for kind of how people are quantifying offset emissions and reductions and removals. And so thinking about the quality initiatives, particularly on the supply side, I think the Reserve's perspective is that they're vital. These initiatives for kind of maintaining the integrity of the program that the current standards have that have established to date, and thinking about how these standards will really kind of shine light on more of the opaque processes and credit issuance processes that aren't necessarily following kind of the bigger standards approach to crediting. I think it's going to provide a common framework for how we even talk about these things. So often at the Reserve, we get questions about how do you think about, what's your approach to double counting, permanence, there's different perspectives, and kind of providing that common framework is going to be essential. I do think there's challenges with trying to define what the standard is and what high quality means, and I think Mary alluded to this a little bit, but it is difficult to have a standard that's a one size fits all given all of the nuance within this sector, and thinking about different approaches to how we might view different approaches to crediting. And so thinking about how we can really give a fair assessment of the programs given all of the different approaches and nuances in this space. And so I think one of the challenges is how do we get this right? Because I think it's also important to be very clear for the market to understand how they're actually going to view this information. And so I think it's going to be really important that we do have a community of stakeholders that are engaged in this process for developing these standards, the people that are going to be able to make it real and practical and be able to be implemented. Thank you.
Thank you, Kristen. And last but certainly not least, we have Dr. Thomas Hale, a professor at the I can't talk today, obviously, the Blavatnik School of Government, University of Oxford. He's the co-chair of the Independent Expert Peer Review Group for the UN's Race to Zero campaign and is a lead at the Net Zero Tracker. Thomas, delighted to have you.
Thanks, Kelly, and thank you everyone for the great comments so far. I'll try to be quite brief so that we can get to the discussion, Kelly. But it's a real pleasure to talk about this because I'm delighted to see the CFTC taking this issue up. It's a really important conversation because the quality and integrity of carbon markets and carbon trading is really critical to the broader challenge of how we get to net zero. So I'm going to offer 3 quick points to try to wrap up this part of the conversation. First, I just want to put the voluntary carbon markets a bit into the broader context around corporate climate action and the transition to net zero. I want to highlight where the limits of the voluntary carbon markets are at the moment. I think we need to be very clear-eyed about what's not working. I want to think about how we think about some of the ways in which standards and regulations, including perhaps from the CFTC in the future, could help to overcome some of those limits. So first point, how does the voluntary carbon market fit into the broader context of corporate climate action? Well, as we've already heard, there's been a huge explosion, of course, of corporate net zero targets. In the Net Zero Tracker, which is a project that Kelly mentioned, we look at the Forbes 2000 companies all around the world. And of those 2,000, about a third now have some kind of net zero target. That's up from a fifth last year, so it's growing very quickly. And of course, those are corporate net zero targets where we see similar actions from cities, from states, from provinces and regions, and of course from national governments. And actually something like 90% of global GDP is now covered by some kind of national net zero target. So obviously that varies a lot across different parts of the world. Here in where I'm sitting in the United Kingdom, the number of Forbes 2000 companies that have a net zero target is somewhere in the 70 to 80% range. In the US, it's more around 40%, but again, this is moving very quickly. Now, of course, those net zero targets vary hugely in quality. Some are really robust, coming with plans, including all of a company's emissions throughout its value chain with a very clear sense of scope and real kind of mechanisms for accountability and deliverables and targets and transparency. And some are really just a press release. And so this is why we've seen a lot of criticism arise, particularly around the use of offsets in net zero transition plans, because of this huge diversity and frankly, the real work that needs to be done on quality and robustness of these corporate net zero plans. So we've kind of reached the end of the beginning, if you want, of net zero, where it's now kind of widely accepted as a paradigm for corporate climate action and indeed for other actors, national governments as well. But we're now in the harder realm of robust operationalization. So second point, where does that connect to the voluntary carbon markets? Well, we've heard from the other speakers how it's developed and what its scale and potential might be. But I think it's really important in this conversation to look not just at what's possible, what's really happened in practice, and to be quite clear-eyed, as I said, about that. Because in theory, practice and theory are the same, but in practice, they're not. And the voluntary carbon market, as it's existed so far, has really suffered, I think, from two limits, one on quality and one on quantity. And the two are, of course, connected. So quality is obviously two variables still. We've had a number of people today talking about all of the great work they're doing to build up quality standards, which is excellent. But there are plenty of people in the voluntary carbon market who are not putting in that work to look at quality in quite the same way. And that means we have a lot of risk because buyers and stakeholders will be looking for the extreme examples. For example, there's big media furor recently around some credits that were generated with enhanced oil recovery, where you pump carbon underground to get more oil back up. And the credits for counting the carbon that was used to pump into the ground, but not the carbon from the oil that got pumped back out. So obviously for a consumer or a stakeholder, that looks a little bit suspect. And here real transparency is a big barrier to success. So shockingly, of those third of Forbes 2000 companies that have some kind of net zero target, most of them, but more than half, don't actually specify whether or not they will use offsetting in the achievement of that target. And those that do say they will use it, 2/3 of those don't say whether or not they will put any kind of boundaries on the quality of those offsets. So there's a real lack of information how we can assess the robustness of these targets because the voluntary carbon markets are still too loosely controlled, too loosely standardized, and too loosely regulated. So that quality problem feeds really into the quantity problem because we've reached, as someone said, $1 billion in volume, which is certainly a landmark, but obviously for this to be a really important part of our broader transition, it's going to have to be many times that to have a real dent on the problem. So we really need a new approach. And if we think how to take things forward, we have to kind of go back a little bit to first principles and think of what we actually want these markets to help us do. And they can help us reduce emissions, of course. They can help us protect and restore nature. And they might be able to help us develop new technologies that could be useful for neutralizing residual emissions. But I think this whole net zero paradigm now really changes a lot of legacy approaches in the voluntary carbon markets because we're not really just thinking about how we can be more efficient at reducing emissions. We're thinking about how do we radically decarbonize the entire world in a few short decades. And that requires a different approach than many of the sort of legacy products and legacy providers have been used to providing so far. That's the scale of the challenge, I think, that comes from this net zero turn. We at Oxford have developed a set of principles on net zero aligned offsetting, which basically, to sum up, say we should, of course, make them high quality. So you're getting what it says on the tin, as Cynthia was saying, but also to make sure that the use of offsets is not delaying or substituting for the immediate decarbonization that we need to see happen across the economy. And instead using, as was said, offsets as a tool to go above and beyond to help us speed up that pathway and to do some other things that might be useful, like transferring technology or resources to those parts of the world or of the economy that would benefit from it. So that's a really big reshaping of what the system needs to achieve and how we do it. So final point, and I'll end here, is just how do we think about the standards and regulation and perhaps doing the role of entities like the CFTC in this huge need to kind of reimagine what carbon markets can and should do. I like to use the metaphor of a conveyor belt of governance, where we think about transitioning from the voluntary space, where we have initiatives like some of the ones on the panel today that are thinking about this in a real way, to how that becomes an actual standard that consumers can use in the market. And you think about something like disclosure of climate-related risks, you can see a real transition over time from voluntary measures to then kind of orchestrated programs like the TCFD framework to now regulation, where many large economies and also proposed by the SEC are now requiring or moving to require companies to disclose this kind of information. So I imagine, and I think we all could maybe benefit from looking toward that kind of conveyor belt as well in the voluntary carbon market space as well. And so this discussion is indeed very timely. Kelly, back to you.
Thanks, Tom. I want to open to questions. Abigail, I'm going to have to rely on you for the room. So maybe we'll open questions to the room first. And if those participants online could raise their hands, I can take your questions in turn.
Sure. We have our first question from Tyson Slocum.
Tyson, please.
Thank you so much. Great panel. I really appreciated all the perspectives, and particularly the comments from Professor Hale, who I think raised some very important questions. And so just building off of what Professor Hale was talking about, we've got significant growth that's going on from all of these corporate net zero commitments. And my question is, it seems like the discussions on assessing the integrity of offsets, while I am grateful it is happening, it seems like it's awfully late in the game for this to all of a sudden be an important issue to be assessing. When you speak to any independent expert, the problem is the integrity of offsets. You know, the additionality, the durability, all of these things. And so and many of the panelists, you know, talked about how they've been doing this work literally for decades in some cases. And so my question is, I see a disconnect between the ability of the current institutions to effectively manage the significant growth to come of assessing the integrity of these offsets with the current track record of poor performance, that we have a crisis of integrity in offsets. And I'm just trying to figure out how to manage that going forward, and doing other things like, it's one thing to have standards, it's another thing to have enforcement to ensure that there is oversight over the claims and protocols being made. Thank you.
Thank you. Which of our panelists would like to take a crack at that question first?
Kelly, I'm happy to kick off, and I think others will probably have comments as well. It's a terrific question, and look, I think, as you note, a lot of this work has been going on for decades. The difficulty is that it's in various corners of the globe, as we discovered in bringing together this expert panel. There are people in academic settings, in think tanks and environmental groups who have so much expertise, but the systems for evaluating integrity, it's fragmented, right? So the point of what we're doing at the Integrity Council is to bring these groups together to work on a common standard that will help the markets scale. And as for sort of enforcement and oversight, I mean, it's a key question and one that we think about a lot on the board of directors. Ultimately, I think that the vision has to be that this is an integrated and interoperable market between voluntary and compliance markets, and there will be appropriate regulatory oversight. In the meantime, given the challenges of this topic and each project, each credit is a snowflake. It's all very bespoke, this evaluation. Developing standards is hugely challenging, as you know. So by doing this with a market-led approach, right? So with this private market-led, well-supported integrity council, these standards should come into a well-accepted being, right? When they're finished, when we get the consultation done, get the responses in, we should have grounds for widespread acceptance in the markets. And at that point, ideally, regulators, the CFTC, IOSCO, others will be able to look at these standards and say, okay, this is something that we can adapt and use for appropriate market regulation in due course. So that's kind of the approach, right? Sort of one ring to bind them all, as it were. That's sort of my take on it, but others may have.
Thank you, Sonia. Do any of the representatives of the standard setting bodies want to come in there? David, Mary, Kristen?
Sure.
David?
Yes, no, thank you, and then thank you for the question. I think it's a great one, and I think there's that perception out there. However, I do believe that the key problem is not one of integrity, of crisis of integrity, as you call it, but really a crisis of confusion. That there's a number of different solutions out there, and that it has created some confusion, some fragmentation. In the meantime, we've seen millions of dollars invested in projects throughout the world that are delivering concrete, real benefits for the climate and for communities all around the world. And I think that's a really important piece of the story that needs to be understood. Now, and the creation of these two important bodies, the Integrity Council for the Voluntary Carbon Markets and the Voluntary Carbon Markets Integrity Initiative, are exactly what you're suggesting, which is we're coming together to define what is a threshold level of performance that you need on the supply side from the standard setting perspective, and what, the kinds of credits that we issue, and what are some credible claims that you need to have in order to have consistency in respect of what the companies that are using the carbon credits and ideally are on a trajectory to meet that net zero target, what they're doing and how they're using those credits. If we can bring those together, we will reduce the confusion and be able to create an even bigger and more impactful market that will complement internal reductions made by companies.
Thank you, David, and thanks for speaking to the confusion as well, because it's a lot of what I see, along with continuous improvement. So I don't think there's ever a time when we just get this perfect. You have to be continuously improving over time. And speaking of trends over time, Stephen, did you want to come in here?
I did. Thank you. So what I heard from the final panelists was more of a question about integrity of the demand side approaches around net zero and where carbon credits fit into those climate commitments, right? And I think the difference of evaluating the supply side and the demand side together is that the supply side has been working around integrity and credibility for, like you said, the past 2 to 3 decades. The standards have been advancing their approaches, advancing methodologies, modernizing their approaches as new data, new technologies around remote sensing become available for forestry and REDD+ projects. So I think it is, as David talked about coming together, but I think there is an important rationale for keeping the conversation around integrity distinct between supply and demand side, for one. And I guess I would just close to say that as we look at the opportunities that this provides, not just to corporates to advance their climate goals, it also, as David alluded, it is providing finance and support for the agricultural sector. We're seeing more initiatives that are popping up to develop approaches to support farmers, not just here in North America, but worldwide. There are cook stoves projects that are reducing the amount of deforestation and land utilization that's required by ensuring we can more sustainably use resources and provide social benefits to communities and individuals in places that wouldn't otherwise be able to afford it. So we shouldn't silo ourselves too much in focusing on one of the end purposes, which is climate action, but instead looking comprehensively at how it can improve sustainable development, not just internationally, but also here in the United States.
Kelly, can I say quickly on the point of whether the demand and supply side should connect or not? And I hear you, David, that there's Stephen, that there's very different, levels of maturity in some of these conversations. But to my mind, it really has to be connected to have legitimacy and integrity. And one of the sources of confusion is actually coming from the lack of connection between them. So if you're a corporate setting a net zero target and you're actually buying a lot of really good offsets, but you're not also driving deep decarbonization throughout your supply chain, then you're not really delivering on what a high integrity net zero target would look like, even though you're buying some really perhaps potentially good net zero sort of compatible offsets. So with only one, we're not going to have the legitimacy that corporates are seeking with these kinds of targets. And so I fear without a kind of integration across them, we'll actually have more confusion and undermine the ability to really get to where we need to get to.
Could I just come in quickly to respond to Thomas Kelly? And that's exactly why the VCMI on the demand side and the Integrity Council on the supply side are working closely together. It's an important point. The concepts are distinct, as Stephen points out, but they are interrelated and they're both needed. I'd also highlight here the Glasgow Financial Alliance for Net Zero, the GFANZ. A lot of the work that's going to be done there around transition planning, goal setting, all that sort of thing is going to be directly applicable to standards in this market, as are some of the work that's in the SEC disclosure consultation and the ISSB as well, which are calling for disclosures around the use of offsets.
Thank you, Sonia. I just want to, Kristen, Mary, do you want to come in here, or has most stuff been covered? I want to make sure we get to other questions if we have them. Kristen? You're on mute.
Sorry about that. I'll just make a brief comment. I think too the experience of the standards currently, right? So I think that all that experience can be leveraged, and we are seeing kind of in the marketplace, right, how regulatory bodies are adopting the standards and approaches from the voluntary carbon market and kind of like what that would look like. So California has adopted many of the approaches that we Vera and ACR have implemented, and they make changes to that. I think it will be like a ever evolving process, right, as the market's changing with lessons learned.
Thank you, Kristen. Mary?
I think the panelists have covered it well. I mean, the point is that we, particularly those of us who have been in the market for a long time, are in a state of constant evolution and improvement. We're learning by doing, we're learning from the experiences of what's happening with projects on the ground and improving our methods, our transparency. And it's important because, as we're doing that and growing our methods to be able to reach small farmers and forest landowners in the US, for example, it really is driving finance to additional activities. And, the biggest concern that we feel is out there is this emergence of this new era of carbon cowboys that are see the market as a way to make a lot of money, and they're coming in and they're quick and they've got venture funding. They don't have the same kind of climate basis motives. They don't have the transparent governance or processes, and so. We're really hopeful that the initiatives such as the ICVCM are going to be helpful to deliver that sense of quality and assurance to the market.
Thank you. Yes, a threshold standard can bring it together. Tyson, thank you for your question. I think you can see that it hit a sweet spot in terms of the things our panelists wanted to talk about. Abigail, is there another in the room?
I'm not seeing any other questions. Do any of the commissioners have any questions? Okay. I think that's all that we have from the room. Anyone remotely have any questions?
I don't see any hands raised, but there are several people on the phone. So if people on the phone just want to speak up with questions, that'd be great. Well, I think we're at time and we don't have any questions. I really want to thank you for having me and to all these excellent panelists. I think what we're hearing is that, to allay the confusion and to bring it all together, we do need to look to initiatives like the Integrity Council or to the BCMI or to the net zero initiatives to really try and help us understand what is high quality, so what does it mean to make a high quality claim. Obviously, oh dear. Very nice. Hopefully, I have solved that problem. Obviously you need a level of nuance when you go to the actual credit level, but there are things you can do with combinations of project type and standard setting body that can really start to allay the confusion, make sure that we are on track with continuous improvement, and really have a threshold standard for what good looks like. So thank you very much. Thank you to all of our panelists. Thank you for the organizers, in particular, Abigail, who I was in touch with a lot. And I'm looking forward to the other panels of the day.
Thank you, Kelly. I'll pass it over to David.
Thank you. Thank you, Abigail. Thank you, Kelly. And as I'm introducing our next panel with the government panelists on panel 2, head over to where panel 1 is now sitting. It's my great pleasure to introduce Nat Cohen, who is the moderator of our second panel, which will discuss state and federal regulatory updates. Nat is president of the Center for Climate and Energy Solutions, otherwise known as C2ES, a nonpartisan nonprofit organization that works with policymakers and businesses to accelerate the transition to a thriving, just, and resilient net zero emissions economy. Dr. Cohen is a globally recognized expert on climate policy, carbon pricing, and the economics of climate change, and has helped to shape market-based climate policies in California, the U.S., and internationally. Before joining C2ES in 2021, he headed the climate program at the Environmental Defense Fund, and in 2011 to 2012, Nat served in the White House as special assistant to President Obama for energy and environment. And previously, he taught at the Yale School of Management, where he was associate professor of economics. No stranger to the CFTC, Nat was also a member of the Market Risk Advisory Committee's subcommittee on climate-related market risk. It's really a pleasure to have you, Nat, and take it away.
Well, thanks very much, David, and thanks to Chair Behnam and Commissioners Johnson, Romero, Mercier, and Pham for the opportunity and for this panel. This is really a terrific panel of experts from various agencies and departments across the U.S. government, as well as representing states. But I also want to add, each of these folks on the panel is a deep expert and brings huge experience and expertise in climate policy in their own right. So it's really a pleasure to be on this panel. I also want to note, since many of the panelists are from various departments and agencies in the U.S. government, there is an ongoing policy process inside the government to build and develop a policy position involving many of these agencies, but that is ongoing. And so I want to emphasize right now the folks on the panel are speaking from their perspectives and from the agency's perspectives, but they're in the process of developing that kind of unified position. So the perspectives we'll hear today are part of that, a part of why I think building that going forward. I also want to just briefly note, we heard about the Integrity Council in the Integrity Council for the Voluntary Carbon Market in the previous panel, and I just want to note, I think it's pertinent here, my organization, C2ES, is part of the executive secretariat of that Integrity Council, and so that's one perspective that I bring to this. So as I said, we've got a great panel, several folks online as well as in person, and I will just introduce each panelist as I turn to them, and I'll do that in the order that's on the agenda. So we will start with Jason Gray. Jason is Project Director of the Governor's Climate and Forest Task Force at UCLA School of Law, and he's a recent former regulator and policymaker in the California Air Resources Board, and so comes to us with that perspective, although also currently now at UCLA. So Jason, over to you.
Thanks, Nat. And thanks to CFTC and everybody else for the invitation to be here. It's an honor to be on this panel and to listen to the discussion as it's continuing for a very timely discussion. I'm going to present some perspective from my former role as the head of the California Cap and Trade Program, where I oversaw all aspects of the program, including offsets design and implementation. I also previously served as a regulatory attorney on the program design, so I have some of that perspective as well. With that said, as Nat said, I have a caveat. I'm not here speaking on behalf of the California government. I can no longer do that, and these views are my own. The new role I have at UCLA, which I'll just mention for the following reason, is really supporting tropical jurisdictions and states and provinces around the world as they look to development strategies that are low carbon, reducing deforestation, and leveraging all available tools, including voluntary and compliance markets. So many governments that I now help support are also looking at some of the same questions you're all looking at today. I'm going to provide a few points of context, which I hope are useful for compliance and voluntary markets. And some of these may repeat some things from the last panel, so apologies for that. And hopefully these describe how offsets can be an important part, a small but important part of government programs like the whole of government approach taken by California. First, as you heard before, there are key differences between voluntary and compliance markets. This looks at who designs them, who approves decisions, who oversees them, and consequences for non-compliance. And from a regulatory perspective, at least from an environmental regulatory perspective, there's additional levels of rigor and legal mandates in a compliance market. Second, and this I think was emphasized at the last part of the previous panel, there are long-standing voluntary programs and experiences in compliance markets and voluntary markets where the fundamental question of scope, authority, design, and implementation have been tackled for years and provide a really good place to start. California certainly learned a lot from the programs that you heard from earlier and adapted those programs into the compliance regime. Third, many of the design elements relate directly to these integrity measures that we all agree are necessary to demonstrate a real offset. And an offset that's looking to reduce or sequester greenhouse gases. That is their purpose. These are crucial to ensuring confidence in the underlying instruments, and I think for regulators like the CFTC, also confidence and certainty in any derivatives of those instruments. These need to be real, quantifiable, verifiable, permanent, enforceable, and additional, terms that are very consistent through the UN process as well as through all these different markets. How you define and implement these terms is very important, and I'll go into how California has done that for some of these elements in the California regulatory program. First, California focuses on data quality and verification of that data. Any program, voluntary or compliance, is only as good as its data quality. Offsets are no different. To be real, verifiable, quantifiable, there has to be rigorous data that can be independently verified. And that data needs to be available for buyers to assess and conduct their due diligence. That's consistent across the voluntary markets you heard from before, as well as the California compliance market. And parts of the confusion that I see emerging are some voluntary platforms purport to sell credits or certificates or even tokens, but the underlying information about the underlying reductions in the instruments may not always be available for the buyers to actually assess. Second, California developed standards that set the rules. These publicly vetted and, in California's case, regulatorily approved standards set the monitoring, reporting, verification requirements, what are eligible activities and practices that are creditable, making sure that it is not really the snowflake approach, but really looking at a performance standard so that these projects can be assessed in a similar fashion. And this goes to additionality criteria as well as criteria for permanence, which in the California program is 100 years. From an additionality perspective, defining the scope is critical to eligibility. California took a different approach to defining additionality than the financial test that's under the Clean Development Mechanism. California assesses additionality against the activity as whether it's above and beyond any legal requirements and above and beyond a conservative business as usual scenario. This means that in a place where most of the sectors are regulated for greenhouse gases, offsets are very limited in where they can come from. California regulates electricity, transportation fuels, heating, and industrial emissions. So there are really very few places offsets can actually come from an additionality perspective in this compliance market. In California, that means forest projects, destruction of refrigerant gases, destruction of methane from dairy digesters, destruction of mine methane capture projects, rice cultivation projects, and urban forest projects. These are currently the only accepted offsets in the regulatory program in California. And importantly, California has litigated this approach. Third, California requires this program to be transparent, showing all the project data, verification requirements, where the credits are, where they've been retired. And this is available for the more than 500 projects California has issued almost 240 million credits to over the years in 38 states across the US. Fourth, to ensure reductions in covered sectors, California has limited the quantity of offsets to a very small percentage of a compliance entity's obligation, currently at 4%. Fifth, and we heard about this before, enforcement is critical. How that's enforced in a voluntary market through contracts, how that's enforced in a regulatory program through a regulatory authority. And finally, assessing whether there's additional non-carbon impacts to be considered, social and environmental safeguards in the international forest context, co-benefits like water, air quality, toxics in a domestic context. There are also critical factors that may also support integrity. These go to the goals of the program. Are you looking for cost containment? Is that a purpose of the offsets? Are you looking to drive investment in underfunded sectors or hard to decarbonize sectors? Certainty elements, locational requirements, regulatory perspective. Who will regulate this? Is there overlapping jurisdiction? And finally, it's important also to recognize that there are important investments needed in sectors that may not be eligible for offsets. For instance, targeting solar installation in underrepresented communities, or looking to drive investment into areas where a methodology for strict accounting of permanent reductions may not be ready yet, may not be available yet, but finding ways to help finance those activities. So all these combined are really the types of things that California has tried to assess in its compliance market. And I will leave it for there and hope that was useful perspective. Thank you.
Thanks, Jason. Very useful perspective. So the next panelist we have is John Morton. John is the climate counselor to the secretary in the U.S. Department of the Treasury. John.
Thank you very much, Nat. Thanks to Chair Behnam and fellow commissioners. This is, the word timely has been used several times. This is an extremely timely and important topic, and I'm thrilled that you're pulling this together for many reasons. With demand for offsets projected to grow significantly in the years ahead, there is obviously much work to be done, both in the public and private sectors, to ensure market integrity. This work includes setting high standards for credit quality and additionality, promoting strong measurement, monitoring, reporting, and verification, and developing a framework for how and when offsets factor into corporate net zero targets, all of which have been discussed by previous panelists. Ultimately, the overarching focus must remain on realizing the sharp emissions reductions called for this decade on the path to net zero by 2050. Voluntary carbon markets should not substitute for or delay the achievement of strong science-based targets in line with a 1.5 degree pathway. The panel that preceded us, the first panel, focused on efforts to enhance the integrity and quality of credits from the demand and supply side, and it's clear that this is a first-order threshold issue. To avoid greenwashing and protect investors and consumers, credits must deliver the promised emissions reductions or removal outcomes. At Treasury, we are following steps by the private sector to self-organize around quality standards. And while we are cognizant of the potential pitfalls and challenges in voluntary carbon markets, we see tremendous potential here as well and look forward to further public-private dialogue on the proper and high-integrity approach. We believe the CFTC has a critical role to play here, and it will be crucial to call and draw upon the expertise represented on this panel, including the experience negotiating standards for international market mechanisms like CORSIA and others, as well as the regional compliance markets that have set standards for regulated entities to use offsets in tandem for allowances. At Treasury, our overarching climate strategy is to enable and expedite the net zero market transition while ensuring the resilience of the U.S. financial system to climate-related risks. We see VCMs as playing a potentially extremely important role in that strategy, and we are seeing VCMs intersect with our work at Treasury now in several contexts. First, in our work with multilateral development banks and multilateral environmental and climate funds, which in many ways have led in building credit markets in developing countries. Number two, in our ongoing engagement with U.S. financial institutions around their transition pathways and those of their clients. And third, in our role as co-chair of the G20 Sustainable Finance Working Group, which is focusing on how to enhance the credibility of financial institution net zero commitments. One takeaway from all these conversations is the potential for innovation in terms of new project types and crediting methodologies. Today, we see an urgent need for climate mitigation projects that are not currently profitable or bankable in certain markets. And demand from offset buyers is potentially a large source of impact-oriented capital that could make these projects viable and enable them to move forward. We at Treasury look forward to continued dialogue around how VCMs can serve to channel capital to advance the net zero market transition. And finally, as we discuss ensuring the integrity of carbon markets today, we should also be mindful of where we're going over the medium term. Achieving the net in a net zero world by mid-century will require carbon removal and storage at scale. Voluntary carbon markets should ultimately match companies that have residual, non-abatable emissions to high-quality removals. And so we need to be thinking today about how we are going to grow the pipeline of high-quality removal projects, both nature and technology-based. And on technology-based removals in particular, the Department of Energy recently announced important steps, and we know there's significant work underway as well in this area in the private sector. So with that, let me say thanks again to the CFTC for hosting this event, and I look forward to the continued discussion here and as follow-up. Thank you.
Thanks, John. Next on the panel is Sean Babington, the Senior Advisor for Climate in the Office of the Secretary at the U.S. Department of Agriculture.
Thanks, Nat, and thanks to the CFTC, Chairman Behnam, fellow commissioners for your interest in this really important topic in this dialogue. Also want to recognize the previous work that the CFTC has done in this general arena, the formation of the subcommittee on climate-related market risk and additional dialogue that you all have carried out. So, USDA agrees with a lot of the sentiments that have been shared today, fellow panelists, that the primary focus on climate change mitigation needs to continue to be driving steep emissions cuts from key emitting sectors, and that voluntary carbon markets may play a role, assuming they're high integrity, high quality, especially in these hard to abate sectors, and also when included as part of a comprehensive emissions reduction plan that also includes direct emissions reductions. USDA has an important body of work contributing to those reductions in the agriculture and forestry sectors, as well as the sectors responsible for the majority of our emissions, electricity and transportation. This work includes USDA's Rural Development Mission Area, which provides hundreds of millions of dollars annually in grants and loans to finance the deployment of renewable energy and energy efficiency upgrades. It also includes our research and farm production mission areas, which pursue development and deployment of cleaner transportation fuels from agricultural and forestry feedstocks to replace traditional fuels, including jet fuel. And outside of the dialogue over the electric and transportation sectors, we also have key equities in the traditional agricultural and forestry sectors. And those sectors have key differences when discussed in the context of climate change. Agriculture has the distinction of being both uniquely very vulnerable to a warming climate and climate impacts, and also a domestic source of emissions. Sectors responsible for roughly 10% of domestic emissions, but has the potential to be a smaller source or even a sink with additional research and investment. Separately, domestic forests, which of course span public and private forest lands, are a carbon sink and could do even more with the right policy and incentives. So at USDA, we're pursuing a department-wide approach to drive nature-based climate solutions and really harness the power of the land sector to reduce emissions and store carbon. The sources and sinks of emissions in the agricultural sector are very diffuse, spanning millions of acres, thousands of farms, each of them a small sink or source on its own. And for the most part, USDA's authority in this space is not as a regulator, but rather as an entity that can provide incentive-based policies. And that's what we're focusing on, voluntary, producer-led, incentive-based policies that are flexible, but can also dramatically increase the adoption of more sustainable and climate-smart practices. We're doing that work through our existing slate of private lands conservation programs. For those who are sort of familiar with some of our work, that would be, for example, the EQIP program, the CSP, the Conservation Stewardship Program, the Conservation Reserve Program, along with some new initiatives that we've rolled out under this administration, notably the Partnerships for Climate Smart Commodities Program. The Partnerships Program is a $1 billion grant program launched by Secretary Vilsack in February of this year, which is geared toward driving additional adoption of climate-smart commodity production practices and fostering additional development in commodity markets for climate-smart commodities. There's tremendous interest in this program. We've received, and our first application deadline just passed last month, we received $18 billion in applications for direct grants, coupled with $8 billion in private sector match for a $1 billion grant program. There is tremendous interest, and we're going to have some hard decisions to make over the summer here. But there are a lot of things we're going to learn coming out of this program because we've included several key priorities as ranking criteria. A major focus on equity and historically underserved producers and communities, along with asking applicants to outline a very robust and comprehensive plan for monitoring, measurement, verification, and reporting of the greenhouse gas benefits of their proposed projects. And as I said, we expect to learn a great deal out of this program and think that some of those outcomes can be very relevant and constructive in the dialogue that we're having on market integrity today. Beyond the partnerships program, USDA is investing in a landmark soil health monitoring network, as well as taking steps to improve the USDA Forest Service's globally recognized forest inventory and analysis program to better account for carbon fluxes in our forested landscapes. And indeed, everything we're doing on climate at USDA is grounded in these principles of sound science and the need to have robust and credible measurement, monitoring, verification to underpin all of our work and investments. Really simply put, if the emissions reductions and carbon removals that we're pursuing and promoting aren't real and don't pencil out in science, then that's both bad for the climate and it's bad for the integrity of our work at USDA. Not to mention any private sector efforts that intersect with that work. So building on the comments from my colleague from Treasury, when it comes to those private sector efforts and the carbon credit marketplace, we think about the agriculture and forestry sectors as a potential source of those credits, particularly when they are appropriately deployed as part of a comprehensive strategy that includes those direct emissions reductions. Given the sizable unrealized potential in these nature-based solutions, along with how expensive we've actually found this climate mitigation to be in the ag and forestry sectors, we do need to embark on a thoughtful discussion regarding how to finance these climate-smart practices and whether private sector efforts may be a piece of that puzzle. And I think that's part of what the convening here today is designed to start that dialogue. As you know, these private sector markets have varying standards, varying degrees of rigor and monitoring required. So using sound science, recognized tools to verify this work and instill integrity in these marketplaces will be critical. And again, recognizing that some emitting sectors like aviation are difficult to decarbonize and credits may need to be pursued as a supplement to those direct emissions reductions. USDA is very supportive of increasing government research, data collection in this arena, and we should also evaluate options for addressing real concerns with voluntary credits, including carbon accounting principles like additionality, leakage, avoidance of double counting, other important principles. And finally, in conclusion, it does bear mentioning that USDA does have some statutory authority in this arena, specifically Section 2709 of the 2008 Farm Bill related to environmental markets. And the section of law directs USDA to help facilitate farmer, rancher, forest landowner participation in these markets. And we'd welcome an ongoing dialogue with fellow panelists, other stakeholders, and certainly CFTC as we continue our future work pursuant to this authority. As this conversation continues to unfold, we'll continue to make critical investments to support these MMRV efforts. And as I mentioned earlier, I feel very strongly it's in all of our best interest to ensure the integrity of the greenhouse gas mitigation efforts that can contribute to these markets, whether that contribution is through a government incentive program or a private sector marketplace or other programs. So thank you very much for the opportunity to be here today. Looking forward to the ongoing dialogue. Thanks.
Thanks, Sean. Next, we have Annie Petzonk, the Assistant Secretary for Aviation and International Affairs at the U.S. Department of Transportation, and somebody who has been a leader in this set of issues for many decades. Annie, it's really a pleasure. Over to you.
Thank you so much, and terrific to be here. Chairman Behnam, really want to thank you for organizing this conversation and for your continued interest in these issues over the years. And thank you to the commissioners who are here with us today or listening in. And Commissioner Mercier, your farm experience rings very personal chords with me because I grew up in rural Pennsylvania, and both the vagaries of weather and the potential impacts of climate and the importance of ensuring that farmers have the ability to have their efforts to farm in more carbon and climate-friendly ways be remunerated are very much near and dear to me as a personal matter. At the Department of Transportation, we start from the premise that emitting sectors need to look first to reduce their own emissions directly. That's why we're working across our different modes of transportation, including the historic investments coming through the bipartisan infrastructure law to boost electric vehicles across America with charging stations. And also, we have developed and released at the 26th Conference of the Parties to the Framework Convention on Climate Change last year, a U.S. Aviation Climate Action Plan, which focuses at beginning with reducing emissions directly from aviation. However, aviation is one of those hard-to-abate sectors, as Sean mentioned, along with maritime shipping, which is, in both instances, it's really hard to move these vessels through the air and on the oceans with things other than liquid transportation fuels. And so while we expect electrification to play a role, particularly with regard to short hop flights, and there's quite affirmative activity on that, because both aviation and shipping for long haul rely on large capital stock intensive investments with long capital stock lifetimes, we do expect that out-of-sector reductions will play a critical role in helping these sectors meet their goals. Well-designed market-based environmental policies, by setting ambitious goals and providing flexibility on how to meet the goals, and catalyzing competition and innovation in the search for better, cheaper, faster ways of meeting the goals, have tremendous potential to help meet the urgent challenge of the climate crisis. I want to profile one instrument which was developed for the aviation sector, and specifically which interfaces with voluntary carbon markets. And I will discuss some of the strengths and some of the challenges that that instrument faces. And then I'll talk about the role of government. CORSIA, or the Carbon Offsetting and Reduction Scheme for International Aviation, is the first global sectoral market-based carbon emission reduction program in the world. It was established under the auspices of the International Civil Aviation Organization, or ICAO, which is the UN agency charged with establishing standards for the international aviation industry. And it was established with the support of industry, labor, and governments. CORSIA limits the net emissions of participating international airlines to the average of their 2019-2020 emissions levels, and allows them the flexibility to meet those limits using two forms of emissions currency, if you will. The first are CORSIA-approved carbon credits, coming mainly from the voluntary carbon market, which come through a screen of CORSIA eligibility. The second emissions currency, if I can use those terms, that airlines can use to meet their obligations under CORSIA is sustainable aviation fuel, or SAF. And CORSIA has developed a set of standards for quantifying the climate benefits of sustainable aviation fuels, as well as sustainability requirements for those fuels. And so airlines who need to address emissions above the CORSIA baseline can do so either by tendering CORSIA-approved voluntary carbon credits, or they can reduce the number of credits that they tender by burning sustainable aviation fuels and quantifying using ICAO-approved methodologies, single methodology across ICAO with the opportunity for those who are promoting the fuels or advocating for the fuels to put forward their own quantification methodologies, provided that they meet ICAO rigorous standards. And the amount of emission reductions associated with those fuels can directly reduce the amount of offsets that the airlines need to purchase. In designing CORSIA, and I'll speak to my personal role in that regard, working with many, many others across the U.S. government and the non-governmental sector, industry, and many other governments around the world, we looked in part to the successful U.S. acid rain trading program, which really is in my view, the gold standard for the design of market-based environmental policy. And that was adopted as part of the Clean Air Act amendments of 1990. And I would encourage the Commission to look carefully at the minimum elements for integrity and transparency that were included in the acid rain trading program. The acid rain trading program achieved dramatic reductions in sulfur dioxide emissions, saving $1 billion in compliance costs for the industry compared to technology-based alternatives. CORSIA is not perfect and was not able to incorporate all of the design features of the acid rain trading program, but it has taken rigorous steps to address two issues that have been highlighted here, including by the question asked of the previous panel. The first is so-called additionality. ICAO developed a series of emissions units criteria that, while they do not in and of themselves provide a harmonized standard for governing additionality of offset projects, do provide a basis on which the CORSIA Technical Advisory Board can evaluate offset programs that apply for CORSIA eligibility. And I want to focus on this additionality issue for just a minute. What makes the voluntary carbon market very different than compliance-based cap and trade programs is that the unit of currency in a voluntary carbon frame is based on reducing emissions below what would have otherwise occurred. Now, I want to tell you that what would have otherwise occurred when I came into this building this morning is that I would have stopped at a bakery along the way and gotten my usual breakfast, which I will tell you when I'm coming to a conference like this might consist of 6 croissants. But I didn't stop there. And so, in principle, since I consumed less than what would have otherwise occurred, I could sell those uneaten 6 croissants to someone else. In order to verify the credibility of those 6 croissants, you need to know what I really eat for breakfast. And that takes some research and some very intensive work. And a number of the voluntary standards have tried to do that kind of work over the years, but I use the croissant example to illustrate the difference between regulated compliance-based markets and voluntary markets. The second piece that CORSIA tried to tackle was, I might say to one of my fellow panelists here, I'll sell you 4 of those uneaten croissants, but I'll also sell you 3 of those uneaten croissants. Unless there is a double entry bookkeeping system to assure that I am not double selling the croissant, the uneaten croissant, the system, the fundamental integrity of the system cannot be assured. And so in CORSIA, we included a provision that requires, before any emissions units can be transferred, an attestation from the host country government of the carbon offsetting project, that the host country government will not count the reduced emissions towards its own commitment under the Paris Agreement. The actual wording of the attestation is not perfect. It could be stronger, but I encourage you to look at it as one attempt to address the issue of double counting. And I focus on that because what we're talking about here is, in the sense of double entry bookkeeping, not just the asset creation, but on the other side of the books, the obligation. And the obligation I liken to a debenture to the atmosphere. How private voluntary carbon markets and programs handle that double entry bookkeeping in terms of their relationship to the host jurisdiction in which their projects are located is an important issue for the Commission to take a look at. And that's particularly important where the transaction involves a promise today to sell a reduction earned in the future. That is a future. That is squarely within your jurisdiction, in my view. And that makes the work of this commission all the more important. We and other agencies and stakeholders are happy to share our perspectives with you on how the lessons learned from CORSIA and other market-based measures can inform sound government policy and foster public trust in offset quality while providing investors, officers, and directors with the tools to do the due diligence to ascertain whether their investments are actually achieving the environmental results needed to undergird their corporate citizenship claims. The Department of Transportation is eager to engage with you, with the interagency, and with stakeholders as you move forward considering standards and guidance that can enable companies and communities, including farmers, to channel the power of markets in the service of driving economic development forward while driving emissions down. The task is urgent. Thank you.
Thank you, Annie. We've got two more panelists, and I want to make sure we have a little bit of time at the end for questions as well. So I will ask the panelists to stick with their aiming for 4 to 5 minutes. So Phil Duffy is our next panelist. Phil is the Climate Science Advisor at the Office of Science and Technology Policy at the White House. Phil, over to you.
Well, thank you, Nat, and thanks to the chair and to CFTC for organizing this important conversation. And thank you for the opportunity to participate. So I, as the scientists in the room, thought that I would spend my 4 or 5 minutes reviewing and expounding on some of the science relevant to voluntary carbon markets. And I'll start at a very, very high level and then zoom down to a greater level of specificity. So at the highest level, we all know that to meet Paris Agreement goals, we, meaning humanity, needs to get to net zero emissions as soon as possible within the next several decades. And so what that means is that we do need offsets because we recognize that there are certain sectors that will be very difficult to decarbonize. And so to achieve net zero, we will have to, for the foreseeable future, offset emissions from those sectors. We also recognize scientifically that our capacity right now to do CO2 removal, although substantial, is limited and is in fact less than we know that we're going to need in the long run. And that's the reason why we all recognize that it's so important to reserve offsets for emissions which are truly difficult to eliminate. If we use offsets instead of eliminating emissions which could be eliminated, then we run the risk down the road of simply running out of capacity to do further CO2 removal when we're really going to need it. We also all recognize that most of the offsets being done now use the so-called nature-based pathways, reforestation, and so forth. And the main reason for that, of course, is that those approaches, the nature-based approaches to CO2 removal at present are much, much less expensive than the more technological approaches like direct air capture. The nature-based approaches, again, reforestation and so forth, have other advantages. They are, as we say, shovel-ready. If done well, they can have important co-benefits like increasing biodiversity and enhancing regional and local economies. The nature-based solutions have important risks, which have already been mentioned. Permanence or lack of permanence, such as from wildfire, leakage, meaning that emissions occur elsewhere instead, lack of additionality, which Annie just now, I think, illustrated very nicely with a couple of examples. And as Annie said, the lack of additionality is particularly a challenge in the case of offsets based on avoided emissions rather than those based on actual negative emissions. So to be a little bit more specific, one of the challenges, one of the scientific and technical challenges we face in offsets is around the issue of soil carbon. We know that the capacity of agricultural soils to store more carbon theoretically is great. We also recognize that it's enormously challenging to measure progress in increasing soil carbon storage. And there was a very interesting, I thought, article in the journal Science that came out in March, which essentially said the following, and that is that at the level of individual fields, we really are very, very challenged right now to measure progress in storing soil carbon at a useful level of accuracy and precision. And so what this article suggests is two approaches to agricultural offsets, and one is to do soil carbon offsets not at a field level, or to structure offsets not at a field level, but at a regional level. The idea being that while it's challenging to measure soil carbon storage at the level of individual fields, we can do it now, even with present technology, with reasonable accuracy at a regional level. And so offsets could be structured based on measuring soil carbon at a regional level and crediting participants for progress that occurs at a regional level. Another approach is simply to base agricultural offsets on other forms of emission reductions, and there's plenty of emissions from the agricultural sector which can be reduced and which can easily be measured. So a couple of concluding thoughts. We do need carbon offsets. That's how we get to net zero. It's important, again, that offsets be used only for emissions which are truly difficult to decarbonize. A number of folks have emphasized the importance of good measurement, monitoring, and verification of offsets. And along those lines, the government is undertaking an effort to coordinate and expand and improve our ability to measure emissions and removals of CO2 from the atmosphere from all sources, including the land sector. And I should say that, well, certainly I don't think anybody thinks it's appropriate for the government to be in the business of offset verification. What we do hope, however, is to achieve useful synergy between what we're doing at the government level and what's going on in the private markets. And specifically what I'm referring to is the fact that there is a lot of exciting science on, for example, on better soil carbon measurement going on both within government and also outside of government. And it would be very, very useful if the private sector and the government efforts can inform one another and can help one another. And I think the potential exists for each effort, the private and the public, to benefit from the work that the other is doing. So those are my thoughts. Thank you, and I'd be happy to take any questions.
Thanks very much, Phil. Last on our panel is Christine Dragicic, the Branch Chief of Partnerships and Initiatives at the Office of Global Change, the Bureau of Oceans and International Environmental and Scientific Affairs in the U.S. Department of State. Chris, over to you.
Thanks, and thanks very much for the invitation to be here today. I truly appreciate it. Sorry not to be able to join you in person, but we're very grateful for the leadership of the chair and the CFTC in convening this discussion, which has brought together a lot of people working on different aspects related to carbon markets, and I think quite a critical time. So the Department of State has the lead on international climate policy, including as it relates to international carbon markets. And we coordinate very closely with US agencies working on domestic carbon credit markets where those interests intersect with our own international efforts. So hopefully you'll hear a lot of very similar themes echoed today. One thing I just wanted to highlight that a number of my colleagues have mentioned is that our overarching focus really is on setting ambitious climate targets, nationally determined contributions, net zero targets, and on prioritizing emissions cuts in this decade. We need to see all entities, governments, corporations, and others working urgently to reduce their own emissions across scopes 1, 2, and 3. And only after that do we turn to the question of offsets. Carbon markets, including voluntary carbon markets, cannot serve as a substitute for these goals. And so I wanted to start out by noting that that's absolutely critical. Within that, then, we're very focused on ensuring market integrity and on questions related to offset quality, additionality, as you've heard, transparency, and other issues. In this light, we work actively on a number of initiatives that relate to carbon markets. And through this work, we've been engaged in establishing a number of international carbon market frameworks and on developing the related guidance for these frameworks. One of the things we're most focused on are negotiations on what's called Article 6 of the Paris Agreement. So as you may know, Article 6 includes guidance on both the new carbon crediting mechanism established under the Paris Agreement and on what are called decentralized cooperative approaches. Under these decentralized approaches, some parties to the Paris Agreement will engage in international transfers of greenhouse gas mitigation that involves carbon credits. Will authorize their use towards NDC climate targets or other international mitigation purposes. Will report on the transfers, and will adjust for these transfers in accounting for their climate targets, their NDCs. Each party engaged in these approaches is expected to report some pretty extensive information about how the underlying carbon credit meets Article 6 guidance, including how they have environmental integrity, avoid double counting, promote sustainable development, and transparent governance. These reporting requirements clearly signal parties, governments' expectations for some of the more technical aspects of carbon credit activity design and credit certification. And the guidance for the carbon crediting mechanism, what's called 6.4, have even more detail on issues like conservative baselines and measures to address the risk of reversals. We're also very actively engaged in ICAO's CORSIA carbon market mechanism, which Annie spoke to a few minutes earlier. As Annie noted, CORSIA established rules and procedures to facilitate airlines in meeting their emissions reductions obligations, including through offsetting. So airlines must use approved eligible credits towards the CORSIA offsetting requirements. The State Department represents the US on the technical advisory body that advises ICAO Council on these eligible carbon credit certification standards based on their alignment with CORSIA's eligibility criteria and guidelines. And these criteria contain in-depth requirements for those standards and their credits. The evaluation of the standards themselves usually takes about a year for each program. We've seen these criteria and the ICAO evaluations positively influence independent standards governance and technical approaches to developing and certifying credits. And I'll note here that all of the CORSIA eligible standards, and so far there are 8, including some that you've heard from today, also supply credits used in voluntary carbon markets. We also have done a lot of work on voluntary mechanisms and international mechanisms related to forests and the land sector. One of the key initiatives is the LEAF Coalition, which brings together public and private sector partners to aggregate demand for forest carbon credits and results-based payments. LEAF is currently the largest public-private effort ever assembled to end tropical deforestation, and it sources credits certified to the independent Art Trees standard. I believe you heard from Art a bit earlier. We've led work on the Forest Carbon Partnership Facility and the Biocarbon Fund Initiative for Sustainable Forest Landscapes. These initiatives pioneered crediting and results-based payments at a national and subnational level for forests and for entire landscapes, including agriculture, respectively. Last year, we launched a program called the Offsetting National Emissions Through Sustainable Landscapes Program, 1SL, which builds capacity and addresses barriers to integrating forest carbon projects into broader subnational or country-scale forest carbon crediting programs. It's also developing tools to support participating countries in taking decisions related to the use of carbon markets in the context of implementing their NDCs under the Paris Agreement. Finally, we participate in the country contact group advising the Voluntary Carbon Market Integrity Initiative, or VCMI, which you've heard about, which is a multi-stakeholder platform working on a code of best practices for the voluntary independent certification of business claims related to their net zero climate strategies, and particularly their use of carbon credits in relation to those claims. In all of these initiatives, we've worked with a wide range of partners to develop or directly shape high integrity policy frameworks and carbon market mechanisms. We also work to establish the technical guidance necessary for these frameworks to function, and ideally reinforce consistency across the different systems. For example, supporting meta standards like those you see in CORSIA and VCMI. I'll note that carbon markets are perhaps the one area in which there is the most fluidity and cross-cutting influence between international and domestic systems, guidance and rules, voluntary and compliance-driven supply and demand. So for this reason, we work very closely with the colleagues you see here today on the panel, with others in the USG, to try and ensure consistency in policy approaches across the different initiatives in which we engage. I think I'll stop here. I know we're short on time, but I'm very happy to answer any questions later today and look forward to engaging further. Thank you.
Well, thanks very much, Chris, and thanks to the entire panel. So let me pause. We have a few minutes left. I want to see whether there are questions folks have from the audience, or any questions the panelists want to pose. Tyson.
Thank you so much, and agreed, it was a fantastic panel. My question is on trying to establish and verify permanence, especially for forest offsets, and what are some of the federal agencies and departments doing in that regard? Because that's the one issue that I think is so challenging, is how do you ensure that directing financing to support these projects, these projects to stop deforestation, that they're going to be long-lasting enough to offset the emissions. And so, yeah, that's it. Thank you.
I'm happy to jump in sort of briefly from the USDA perspective, and just with a sort of a admittedly base level knowledge about the complexity of some of these standards and programs. However, the concept of buffer pools seems to be relevant here, right? That if you assume that whether it be an insect or disease outbreak, a wildfire, a drought-induced disturbance to that forest, that you're gonna lose some 10, 20%, whatever it is, over the lifetime of the project length, whatever the standard that you're aiming towards applies. Then you just sort of only count 80 or 90% of that carbon, and you're just sort of building that into your assumption. So I think that's a relevant just sort of principle to think about here. And as I mentioned in my comments earlier, USDA's Forest Service is the largest and we think the most prestigious forest research organization in the entire world, and we steward a long-term data set going back to the beginning of the last century around our forest cover inventory, the forest inventory and analysis program. So there's a good deal of government data there and research that I think can be part of that discussion, along with a whole bunch of innovative folks in the private sector who come in and meet with us regularly to talk about additional capacity with satellites and remote sensing and things that can really help us be very precise and very rigorous when we think about forest carbon monitoring and carbon fluxes going into this discussion and others. Thanks.
I'm looking at other folks on the panel. I know Annie, if you'd like to, would you like to come in? I know that Chris and Jason and Phil, we have some of the world's experts on deforestation here as well. Chris, I saw you raise your hand, and Jason and Phil, if you'd like to come in, I know you could each speak really to this point as well.
Obviously, this is something the U.S. government cares a lot about. I'll let Jason and Annie certainly come in, and I will note that I think this is very different if you are talking about project level approaches or what we call jurisdictional approaches, so national or subnational scale programs. And that's actually why you've seen international policy moved towards these jurisdictional approaches over the last decade. In fact, under the UNFCCC, these were agreed in 2010, in part because the risk of non-permanence is much less when you're looking across a much broader area. So most of the work that State Department does on forest carbon markets as they relate to forests are actually at that jurisdictional level, that state, provincial, or national level. Within that, I think the focus on buffer pools is exactly right. Most of the approaches that we've engaged with actually require the use of buffer pools. And there's two ways of doing that. You set aside credits from a specific program so that in the pretty unlikely chance that there is actually a reversal across an entire jurisdiction, you draw on the credits that have been set aside in that pool. And then in many cases, we actually aggregate the buffer pools across a number of different programs because the risk of a reversal across 8, 9, 10 different jurisdictions spread across the world is actually much less too. So you have that buffer pool set aside, and then you can draw on that in the unlikely case that there is a reversal at that scale. I'll leave it there.
Thanks, Chris. Let me go to Phil and then Jason.
Yeah, thanks. Well, in the specific instance of wildfire risk, it's also important to mention that there are things one can do to manage the land in ways that reduce that risk. And the main thing you can do is managing the fine fuels. And of course, one of the drivers of increases in fire risk is climate change, but another is buildup of fine fuels due to historic fire suppression. And so management of the fine fuels, removal of the fine fuels, most efficiently through controlled burning, can really be a very significant lever in reducing fire risk and therefore improving the prospects for permanence and forest offsets.
Thanks, Phil. Jason.
Great. No, just to echo what Chris and folks have said, I mean, I think this is something that has been addressed and continually evolving in both voluntary and compliance markets. For the California approach, there's been very close collaboration with U.S. Forest Service, both utilization of FIA data, but also specific work on remote sensing and looking at risk for wildfire, which is something I know the California Resources Board continues to look at. So that's really done through a buffer pool approach in the California program now. I think it's also important to recognize that some of the projects within the California program are pretty massive. So in particular on the forest space, about half of the offset credits coming from forests are from tribal and Alaska Native Corporation owned lands or managed lands. And these are very large. And I think that buffer pool approach and that risk mitigation is done there. For the context of some of the subnationals that I work with now, similar to Chris mentioned, is really looking at that subnational level approach. So not project by project, but looking at a larger scale. So just a couple thoughts on that.
Thank you. Annie, did you want to come in or?
Just only to say that Christine mentioned the art or architecture for red transactions, which is a multi-year developed scientific standard that addresses also the permanence and buffer pool question.
Well, thanks all. So we'll be able to go a few minutes longer, but we'll try to wrap up by 11:50 or so. So let me take the moderator's prerogative and ask a question of the panel also as a way of wrapping up. We've heard, I think, a lot of individual issues around additionality, data monitoring, transparency, accounting that folks have raised with respect to credit quality. I'm curious to go back to Chair Behnam's original question around the role of the CFTC here. Where would you, given your experience and your perspectives, suggest that regulatory bodies like the CFTC or voluntary efforts like we heard about earlier, the Integrity Council and VCMI, where should they focus? Is it on some of those issues you've raised? Is it on a need for broader or more a unified emissions accounting approaches? Where should CFTC and voluntary efforts focus? And maybe I can use this as a way to go back down the panel in the same order we had. So Jason, I'll start with you, and this will also double as the sort of wrapping up. So if you can keep each of your comments quite short, we'll be able to get to everyone. Thank you. Jason.
Thanks, Nat. Again, thanks everybody for the invitation and for the discussion. Yeah, but I think part of the focus, that's a hard question because it's like, is there one area to focus on? And I think the answer really is no, it's multi-level here. I guess my view is making sure that there's an ability to reduce the confusion that currently exists in the marketplace, both on the voluntary side and on the regulatory side, just how those overlap. I think the accounting side is something that everyone agrees on. This has to be very robust based on the best science possible and with abilities to update as that science improves. I think maybe from a CFTC perspective, looking at how to reduce that confusion, add some certainty for folks that may be in futures or options or on the exchanges. So those would be kind of my parting thoughts.
Thanks. John.
Yeah, I mean, I think it's hard again to pick out one. I think we've discussed the many issues that are on the table, and I think the resolution of them in as expeditious a manner as possible will enable capital to flow in more credible, high-integrity ways, which is important for our shared goals of net zero by mid-century. And so the North Star here needs to be a set of standards and high-integrity principles that guide that transition, not any other. I think it is the case that having transparency around the question of additionality and harmonization around the question of additionality strikes me as being at the core of so much of what we're talking about, which can be talked about through an integrity lens or through many other lenses. But this question of additionality, reaching a clear agreement on use of proceeds that go beyond current use of proceeds, but that we can collectively agree are additional and high integrity, I think is key. And I would urge focus to be put on that question. And I guess finally, I would say the faster we can get there, the deeper the liquidity is likely to be. And we know now that there is capital ready to deploy towards high integrity standards. So I urge this group to continue their work as quickly as possible in the voluntary arena, with the hopes that we will see further formalization in the months and year ahead. Thank you.
Thanks, Sean.
Agree with everything Jason and John said, that the importance of these carbon accounting principles and getting some harmonization and standardization is just going to be critical to folks having confidence in these projects and these markets going forward. I might say two things a little bit more specific to USDA's constituency, and one was brought up by Jason, but making sense of the confusion about the marketplace right now. I've been whether it's listening to it in congressional testimony or being out on a farm, heard the term Wild West thrown around quite a few times with producers trying to make sense of the various options that have been thrown at them by their crop advisor or their conservation district or their ag retailer regarding these new carbon projects. And I don't think we take a position on what's good or what's bad, but there does need to be some, what is this offering and how can this work for an individual farmer, rancher, forest landowner. The second piece I'd mention, and I won't take a position on which entity, whether it be CFTC or the other folks who are on the first panel, but an issue that we think is important and we've centered our work around is diversity of participants who are working in these spaces. We've got a whole host of landowners across different parts of the country who are looking for additional revenue streams, additional economic opportunities. And we think about this marketplace, again, when coupled with steep emissions, direct emissions reductions, we think about this evolving marketplace as an economic opportunity for those landowners who can add an additional revenue stream, who can keep their farms as farms, keep their forests as forests. There's development pressure all over the place, which we all know, and this can be a part of that discussion. But right now, there's a narrative, or at least some evidence, that we're talking about large-scale, significantly sized landowners here, and I think we're looking at our work certainly to involve those folks, but also to involve our smaller holders, our historically underserved producers and communities. So that's really important. And it's not just diversity of producers, it's also diversity of crops and forest types. It's not just the big corn, soybean rotations in the Midwest when we think about the farming side. We want to involve specialty crop producers across the country. We want to involve livestock and ranching. So, just to enter that into the discussion here, we think those are all really important things to be cognizant of. Thanks.
Thanks, Sean. Annie.
Agree very much with John and Sean, and in some respects, from my perspective, carbon accounting and the voluntary carbon markets are in a similar, not exactly analogous, but similar position to the state of accounting prior to the 33 and 34 Acts. We don't have a single set of GAAP, generally accepted accounting principles, in either the in the project space. And for corporates, while there is the greenhouse gas protocol by which many, many corporates report their emissions, that reporting and their commitments define three scopes: Scope 1, direct emissions; Scope 2, indirect emissions; and Scope 3, emissions one layer out from indirect, such as the emissions from travel, which are what come into the Department of Transportation's purview. Everyone's Scope 3 emissions is somebody else's Scope 1 emissions. So the relationship between the emissions accounting at the project level and the emissions accounting at the corporate level is complex. We also don't have a single analog to FASB, the Federal Accounting Standards Board. Do we need one? What are the lessons that you all have learned and that your sister agencies in the financial area have learned from the evolution of GAAP and FASB that could be usefully applied here? Thank you.
Thanks, Annie. Phil.
Thank you. So, well, in OSTP, we're very, very focused on getting better at measuring and monitoring emissions and removals of greenhouse gases to the atmosphere. And we're pretty good at that, doing that on large spatial scales. As I said earlier, when we get down to the finer and finer spatial scales, it becomes more and more challenging. And of course, those fine spatial scales are exactly where the carbon markets operate. So what we're focused on is, in order to improve our capabilities, improving coordination across federal agencies, transitioning a lot of the really, really great measurement capabilities that have been demonstrated in a research mode, transitioning those to operational mode. We're also, of course, very, very interested in making progress on the fundamental science and technology of measuring emissions and removals. And there, as I mentioned, we do see a lot of potential for synergy between the work that we can do in government and some of the really, really good work that's happening in the private sector. So we're again, that's our focus really is on better MMRV, which we think will go a long way towards improving confidence in these markets.
Thanks, Phil. And Chris.
Thanks. I think I would say two different things. We think that when you look at voluntary market initiatives like BCMI, there really is a huge potential value add in focusing on best practices on the use of voluntary carbon credits towards corporate targets. There's a number of key topics related to this that we've talked about: MRV, additionality, baselines. But perhaps one of the most critical issues is transparency. Transparency around corporate climate targets, their emissions, the actions taken to reduce those emissions, transparency around how mitigation outside of a company's operations or supply chain is supported, including through results-based payments, transparency on what carbon credits were sourced and how those were used, and transparency on whether the mitigation associated with those credits is counted towards the NDC of the host country, and whether a corresponding adjustment has been applied in accounting for an NDC. Those are real issues. They're very live right now, and there's great benefit in providing more clarity and more guidance on that. And then as for the regulatory bodies like CFTC, like FTC, in an evolving space like this, we think a critical first step, and one that you've very thankfully brought about, is a conversation exactly like this. We need to be talking. We need to hear what everybody's doing. I think there's two areas where regulators could potentially be very helpful. One is in providing guidance on the transparent disclosure of claims, including in marketing and branding materials. And the second is guidance on how to ensure that credits that underpin listed contracts are real. So those are just two areas. I think more will come in future discussions, but I wanted to leave you with that. And as a final thought, and others have said that, I just wanted to highlight the real urgency of this task. We absolutely have to cut emissions by nearly half this decade. We have to reach net zero around mid-century. We don't have the time to waste. So every tool we can bring to this challenge is absolutely needed. And we thank you for your efforts.
Well, I want to thank the panel, and I'll turn it back to David.
Thank you, Nat. We will now have a 60-minute lunch break, so we'll return at 12:55. Please keep in mind that all visitors will need to pass through building security upon re-entering after lunch. Thank you.
As folks are taking their seats, I'll just start the introductions over here. Well, thank you everybody for coming back despite our fire drill. We're going to begin the third panel in just a moment, which will discuss carbon offsets trading and infrastructure. And it will be moderated by Eric Pitt. Eric works in climate finance with the nonprofit Ceres, also no stranger to the CFTC, where he leads policy advocacy work on climate-aligned investment products and retirement investing. Previously, he worked in the fixed income markets at JP Morgan, where he managed a team of traders, structurers, and analysts who were responsible for providing liquidity in U.S. corporate credit to institutional investors around the world. Eric was responsible for market structure initiatives, including the launch of a new electronic trading platform, which led to serving on the board of TradeWeb. Eric is also an advisor to several fintech and climate tech companies and investment funds. He's spoken on market structure at the SEC, the Fed, and numerous industry events. Eric graduated from Harvard College with a degree in physics and has an MBA from Columbia University. Eric, over to you.
Thanks so much. Oops. There we go. Thanks so much, David, and thank you to the Commission for having us all here. Thank you, Chair Behnam, and all the commissioners. It's a pleasure to be here to discuss this quickly evolving and crucial topic. Ceres is a sustainability nonprofit that has been working with investors and companies to drive change for over 30 years. The Accelerator for Sustainable Capital Markets was founded to promote systems change and works closely with financial regulators, including the Fed, the SEC, and of course the CFTC. Much of the progress we've seen in climate finance in recent years has been due to the work of the special subcommittee initiated by Chair Behnam and led by Bob Litterman. In the time since that report was published, so much has changed in climate finance. The idea of climate change as a significant financial risk has moved from the margin to the mainstream. The SEC has proposed mandatory corporate disclosure of climate risks and greenhouse gas emissions. Just Tuesday, the Net Zero Asset Managers Initiative announced commitment by 83 asset managers, aligning $16 trillion in assets with net zero targets. These are promising signs that government and business are recognizing the scale of the work to be done. Conspicuously absent from any accounting of progress is a federal price on carbon. No other action could have as profound an impact on investment in climate solutions in this country. We have all benefited from the tremendous potential for innovation in the U.S. economy, but until incentives are properly aligned, we're missing opportunities for job and wealth creation. There are important equity issues to be addressed, but address them we must. As we have heard today, other countries and states in our union have enacted carbon prices and market mechanisms with growing portions of the economy covered. We must find the courage to regulate greenhouse gas emissions in this country. Voluntary markets have emerged in the absence of such policy. These markets are a sign of optimism and a cause for hope. There is a precedent for voluntary markets setting the stage for subsequent compliance markets, as we've heard today from the panelists. And we should all applaud the innovation and leadership of the market participants we're hearing from today in helping to stand up these markets. How do we build confidence in these markets? The promise of an offset market lies in its potential to allocate capital flexibly to the best and most efficient carbon sequestration projects. This potential can be realized when risk capital enters the market. Investors will need to be confident in project integrity and market transparency to allocate meaningful capital to these markets. For these reasons, I'm very pleased to see the CFTC become active in this area. I believe the Commission's involvement could play a big role in building the needed confidence in these markets. Before turning it over to our distinguished panelists, I want to share guidance that Ceres recently published in a report on the use of carbon offsets by corporations. First and foremost, as we've heard said by so many today, companies are responsible for reducing their emissions. They should set science-based targets in line with the Paris Accord and focus on reducing their operational emissions, emissions from energy purchasing by purchasing renewable energy, and emissions in their supply chain. They should use offsets only in addition to a concerted effort to decarbonize. These offsets should be of the highest quality, and we've heard so much talk about the different issues driving quality. We urge them to pay attention to the environmental justice issues and ensure that the projects truly contribute to the fight against climate change. Now I'd like to offer our panelists the opportunity to present their comments. And I will start with Kathy Behnam, Managing Director at S&P Global. Thank you.
Thank you. It's a pleasure to be here, and I thank the chairman and the commissioners for establishing this day to get the information out to the marketplace. Registries are a critical aspect of the infrastructure to support this growing market. Our background, just to give some credibility to why we're here today to participate, is we've been 12 years formerly IHS Markit and now S&P Global. We support over 31 environmental programs across carbon, water, and biodiversity. We host both compliance programs and voluntary programs, and a new merging national and sub-jurisdictional programs. So we've supported a lot of countries who've created their first national RED Plus programs. We created the first NDC national registry, and we're supporting the federal government of Canada with all their registry systems. So we've been in it for a bit of time and have learned a lot in 12 years. The key components, what is a registry? I will start with that. It tracks the life cycle of an environmental asset. So what does that mean, and what does it involve? You have to think that registry is composed of three components. One is the technical component, the technology, embodying the security and the rules of the program. Of course, that is key. The next part that is key is the terms and conditions of the registry. How do you operate? What are the rules of the registry? What are people recognizing when they put their assets or trade? What is the what are the conditions of how you're utilizing that software? The next component is the operations of the registry. The key component is your know your customer checks. It is very, very important. And there has been issues early on in the market of the know your customer checks not being done effectively or efficiently. It has to be financial grade type of assessment of companies in order to feel comfortable of knowing your counterparty. What aspects of the registry help support the trust and building trust and confidence in the market? So let me take you through a few components. Today, most of the speakers have talked about transparency. Well, how do registries provide transparency? Almost all registries have a public view, and that allows everyone to go in and look at information on the project. They're able to see all the documentation of that project. What is the plan for the project? What are the different aspects or additional attributes besides carbon that is listed? So it's very important to have that level of transparency for the public. The next component that is really critical is integrity. How do registries help on integrity? Well, a few steps. One is project registration. So every program that was here today represented has a process to make sure that one project is registered only once in their registry, so that they check various aspects of that project to make sure it has been only registered with them once. Additionally, each registry assigns a serial number, a number so that you know the singularity of that credit, and you can track that credit through its life cycle from issuance to transfer and to retirement. That also adds to the integrity. And the first, and as I mentioned, robust KYCs, know your customer checks, are really critical for integrity. So registry helps, and the registries helps people track their assets. They get to see their whole account, and they get to see all their activity, because reporting and having information readily available is a key component of the registry. The final thing, which is looking at all of my colleagues to my right, is that a registry should have access for the participants to liquidity. And that is the API or various types of connections, so that it goes to the exchanges, brokerage firms, clearinghouses, offering services to OTC transactions to have cash and position settlement, all critical components. So that's the core component of the registries. Now, one thing I'd like to bring up is, what is a challenge? What's one of the challenges for growth in these markets? And it was mentioned earlier this morning. Double counting and double claiming, I think, is one of the key components that we have to solve for going forward. Now, we looked at this market, and having been there 12 years, we looked that we needed to, how do you know each registry is checking that that project has only been registered once? But what do you do when you have quite a few voluntary programs and a few national programs starting to issue credits? How do you ensure that things have not been issued in more than one program? So we recently launched a carbon meta registry, and there could be more coming, and there also is effort by the World Bank to do something similar, but at a data level. One of the things that has to be checked is that it doesn't matter what program, a project should be checked against all other projects, from GPS location, from KML files, to make sure that someone has not registered their project in more than one program. The other thing that's really important is double claiming and tracking. This morning we talked about tracking for authorized units based on Article 6, and also tracking corresponding adjustments. So having known this, we have a huge board of advisors of excellent companies, NGO, observers, the World Bank, and many participants. We have sub-jurisdictions plus national programs on our board, advising us the best way to sort of handle when a project comes in that's already been registered with somebody else. So this advisory board is starting to go through what are the rules that should occur. Okay, it could be possible that two projects, one a cook stove and one a red project, could sit in the same location, but you couldn't have two red projects in the same location, or certain types of methodologies can impact the output of the amount of crediting for the other methodology. So these are things that there are people looking at it and working to create the rules to understand that something hasn't been double counted. Really, really important. And when you have that basis, you can go further on to look to expanding the marketplace. We need robust infrastructure, and we need connectivity to exchanges and liquidity providers. We've worked with clients across the globe, and all of them want to have safe, secure, trust and confidence, and they want to have access to liquidity. And that's all I'm going to cover right now. I want my distinguished panelists to go, and then I'm very open for questions later. Thank you.
Thank you so much, Kathy. And now, John Melby will speak, the President and Chief Operating Officer of Expansive.
Thank you, Eric. Thank you, Chairman Behnam and the commissioners here. It's a pleasure to be speaking to you all about the environmental markets. It's something that we've spent our whole entire careers, most of us up here, working on. So it's nice to see it getting to a point where we were able to have these types of discussions. Just as way of background, Expansive is a company that's completely focused on ESG, inclusive commodities. So starting with carbon, but water, renewable energy, digital fuels. And what we are is really a combination of two companies that came together. One was an exchange, a spot exchange for these types of assets. And then the second was a market infrastructure data company. We brought them together to help build out what we felt is the necessary infrastructure for these markets to scale. So if we think about how we think about how commodity markets evolve, they really have evolved historically around physical locations. So you have Chicago with the railroads, you have the North Sea or Cushing, Oklahoma, where the pipeline infrastructure comes together and they become very important parts of those commodities. In the case of digital commodities, which is effectively what happens in the registries that Kathy described, where does that delivery go? So what we've aimed to do is to build out that digital infrastructure that provides the equivalent of that delivery function in those other commodities. So just as a quick picture here of how we see the market coming together and is how we have operated our business. What Kathy described on the carbon offset registry infrastructure is on the left side of that diagram. It includes also the standards that were talked about. The first panel, I think, did a very good job describing how those standards have come together and what they do. The registries are the infrastructure by which they sit on. And then on the far right side is what most of the other folks here on the panel are, is the derivatives exchanges, the professional brokerages. There's also price reporting agencies and all those other types of assets or market participants. What we do is we sit in the middle. We connect, we have a portfolio management tool that connects into the leading registry systems across the globe. And that then connects into a spot exchange that we operate. And that spot exchange then creates sets of products to trade. And then we provide market data out to the marketplace as well as to the various entities on the far right there. These markets have begun to scale in a very meaningful way. So it's kind of sense of context. I want to make sure people are aware that these are markets that have grown and they continue to grow. We had almost 600 million carbon offsets transferred through our system, meaning connecting to various registries last year. So it's a significant amount of activity that's up massively from before. And then on the spot exchange, we had 122 million offsets traded on screen last year. So these are numbers that are growing quite rapidly. And then we saw the development of the external parts of the market. So just kind of a quick view of how we see the markets grow. What's happened is in the early days of these carbon markets, every offset was unique and transfer or traded in a unique way. So basically, you had bespoke products. So you'd have to look at what a vintage was. Was it verified by Vera? Was it verified by ACR or Gold Standard? Is it located in a certain location? And so everything traded as a bespoke product in the marketplace, and that's very difficult to scale, which created a problem for project developers who are looking to get financing and then ultimately to create out a forward curve for transactions and then ultimately to derivatives. It was talked about in the panel before, the development of CORSIA. Expansive worked very closely with a number of airlines during the CORSIA process and has worked with the International Airline Transportation Association to develop an exchange, co-branded exchange on that for the airlines. And in doing so, we realized that there was a need for a set of products that people could transact, that they could have confidence in what they were buying and selling, but yet to group them into some kind of standardized product. So we developed the Global Emission Offset, which referred to as the GEO, which is the first standardized contract that grouped a number of offset types together in the marketplace. So effectively what that is it creates a product where the seller has to deliver an offset, so physically deliver an offset via the registry to the buyer that meets the criteria of that program. And in the case of the GEO, it mirrors very closely to what the CORSIA program is, a little bit narrower in scope. And then that started to develop and began to trade meaningfully, and you can see the volumes as they started to improve. And then CME Group, who's on the panel here, developed a futures contract on top of that, and that certainly helped accelerate and bring focus into the marketplace. And then on the back of that, one of the conversations that was said in the very beginning is the nature-based products versus technology-based products. We developed the NGO product, which is a nature-based global emission offset, and that began to trade and is actually the most commonly traded standardized contract in the carbon offset space. So these markets have continued to grow rapidly. I think all of the folks on the panel would say the same thing. But part of what's happening is we collectively are bringing the market infrastructure that we would know from other commodities, be it energy, agriculture, and the like, and helping scale those markets. And that's what we aim to do, and think that those are important tools to bring to bear. Happy to talk about it or answer any questions later. Thank you.
Thank you very much, John. Next up is Dan Scarborough, co-founder, president, and COO of Incubex.
Thank you to Chairman Behnam and to the Commission, first and foremost, for putting this event together on a topic that has been very close to me for quite some time, virtually my whole career. And really happy to be participating today. Thank you for the invitation. Regulated exchanges have been performing a very key role in environmental markets now for nearly 20 years, dating back to the first such exchange, Chicago Climate Futures Exchange, which I was fortunate to be a part of in 2004, launching the SO2 futures contracts, NOx, compliance carbon in the case of the Regional Greenhouse Gas Initiative, and furthermore, voluntary carbon futures as far back as 2008. So this is a topic that has been around for quite some time. I'll try to keep my remarks brief just so that there's time for question and answer. Happy to field any questions. Quickly on Incubex, we're a specialist environmental product developer that was founded in 2016. Primarily our management team comes from Climate Exchange, Intercontinental Exchange after the acquisition in 2010. Been around in the environmental markets. Some of our colleagues, Dr. Michael Walsh, Nathan Clark, some of the real pioneers, I think, in the voluntary carbon market going back to Chicago Climate Exchange in the late 90s, early 2000s. Incubex primarily is a partnership model. So we have a partnership with leading exchanges, technology companies, really focused on innovation, product development. We partnered with EEX Group in 2017. That was also the year they acquired US-based DCM and Nodal Exchange. And we've been in partnership with Nodal and EEX since 2017, helping them launch really the broadest set of environmental contracts on any exchange in that period of time. We also announced a partnership, a technology partnership with Trayport in November of last year to create what we call the Voluntary Climate Marketplace, which is a OTC bilateral platform for voluntary carbon offsets. couple quick observations and remarks on voluntary carbon. Voluntary carbon markets have been around for 30+ years. In many ways, they've evolved in that period of time, primarily on the back of technology companies and registries really innovating and continuing to provide some of the valuable services that Kathy had mentioned. Just from my perspective, the way that I look at security and kind of validation in the voluntary carbon market, I would look at it much in the same way that you look at IT security, that a layered approach is necessary, having KYC performed at the registries in addition to layered KYC at either trading platforms, regulated exchanges, the normal KYC that companies would go through to trade futures contracts on any regulated exchange, really helps provide some of that layered approach. So you have the registries, you have exchanges really providing a lot of that, really additional security in the marketplace. Common attributes, I think a lot of the participants have really spoke to carbon offsets, the robust third-party verification of these products. I think it's less about, is this a valid offset? Invalidation is very rare in the voluntary offset markets. However, in the eyes of a buyer who's buying a voluntary offset, it's very much a matter of in the eye of the beholder is what I like to say. Everyone has a different opinion on things like additionality, things like permanence. There's a number of offset protocols. If you look at the registries, I think it's a testament to the number really in the cycle of protocols that these things have gone through, version 1 through many versions of protocols that have advanced over the years based on the science, based on new information, and a lot of the registries I think have aligned on many of those things. There really is, for all intents and purposes, from a market perspective, no such thing as a good offset. So that is really up to the opinion of the buyers. And again, that's not speaking to the validity of the issued credit. These are tracked. There are measures in place to account for double counting. But what I think we've started to see, and I think John alluded to it as well, are really some of the compliance markets also providing some guidance on what constitutes a good offset. So CORSIA is a good example. The aviation industry has a program coming online that, for all intents and purposes, is a compliance market for the aviation industry, and now is in a pre-compliance phase that much of the broader voluntary market is now pointing to CORSIA as a standard. You look at things like the California Cap and Trade program under AB 32, that you have offsets that are usable for a portion of the compliance in AB 32, and only a subset of offsets, certain project types within the Climate Action Reserve. There's a process to take a Climate Action Reserve offset and have that certified as a CCO effectively, or a California compliance offset. Just a quick note on Chicago Climate Exchange, just as an example of the voluntary carbon market existing for many years. 2003 to 2010, this was really a compliance market for all intents and purposes, where companies were taking a voluntary but legally binding commitment to reduce their greenhouse gas emissions ahead of any federal mandate to do so. But at the peak of the program, you had over 400 members, approaching 500 members, that really took a voluntary but legally binding commitment to reduce emissions. Significant traded volume, as you can see, 150 million tons were traded in the spot market. And again, this is back in a 2003 to 2010 timeframe, with a weighted average price in the market of $3.26. So as an example, companies trying to really reach a consensus, very significant stakeholder engagement, the scientific community, government agencies that were involved in kind of setting this program, and people getting around the table and agreeing on some of these standards. Again, it's an example of voluntary carbon markets kind of forming a consensus many years ago. This slide really is speaking to what I would call kind of the evolution of the voluntary carbon markets. And still to this day, much of the activity is predicated on a very project-specific level. So you'll have a buyer of an offset that is looking for, in some cases, the individual project ID number. They want a specific project, a certain developer, certain verifier, certain registry, certain vintage. And there are marketplaces that are developed to really facilitate that, as John alluded to, the expansive marketplace, CBL markets, as well as what we formed with Trayport in the voluntary climate marketplace. This is really part of the infrastructure complementing some of the things Kathy was speaking to on the registry side, whereby now you're starting to see some standardized products develop. I think, at least from my perspective, what these standardized products are starting to represent are baskets or portfolios of offsets that point to certain standards or substandards in the market. Something like CORSIA as an aviation industry offsetting contract. That's a standardized product that can be traded in the over-the-counter market, can be traded on OTC platforms, can be traded now on futures exchanges as well. And then ultimately, over time, global standards, global benchmarks that will emerge as well. I think with respect to compliance markets, we're a lot closer to that in the case of the EU ETS, the California cap and trade markets, the regional greenhouse gas initiative that have all been around for 10 to 15 years and advanced in that period of time. In the case of voluntary carbon, we are kind of undertaking that step in the evolutionary process right now. I touched on the voluntary climate marketplace. This is really an over-the-counter bilateral market, a platform developed with Trayport, which we think will bring best-in-class market access, transparency, and a very neutral trading platform that will be open to the community of energy traders on the Trayport system, which is over 6,000 traders at the moment. So this, is a piece in that first kind of piece of the evolutionary cycle of the voluntary offset market.
1 minute, please, Dan.
Just quickly rounding it out, going to the future side of the business and some of these standards that are starting to develop. In partnership with Nodal Exchange, we are in the process of launching some contracts that serve a subset of the voluntary carbon market. So some of these are CORSIA related futures contracts, nature-based contracts, the certified emission reduction market, which have been listed as futures on many other exchanges throughout time as well, but really to provide a portfolio approach to try to bring some of this fragmented, opaque pricing into a regulated setting, bringing that best-in-class market infrastructure to a broader set of the voluntary carbon market. So this is a very near-term launch that is planned for later in June. These are some of the specific contracts, building on the existing contracts that you see there, the California compliance offsets, both the CCO8 and CCO0, and then some of the new contracts that are planned for launch later this month. This is really just illustrating the growth of environmental open interest just on Nodal Exchange generally, but I think if you looked across all the exchanges, you'd see a similar chart where open interest now approaching 3 million contracts across global environmental contracts at ICE, EEX Group, CME Group, some of the major exchanges. So that's really a testament to that 20-year history of the markets. Thank you.
Thank you very much, Dan. Our next speaker will be John Frederick, Chief Financial Officer of Indigo Agriculture. And if I could ask the remaining panelists to try to stick to about 5 minutes, just so we have some time for questions. Thank you very much.
Sure, thank you. Good afternoon, I'm John Frederick, Chief Financial Officer of Indigo Agriculture. It's a pleasure to be here with you today. I'd like to thank Chairman Rostin and the commissioners for inviting us. We're very excited to participate today. I'm not here today to argue the importance of addressing climate change at this point. The 2022 IPCC report really lays that out much better than I could, and the risks are becoming increasingly more complex and difficult to manage, and really compounding the overall risks to us and the planet. But while climate outlook seems difficult at best, I'm convinced that the commodities markets and the CFTC has an important positive role in slowing and reducing greenhouse gases. And that really comes from us doing what we do best, innovating and holding each other accountable. And I'd really like to thank again, and why I'm so grateful for the opportunity to speak with you and to really be with these distinguished panel members today. I think it really brings to the fore what we can do as a financial market to really catalyze the reduction of greenhouse gases. Indigo, as we sit here today, is really on the eve of issuing our first vintage of carbon credits later this month. These credits are measured and reported and verified by Indigo, audited by third parties using Climate Action Reserve's Soil Enrichment Protocol, 141-page, scientifically reviewed and validated protocol. This protocol, along with a similar protocol from Vera, really provides that rigor, that quality that's necessary around measurement, reporting, and verification of carbon credits, which are produced in tandem with that set of physical commodities. The science is robust, and the math behind these measurements are complex for certain, but it's really necessary to accurately, at scale, measure and account for sequestered carbon. To ensure these actions are real, measurable, verified, additional, permanent, and unambiguously owned. Certainly, you heard my distinguished panel member, Kathy, mention really wanting to get at that heart of not getting any double counting into the market and really holding ourselves accountable for that high quality standard. We really believe that in order to ensure the confidence of buyers of these credits, these agriculture-based credits in the market, and make sure that they can feel comfortable and confident when they report their plans to reduce their carbon footprints to the SEC, that high-quality standard really needs to be adhered to. These data assets, these credits, really reflect sustainable agriculture practices like nutrient management, limited no-till, and cover crop practices. It's powered by nature, more specifically photosynthesis, arguably one of the most scalable processes for removing carbon dioxide from the atmosphere and sequestering it in the ground. To frame this opportunity that faces us, think for a moment about an aerial view of farmland. Conventional farming can really leave the soil without crop cover. It could be disturbed through traditional tillage, allowing for the release of greenhouse gases through normal microbial and chemical actions in the soil. And in fact, the USDA was quoted as saying that U.S. falls and winters, according to them, the soil is really, through the fall and winter, is really bare and mostly brown during those time frames. So if you really think about the opportunity that we have, it's really about taking that brown and turning it green. It's about turning it green with vegetation that can unlock nature's natural carbon removal technology, photosynthesis. But as we all know, farming practices aren't free. Cover crops cost money. The equipment to do it costs money. And the farmer is already economically under pressure. They're under pressure from dramatic increases in key input costs, notwithstanding the commodity price increases that we've seen. So this industry, this agricultural industry, really needs an economic stimulant to catalyze action to support environmental sustainability. This is where we all come into the picture, and this is where we become part of the solution. Demand for high-quality agricultural credits is considerable and currently materially exceeding supply. Indigo is partnering with some of the largest agricultural input providers, equipment manufacturers, cooperatives, data aggregators, to try to catalyze and build the supply by helping farmers increase their profitability through sustainable farming practices. So think about this in terms of catalytic finance. We then convert their data from these practices to carbon and other ecosystem credits, which we monetize for them, giving them the predominant amount of proceeds from these credit sales. We sell these credits directly to companies that wish to offset their remaining footprint after reducing as much as they can through reductions in their practices through improved carbon practices. And those companies then retire those credits through the registries. So really, to ensure that these credits have demonstrable value and really to ensure the integrity of the market, rigorous carbon measurement standards. I think we've been talking a great deal about those standards and how these protocols need to be rigorous. That really needs to be our focus. We need to work together in unison, carbon credit issuers and originators, trading platforms, standard setting bodies, and regulators alike to accomplish this important goal of addressing climate change. So I'd like to say thank you again and look forward to a great conversation.
John, thank you. Our next speaker is Evan Ard, the CEO of Evolution Markets.
Great. Thank you, Eric. Appreciate this. Thank you to the chairman and the commissioners for convening today. Very important issue, close to the hearts of everyone here. Just quickly, Evolution Markets, we're a futures and swaps introductory broker regulated by the NFA here in the States, as well as the FCA, the Financial Conduct Authority in the UK. We also have a net zero solutions group, which effectively works with corporates to identify what their carbon footprint is and help them on their journey to net zero, including ultimately taking action, which could be reducing their own internal emissions or buying offsets, purchasing renewable energy, things of that sort. It gives us a broad view of the sustainability space, and particularly a broad view of how we look at the voluntary carbon markets, both from a markets perspective, where our brokers are facilitating trades every day, as well as from on the corporate side and what corporates need and want in order to meet their sustainability objectives, and from the side of the producers, the project developers, and what it takes for them to work through the process to generate the supply of credits that's necessary to meet that corporate demand. I think it's important to, when we talk about the role of the market, to give an idea of the scale and the necessity for the market today. In order to meet the target of climate increase in the global temperature of just 1.5 degrees Celsius, we need to get to a net zero economy by 2050. And obviously we need to cut our emissions in half by 2030. It's not that far off. We're talking 25 billion tons need to get reduced, certainly through efficiency, through the energy transition, through decarbonization of the economy. And as some of the panelists earlier today had mentioned, offsets should come last, but they're an essential part nonetheless. We think there's going to be 15–20% of that 2030 target will come from offsets. We're talking 5 billion tons. That's a 15x size of the market. That's a massive amount of capital that needs to get allocated to these markets over the next, less than a decade. And so the markets are going to play an essential role, not only mobilizing that capital, but also providing the necessary risk management for that capital to be able to be mobilized. And that's essentially the nexus of where we come together today. And you see it on this panel between the OTC marketplaces and the exchanges to my right. And as a broker, we play in the middle of both of those. So just to give you some perspective on how important we think the OTC market is, because I know my exchange colleagues will discuss the role of the exchanges here in the voluntary market. The carbon market is truly an incubator. The ideas for how these products come together typically start among the initial players who are working on finding solutions, mobilizing capital, and a couple of the panelists before me described some progression for products that have made their way to the futures market, including the GEO and NGO futures, which are listed at CME, and the MBT future at ICE as well. The OTC markets also play an important role in innovation and risk management. Much of the risk management that we see today in traditional commodity markets, energy and other more established environmental commodity markets started OTC. We're able to establish liquidity. We're able to put together structures that met the market needs and ultimately progress their way onto the exchange where it was necessary for the true liquidity to be mobilized in order to provide the risk management solutions that the market needs. And in that context, the CFTC is going to play a very important role going forward as the regulator of these markets in ensuring that there's proper oversight and that they operate well, and that there's confidence in these markets. So ultimately, the way to mobilize capital is to ensure that those who are going to be bringing this massive amount, perhaps trillions of dollars of capital to the voluntary carbon market, or to carbon offset markets in general, I should say, that there is a way for them to mitigate the risk that they see inherent in doing the primary financing of these transactions. And that's where the exchanges and the futures contracts come in, and forward contracts, and certainly that's the important role that the CFTC will be playing now with its current contracts, and certainly going forward as additional contracts are created and migrated. And with that, I'll turn it over to the rest of my colleagues. Thank you.
Thanks so much for those remarks, Evan. Our next speaker is Mike Kierstead, Head of Environmental Products at ICE.
Thank you, Eric. Commissioner, Chairman, thank you very much for having us here today. It's great to have a seat at the table. I do believe these carbon markets are going to continue to grow, so these type of conversations are very important to have on an ongoing basis. So I appreciate that. So I thought I'd talk about the agenda and the objectives for my bit here today. So obviously, what is the science behind net zero, the global carbon budget, and how the carbon cycle can add or remove from that budget, how environmental markets, explicitly environmental commodities work to be able to price that and reconcile the science, and then what role do project-based credits play? And the asterisk is there is because we need to be careful with the word voluntary, which I'll get into in a few moments' time. So whether you call it net zero, sustainability, energy transition, or ESG, what's important is going back to the first principles, which is the science. And if the mitigation pathway is to 1.5 degrees, then that's the budget, that's the carbon budget that we have to work with. So as greenhouse gases, are emitted and go into the atmosphere, we need to find ways to pull it out so we truly get to a flat net zero position. And that's where the carbon cycle comes into play and the associated futures products with it. So a good example of carbon going into the atmospheres through transportation or electricity generation, that's CO2 being emitted into the atmosphere. It's also known as a negative externality, which ICE prices through mandated cap and trade carbon allowance products. Then there's the other side, which are positive externalities, which is a nature-based credit, for example, which is pulling carbon out of the atmosphere, or renewable energy credits, which are effectively carbon neutral in that they don't emit any CO2. ICE prices all these contracts through futures, and you can see across the bottom banner there how we do that. So again, carbon allowances would be representative of a negative externality, how we price that. Nature-based solution and renewable energy credits are examples of positive externalities. So project-based credits and the asterisk. So we need to be careful when we talk about calling it a voluntary carbon credit, because if you set a mandate to your constituents, to your shareholders and stakeholders to become net zero, to be sustainable, that's not voluntary anymore. So it's very important that to keep that commitment, that we realize that we're not only are these products important, but it's becoming more of a mandated. If you've made that agreement to your shareholders, then it's something that needs to be you stick to. The taxonomy of where we list the futures credits. So obviously nature-based reduction and removal versus tech-based reduction and removal. The ICE nature-based carbon credit future is in the nature space to begin with. And largely because the technology-based removals, today, there's a very limited supply of those physical credits available to deliver into a physical futures market. Some of the headwinds that we see in this space, which is to the right on my slide. So supply sits with the numerous standards and methodologies. Whether that's registries or standardizations. The issue there is that because there's so many registries, there is no standardization. It's important that as these markets scale, these standards, registries, methodologies become one. So on the monitoring, reporting, and verification, precision, you think of a renewable energy credit, the megawatt hour is generated and minted at the wind farm, at the solar facility, where here there's verification, there's a long lead time, there's a process to get that supply to the market. And continuing with the bottlenecks, manufacturing of a carbon credit, RECs, for example, are minted on a monthly or quarterly basis, where soup to nuts for a carbon offset product can take a while. Standards and registries, market governance, and cybersecurity, obviously very important. What we would like to see is that as these markets become more of a financial asset, that they're treated as such as far as a security and regulation goes. Last, so I want to give a quick buy-side example on who, how, what, and when using a compliance cap and trade program and how precise that is. So who, it's a polluter pay model. It clearly identifies who owns the ton. How, it defines how to calculate, report, and verify that liability. What, it tells you how to compensate by buying a permit to pollute and retiring that. And then when, it tells you when to retire your permits by, whether it's an annual or tri-annual basis. All of these building blocks are currently not inexistent in this space. So it's very important that as we standardize and as this market scales, that we take into considerations lessons learned from the existing mandated cap and trade programs. So with that, thank you very much, and I'll pass it on.
Thank you so much, Mike. And our final speaker is Pete Keevy, Managing Director of Energy and Environmental Products at the CME Group.
Good afternoon. Thank you for the opportunity to present today. So in the interest of time and the topic, I'll limit my presentation to the voluntary carbon market topic for today. So what are our futures contracts? What do they cover? I love Venn diagrams, so here's a Venn that shows you basically what the similarities and differences are between the three futures contracts that we have listed. I won't go into all the attributes, but there's general similarities between the structure of the futures contracts, whether it be on vintage years, registries, what type of projects are in or out of those futures contracts. And in the materials, you can just see what the differences and similarities are, but right in the middle, there's a few things: standardized contract size, how the delivery mechanism, and the settlement through CBL Markets, who is our delivery agent and spot market on this set of futures products. And the registries vary between the futures contracts. The most popular is our nature-based contract, which we've, I think, discussed at length here today. And that's all delivered into the Vera registry, which you heard from earlier on the panels. So just a little more data and detail on the variety of the different contracts. We don't have enough time to really run through all of the intricacies of how the contracts work, but they are listed as standard futures contracts that work very similar to the commodity product set that we're all used to operating under as a regulated marketplace. So here's some stats which you can look over at your leisure. I have the May 30th stats today just to, I want to give like an idea of what the scope of the market is. So to date, this is since we launched our first contract just over a year ago, we've had 111,000 contracts traded. That's about 111 million credits. We have 22,000 roughly open interest between the three contracts. That's 20 million credits in open interest. The majority of those sit in the nature-based contract. About 19,000 of those contracts today sit in the nature-based, which has proven to be the most popular and most liquid contract there today. We have about 80 firms participating or have participated in this contract to date, so it's relatively broad constituents that are interested. We've had 12 successful delivery cycles, and with that we've had over a dozen of our FCMs participating in those deliveries. So it's operating very well under our regulated structure today as a futures market with broad acceptance and participation across our customer groups. So everyone's alluded to the rapid growth of the market, and this, I just read off our most recent stats, but this chart just shows since the launch, it's been a fairly steep rise in activity and in growth and in open interest. So basically, why has this happened? The feedback that we've received from our customer base is that the exchange role is welcome because it adds the three things that every traded commodity market needs, which is liquidity, transparency, and price discovery into the future. So the forward curve is vital, and also the customer intermediation and the credit intermediation aspect of a regulated exchange has been welcomed in getting this market to grow from a very fragmented spot market into a much more centralized, easy to value, easy to observe futures market. So just some view on pricing. So we've kind of haven't spoken too much about pricing here today, so I just wanted to show the charts and give you a feel for the different products. That the Corsia product is our the first one that we launched. That is our GEO contract. We spoke at length about that earlier today. It was the most forward-looking organization that basically laid down the initial standards that were widely accepted by the market. But it's been a relatively there was a period of price increase, but it you know, you can see it there. It hasn't been a parabolic rise. It's been a relatively stable price environment for all of these products. The light blue on top is the nature-based product, and then the other two are the technology-based Corsia and Core Geo products. And that's really all I had. I just wanted to give everyone sort of a feel for how big the futures market is relative, and put some actual numbers: 20 million credits of open interest and 110 million of volume since we have launched, and just get a feel for how big the futures market is relative to some of the explanations of the size of the market today. Thank you.
Thanks so much, Pete. I'm going to kick it off with a question for the panelists, and then we'll turn to the audience. What is the role of speculation in this market, or other financial players who are not themselves project developers or companies looking to retire these credits? And has there been an evolution recently in terms of the types of market participants that you all are seeing? And for those financial market participants, is that largely in a sort of intermediating and sort of like quicker holds type of activity, or is that a long-term view of people building up an inventory, you know, a buy and hold type of program? So whoever would like to take that.
Eric, maybe I can start. Because we see, you know, spanning both the exchanges and, you know, the OTC market, I think we have a pretty, you know, fair sense of who the different counterparties are. There is a fair amount of what you might call speculative interest, or financial interest is probably the better way to put it. I think the way the market sits now, a lot of those early players who, some of them to be sure, are taking on their own climate targets, and they are, you know, using their own offsets that they're creating, but they're creating much more than they actually need, or that their customers need, or their supply chains need, and therefore playing an important part of mobilizing capital towards, you know, developing new projects that can be available for the corporates that are out there. They have expertise left over from the previous carbon market under the clean development mechanism that they're leveraging today. In some cases, they have actual projects that they've kept going, you know, in the interim period between carbon 1.0 and where we are carbon 2.0. But the most important thing that they do now is they provide that liquidity. They're a warehouse of these credits, and they also can provide an important innovation in terms of the products that are created in order to, you know, in terms of, you know, buying and selling of the credits themselves, as well as bringing capital into new projects. So that's the role that we see today.
Does anybody have a different perspective to add there?
I just add to the liquidity standpoint where to bridge the gap between a bid on and an offer, and, you know, Pete mentioned as one of the three pillars of an exchange is liquidity. Financial intermediators do need to be in that space to provide that liquidity and really offer the ability to scale the market.
Great, thanks so much. Are there questions from the audience, from the room? Tyson?
Thank you very much. And again, really interesting panel. So my question is about the products that are offered in the futures market. So it's my understanding that the exchanges rely upon the registries for offset verification, and then the registries have these protocols, some of which are scientifically peer-reviewed, as you've said, to ensure that the procedures for the offset are sound. Where does enforcement of those protocols fit in with that? So who is making sure that the forest manager or the farmer or the renewable project developer is doing what they said they would do in the proposal?
If it's okay, I'll go ahead and take that first. I think from our perspective, we see third parties working with the registries and working with the project developers, and really in kind of an audit fashion. As a company and as an issuer of these credits, we also have a responsibility for permanence and continued monitoring. So for us, it's really an ongoing 100-year obligation to continue to track and make sure that those practices continue, at least in an agricultural context. So it's really the audit function that's associated with the registry by the third party who's doing it on behalf of the registry would be our point of view.
Anybody else on that?
Yeah, just quickly to add to that, I think, as I mentioned before, I think the layered approach to security, integrity in the market is key. And third-party verification has been something that's been a part of the voluntary carbon market for quite some time. These verifiers are working in accordance with the rules and principles, the protocols that have been developed by the registries. But these are independent verification companies that are going about and doing this verification. So, I think that separation of duty, kind of having multiple stakeholders involved in that process and the creation of offsets is key.
If I could add as well, there's also there's a lot of standards out there, as people have said before, but these products are trading on the standards that are seen to be of the highest quality. So the market really does care. So when someone's going to buy a product to offset their emissions, they want to make sure that they're buying something that is going to stand up. So you have Vera, ACR, Climate Action Reserve that were on earlier today that have spent decade more building up integrity trust systems. Then you have the registry providers, S&P, APX, and that also do KYC, all the processes that help create that robust infrastructure. And then the futures exchanges and other entities that have infrastructure that are required. Ultimately, these are products that are being bought for a purpose to address an environmental problem. And any company that's going out and spending money to do that wants to make sure that what they buy is going to be trusted. And so what you'll see is the market values, and you can see the pricing shows this too, values those higher quality offset providers or those that have a reputation of being very, very rigid. So that's a key component of this, how these markets have evolved.
And just to add, just for clarification of terminology, so the group that spoke this morning are the standards bodies. They set the methodology with stakeholder engagement. They set the protocols. The registry infrastructure can either be run by these standards or they could be provided by a third-party provider like we do. So we check, we agree protocols with the standards body to double check. But the setting of the protocols and the methodologies are the standards bodies. And then the registry administration component might be validating that all the documentation has come in as expected, that there's an independent verification report before issuance. There's a step, there's a process and a checklist to make sure everything is there before you issue a credit. So just for clarification.
Nat, did you have a question?
Yeah, thanks very much. I just wanted to pick up on one of the themes I think we heard from the morning panels. I think we heard a number of folks in each panel talking about the existence of some confusion or uneven quality now in the marketplace and the value of having standardization or harmonization around quality to build on what the standards organizations are doing, but also to maybe create some greater clarity in that. We heard that on the voluntary side, the Integrity Council, and we heard some discussion of that in the second panel as well. And I'm just curious for thoughts from this panel. I hear a few different things. I hear some of you talking about the importance of quality in the marketplace, and I hear others saying it's all in the eye of the beholder, and so there's a variety of that. I'm curious about how, whether there's a need for greater consistency or harmonization around quality, and what the impact would be perhaps on liquidity and the volumes in the marketplaces that you all oversee. Thanks.
I'm happy to take a stab at that. I think the Corsia is the example that was brought up earlier, helped organize buying, made it easier for people to companies to decide what they should buy. As I described it early when I presented the beginning opening remarks, the way the voluntary carbon market has traded historically is a single project by project basis. So you can imagine if you're a corporation and you're trying to meet your commitments, and the first thing you have to do is figure out, well, what's a quality offset? And it's confusing. The comment earlier was said it was confusing. So Corsia helped the airlines sort that out through a very rigorous process. And a lot of corporations then said, well, that's seems to be a good way to start. So the Corsia eligible, and then there was the NG, the nature-based approaches that all of us have worked on. I think the most important thing that could be done is to have it be clear for companies on what they could buy and to meet certain requirements. That doesn't mean that they all have to be the exact same offset type, because there's plenty of reasons for different types of offsets, but to have sort of a set of clarity for when the company buys that offset, that they're not going to have to later on be worry about greenwashing or something not being valid or whatever, all those types of things. So that clarity will provide a mechanism for these markets to scale, will provide liquidity, and most importantly, to address what Evan brought up, will provide capital that will enable us to create that many projects globally.
And can we also just, from a futures perspective, we're trying to create a benchmark, and benchmarks don't necessarily meet every single need for every single consumer in the market. It's a benchmark, right, that credits can be measured against. So we have the standards that have been set down by the registries. CBOW Markets manages a spot market that has a variety of different projects at different valuations and different qualifications. But when we're trying to build liquidity and price discovery in a market, you need to work against a common standard that may not meet everyone's needs, but it can certainly form a price discovery mechanism, a benchmark for you to value quality and value price on a relative basis if your needs happen to be different. And that's true for every commodity market, not just voluntary carbon markets. And that's why people are happy to take delivery today, even though it's a seller's the seller has the decision about which credits to deliver. People are willingly taking delivery today. So the market is functioning very well in a regulated environment today in the futures market. And then the other concerns can be dealt with either outside of that regulated world in the spot market, or consensus can build and liquidity can build around a certain set of parameters that exist today.
Yeah, just quickly, I would agree with what Pete said, and we have corporate clients who they're out on a limit to a certain extent. There's not clear standards in terms of what they should buy and, as a carbon offset, and what they shouldn't buy. They're concerned about their corporate reputation, as they should be, and they're taking on, but we also applaud their courage in being out front and doing something about the climate, because we need to do something now in order to really meet the targets going down the line. And so I think there's a certain amount of reliance on the existing systems, not only just the marketplaces that are here around, on my panel, but the registries from before, and leaning into that current infrastructure as the attitudes of the market shift around what's high quality and not high quality, is a difficult place to play. But I think it's some corporations have taken upon themselves to get out there anyway, and I think that should be applauded. And then to the question on how that impacts liquidity, I think Pete answered that quite well. Is like liquidity will come where people coalesce around those ideas of quality and therefore need to hedge or use the futures markets to buy supply.
Yeah, I think adding to that, it feels to me that if we really want to drive efficiency into the market, harmonization of some of the registry standards could be beneficial, while we acknowledge that there can be some differences and there could be differential pricing for some of those differences. The attributes around quality are relatively immutable. We touched on some of them. They have to be additional. These things that we're doing permanent, unambiguously owned, free of leakage, and really doing no harm. I think those attributes end up being immutable and something that if an issuer, an SEC registrant who wants to buy these credits are really going to have to feel very comfortable that there's something real behind this, and those harmonized standards and those quality attributes are going to be quite important to building faith and trust in the market.
Thanks so much. I think we're at time. So I just want to thank the panelists, all of you, for your comments today. I'm sorry we don't have more time. I have a bunch more questions I'd love to hear the answers to, and I'm sure others do as well. But that'll bring a close to this panel. I want to thank David Gillers and Abigail Knopf for all the great work in bringing this together. And again, thanks to the commissioners and the chair for having us here today. Back to you.
Thank you, Eric. We are going to turn now to our fourth panel, which we've divided into two parts to accommodate all of the market participant viewpoints that we'll hear from here today. Dr. Janet Peace will moderate the first part of the panel. And as I'm introducing, we're going to do a little switcheroo here. So folks that are on the fourth panel in either parts 1 or 2, please feel free to take a seat back at the panel tables. So Dr. Peace is the Chief of Advisory Services at Blue Source LLC, where she provides strategic advice to companies, NGOs, and policymakers on market-based climate policy, options for reducing greenhouse gas emissions, and the use of environmental credit markets. For 15 years prior to Blue Source, she was part of the leadership team at the Pew Center on Global Climate Change and helped launch its successor, the Center on Climate and Energy Solutions. At Pew and C2ES, Janet led the work on market-based policies, including carbon pricing and the use of carbon offsets, engagement with the corporate community, climate disclosure, corporate sustainability, climate resilience, and carbon capture, use, and storage. Dr. Peace is on the board of the Climate Registry and the Pricing Carbon Initiative, as well as the advisory board for the American University Center for Environmental Policy. Dr. Peace holds a PhD and Master of Science in Economics and an undergraduate degree in Geology. Dr. Peace, I'm going to turn it over to you.
Thank you, Abigail. I appreciate the introduction, the invitation to this session, and I want to thank the commissioners, as everyone has in every other panel, about holding this particular roundtable and your interest in this topic. We all appreciate it. So, a little bit about the company that I joined a few years ago, Blue Source. It's been around 20 plus years. It's probably one of the most established project development companies in North America. We obviously develop carbon offsets. We work with the clients, helping them understand what these markets look like, how they should be moving forward. And in February, just recently, we announced that we were merging with another well-known company, Element Markets. And all of this will be under the banner of TPG Rise Fund, chaired by Hank Paulson. If you don't know about the TPG Rise Fund, It is the largest climate impact fund in the world. So largest impact fund, pretty cool. Pretty cool to be associated with that. And our merger with Element will make us one of, if not the largest company devoted exclusively to the purpose of protecting the environment and accelerating action on climate change. So the necessity and the demand for readily available solutions to address climate change, as we've heard all day, is really accelerating at an unprecedented pace. And the renewed focus on ESG in the corporate community is pretty exciting, and that's been part of it. But I'd say the real driver has been this commitment to net zero. Companies, universities, cities, states, governments. I mean, I've been in this market a long time, and it is so exciting to see the power of a price on carbon really drive action. Market-based environmental credits can provide an opportunity, as we've heard over and over again, for private capital to invest in projects that are beneficial to the climate, like conservation, like regenerative agriculture, and other types of industrial emission reduction projects. So a couple things that I think are important to talk about in terms of misperceptions. And one you've heard about over the day, which is that this, if you want to know what the wild, wild west in carbon markets look like, you should have looked at it 20 years ago. Because 20 years ago, I would say, yeah, this was a wild, wild west. And today, you've heard about the registries setting the standards. You've heard about how verifiers go in and check to make sure that the numbers and the projects are what they say they are. And we heard about the tracking to ensure that there's not double use of a credit. But there are, what did somebody call it? Carbon cowboys? Maybe let's say carbon cowgirls too. There are folks out there that are experimenting, and that's what this market is supposed to do. It's supposed to incentivize innovation. So there are companies and individuals out there who are trying to do new things, and that's very exciting. But some of them are not using a methodology that was created by a third party. They're creating their own projects. They're not having a third party verify, and they're not having a registry track those reductions. So some of that is, I think, causing some confusion among buyers. It's hard to know. But I think when you look at the registries and the history of the development of the registries and the improvements over time, I think those have been a sign of maturity, if you will. Another thing that I think is a kind of a misperception, and I should have, I'm an economist, so I think about it from this perspective, that when a company buys offsets from a company like Blue Source, that's money out the door. And I haven't met a company yet that doesn't try to minimize costs, especially if they think about these costs going up in the future. So the fact that they're spending money out the door gives them a direct incentive to try to reduce that cost by mitigating emissions, by innovating in new technology. And there was a good report that Ecosystem Marketplace put out a few years ago where they looked at companies that actually buy offsets, and they found that companies that buy offsets actually do more mitigation than companies that don't. I think that is pretty darn interesting. So those are a couple little, I guess, insights that I thought I'd share. And now let's go ahead and get started with our panel. This and the next panel are going to be market participants, basically. And so you're going to hear challenges and opportunities. You're going to hear about derivatives. And hopefully by the end, we can talk about what recommendations for the role of CFTC in these markets. So our first speaker is Mark Kenber. He's going to be virtual. And there he is. Hey, Mark. So Mark is a co-executive director, external affairs for the Voluntary Carbon Markets Integrity Initiative, VCMI. He's also the managing director at the environmental consultancy Climate Advisors. Mark, do you want to give a few opening remarks?
Yeah, thank you very much, Janet, and thank you all for inviting me here today. I'm sitting here in the south of the United Kingdom, where, as you may be aware, we're celebrating 70 years of the Queen's being on the throne. So that's why I'm wearing a tie and looking very festive. So as Janet mentioned, I have two roles or several roles in voluntary carbon markets. One, I am the co-executive director of the Voluntary Carbon Market Integrity Initiative, which I will speak to mostly in this initial presentation, but I'm also a board member of the Integrity Council of the Voluntary Carbon Market, and you've heard from many of my colleagues throughout today, and a board member of Vera, one of the standards who you've also heard from today. So I think a lot of the discussion that I've heard, and I've dipped in and out of today's meeting, has focused on the supply side of the market, the quality of credits, transactions, transparency in the credits, and not so much on either the whole system governance or in particular the demand side. I'll touch briefly on the whole system governance aspects of it, which I think are very important to bear in mind. Voluntary carbon markets, or carbon markets generally, exist to serve a public purpose, to accelerate emissions reductions and removals, and to generate additional finance, particularly to developing countries where carbon reduction and removals take place. And so therefore it's essential that we assess and measure whether the market is serving that public purpose. It's obviously important to make sure that transactions are carried out honestly, that they're verified, and all the other things that people have discussed. But often we can get down into that and forget the big picture of the market as a whole. So a couple of 2 or 3 quick recommendations on how we look at the market. We should be looking at the market and what's needed. One is we need to have transparency on every aspect of every transaction and every project and credit that is delivered into the market in as real time as possible, both so that we can carry out the assessment that I've just mentioned on whether the market is serving its public purpose or not. And we can only do that if we really know that the market is driving additional emissions reductions removals, that's to say above and beyond policy requirements, above and beyond commitments and obligations to decarbonisation by corporates, and that the finance that's generated through carbon markets is again above and beyond existing sources of flows of public finance and private finance. This market needs to be additional, and we need to have the transparency across the market to be able to judge that is indeed the case. We also need transparency, and I'll come back to this in a moment, to assess the use of carbon credits at the end on the demand side. And as I mentioned, in the context of the VCMI, I will mention a bit more about that. We also need to look at, as part of whole system governance, the participation of all sectors in the market. Now, at the project level, most of the standards have very good and well applied rules and procedures for ensuring the participation of affected local communities, setting up benefit sharing systems, ensuring that really all stakeholders are engaged in both the design and implementation of projects. But the markets themselves are designed by people like us, not the people who are necessarily involved in the projects directly or affected by the projects or have projects on their land or in their communities. And we need to make sure that the market is designed from the outset and reformed, bearing those people in mind, and that those views and those stakeholders are part of the market design and governance process. And that's not only because it's the right thing to do. It seems to me axiomatic that we would expect all stakeholders to be involved, but because if we want the market to grow built on trust and integrity, then we need to reflect those opinions, those stakeholders' views and their needs from the outset, not just once we've got down to the project design and implementation level. And thirdly, we need to think about the governance of carbon markets in the broader context, and some have mentioned this already earlier today, of other markets and other actions. So climate policy, finance policy, energy policy, corporate disclosure requirements, a whole bunch of regulations, policies and actions that are taking place outside the strict confines of carbon markets and voluntary carbon markets in particular, but which are clearly affected by them and in turn affect them. And we've seen this recently with the recent outputs from the SEC, which talks about the use of carbon credits. But how the market develops needs to take into account those developments, and those developments, again, need to take into account the market. Mention the issue of transparency. One of the issues that is perhaps has been neglected to a certain extent till recently is the demand side of the market. And that's to say, what criteria should judge what credible use of carbon credits looks like and what claims can be made about it. Now, all of you in the room and on the line will have seen the multiple claims that companies and other organizations make about their carbon and climate commitments and their use of carbon credits. We have climate neutral, emissions neutral, GHG neutral, climate neutral, carbon neutral, net zero aligned, climate positive. I could go on for a long time. Very rarely do those things mean the same thing. And it's often very difficult to actually find out what they do mean. In the very small print in corporate sustainability or other reports, you have to really dig in to find the criteria that have been followed to make those kind of claims. And often, much of the information is not available. So if, as investors, the general public, but in particular consumers who are increasingly making purchasing decisions based on environmental attributes of the companies they're buying from, and in particular, the climate claims that they make, it seems to me essential that there is harmonization, consistency, and most importantly, honesty and transparency in what those claims are. And that, as I mentioned at the very beginning, that the use of carbon credits is in addition to and not instead of decarbonization of value chains. And for that reason, the Voluntary Carbon Market Integrity Initiative next Tuesday will be launching a provisional code of practice to answer those two specific questions. When and under what circumstances should companies be making use of carbon credits? And second, what are the claims they should be making about them? And I'm obviously not allowed to give away all the secrets that are in the report, but I think it's fair for me to say that there are 4 broad elements of it, which I'll go through very quickly. One is a set of prerequisites. What is basic corporate good practice in dealing with climate change? It means having a long-term net zero commitment. It means having short-term interim targets that are consistent with meeting that global net zero goal that we all signed up to in the Paris Agreement. It means providing transparent inventories. It means making that your public policy advocacy and engagement is consistent with those internal corporate commitments and those public commitments to net zero by mid-century. A set of prerequisites which ensure that use of carbon credits follows the widely accepted mitigation hierarchy of setting targets and reducing emissions first. Second section will be on the claims themselves, and they combine both ensuring that companies are on track to meet their interim targets that they've set that should be aligned with science and meeting net zero by mid-century, and the use of high-quality carbon credits to compensate their remaining emissions at any given time. And there is a hierarchy of claims that if you look out on Tuesday, you will see how those are scheduled, with the idea being to incentivize progression up the hierarchy. Third, we talk about the credits themselves, and I'm sure we'll be delighted to say that we are not trying to create another standard. We're not trying to replicate or duplicate the work of the ICVCM, Corsair and others, and we very clearly point to those 2 initiatives in particular, as well as some other buyer beware criteria to ensure that when companies are buying credits, they are getting what it says on the tin, and they're getting the quality that they demand. And then finally, the 4th section will be on transparent reporting of both the corporate decarbonization, which is often done through other initiatives, and the credits that have been used. And I return to my initial point to finish. The issue of transparency is absolutely essential here, not only because of the public purpose of the market that I mentioned at the beginning, but if the market is to grow, it needs to be based on trust. And trust can only be earned if we are able to scrutinize what companies are saying, what project developers are doing, where the benefits are arising and where they're being shared. Only then will the public believe that corporate claims based on their own decarbonization and use of carbon credits are valid, are acceptable, and are real. And I think if that's a recommendation I would make, if I was to make one recommendation to you all today, is to focus on transparency, because that will give us and the broader world the confidence to trust in carbon credits and the use that's made of them. So Janet, I think I'll leave it there, but happy to answer any questions later.
Thanks, Mark, and we'll come back with questions after everybody has a chance to give opening remarks. Our next speaker will be Bella Rosenberg, Senior Counsel, Head of Regulatory and Legal Practice Group, International Swaps and Derivatives Association, ISDA.
Oh, sorry. Thank you, Janet. Hello, everyone. Thank you to the chairman and the commissioners for organizing this important discussion, and I'm extremely pleased to be here today. I'm going to start by underscoring the importance of voluntary carbon markets. We are gathered around this table today because the market demand for voluntary carbon credits, or VCCs, is growing, both in the United States and on a global scale. It is important to recognize that the voluntary carbon market, in its essence, is a market-driven solution to climate change. It is clear that market participants recognize the urgency to reduce, remove, or avoid greenhouse gases. And those market participants that have the ability to generate VCCs are doing so not driven by a regulatory incentive or requirement, but by a desire to contribute toward the global fight against climate change. So those generating VCCs are able to sell credits to other firms or companies that want to contribute in this effort, but don't yet have the technological capabilities to reduce or avoid greenhouse gas emissions efficiently. So I think we've established here we do have the demand, but the next question is, where do we go from there? How do we make these markets liquid, transparent, and resilient? And I think this is why the CFTC has gathered this convening to get this information from the market participants. In our view, to achieve this goal, we believe that we should focus as a community, both private sector and public sector, on three key areas. The first one is developing a strong legal foundation for the treatment of voluntary carbon credits, or VCCs, across jurisdiction. The second area is providing regulatory clarity on the treatment of financial instruments tied to VCCs. And the third one, establishing good governance throughout the market value chain. Importantly, ISDA is actively involved in the work of each of these areas, and I would like to spend a few minutes on each of these areas. So the first one, developing a strong legal foundation for the treatment of VCCs across jurisdiction. It is important to establish the legal nature of voluntary carbon credits, which will determine how a VCC can be created, transferred, and retired. It affects what type of security may be taken and enforced in relation to VCCs and how that can be achieved, as well as how VCCs would be treated following an insolvency, including with regards to netting. And I would like to spend just a minute on this issue because it is very important for market participants, but it's also very important for ISDA. As you may know, ISDA stands ready to work on to create documents for the secondary market that will include spot, options, and forwards contract. In order to create global standardized documents, it's very important that the VCCs that are going to be referenced in the document are of sound legal nature, and they are treated consistently across jurisdictions. And what I mean by that, last year we published a paper that analyzed how VCCs are treated in different jurisdictions. And what we found out that some jurisdictions views VCCs as a bunch of contractual rights. So if you have a bunch of contractual rights, you have to look at how these credits are going to be created, transferred, and retired from the contracts law perspective. I don't want to be too legal here, but the question becomes, if I transfer my credit, will clawback provisions apply? And in addition, how would security interest work if you have a bunch of contractual rights? Other jurisdictions, for example, under the English law, they view them as intangible property, and we believe that's how VCCs should be treated. But even then, as I mentioned before, the issues of creation, transfer, retirement retirement of credits under property law arise as well. So if different jurisdictions have kind of different views on property law, that creates an issue. So now you can imagine that it would be quite challenging for us to create consistent global documentation if different jurisdictions have different approaches to VCCs. So we hope that there will be a point where either through legislative amendments or some sort of announcement from different jurisdictions, there will be a decision to have a consistent treatment of VCCs. The good news here in the United States, at least for purposes of bankruptcy law, since VCCs are considered commodities, it is quite clear that, because they're commodities, VCCs will enjoy the safe harbors of the bankruptcy code. So a non-debtor can enjoy safe harbors, including the set-off rights, so meaning netting. And this is this is an important issue that I think, market participants should focus on. So as I noted, in order to optimize the enormous potential that a global voluntary carbon markets can offer, we need to work towards creating a strong legal foundation for VCCs across jurisdiction and not just in the United States. So the second area is providing regulatory clarity on the treatment of financial instruments tied to VCCs. First and foremost, it's very important that the CFTC's recent confirmation that VCCs are commodities is important, as this market sometimes is perceived to be unregulated and lacking standards with no ability to prevent greenwashing. Since VCCs are commodities, the Commission has the authority to go after the participants who engage in fraud and manipulation in the spot market. If we want to make these markets flourish, there can be no room for greenwashing or double counting of credits. In other words, there should be no room for fraud. Today, earlier this morning, ISDA published a paper that examines various derivatives products that reference VCCs. And the goal, again, I want to spend a little bit more time on the issue of regulatory clarity, because I think it's very important for this market. There is a lot of discussion as to, how voluntary carbon market is unregulated, and, there are different violative behaviors take place, conduct. But I think it's important to sit back and take a stock of what authority the Commission has in order to sort of create order in this market. And I think this paper, answers this question in a little bit. It goes through describes different contracts that the CFTC has authority of. Clearly, the CFTC has authority over derivatives contracts. So if you have, for example, if you have a VCC swap that is financially settled, is going to be within the CFTC jurisdiction. And granted that we don't have a lot of swaps that are financially settled, but there are some. And if they are, then they will be subject to reporting rules, record-keeping rules, margin rules, you name it, all, the whole gamut of the, post-Dodd-Frank regulation. But most importantly, that we should focus is on VCC futures contracts. The CFTC has exclusive jurisdiction over these contracts. And because the VCCs or voluntary carbon credits are commodities, the CFTC has special interest in commodity futures contract when they're physically delivered and settled. And historically, the former CFTC official and current CFTC officials did say, noted the importance of delivery points in the context of commodity futures contracts. And they specifically said it's important, to prevent fraud and manipulation. It's important that these delivery points have rules and governance standards that describe how transfer and delivery of commodities take place, so it should be free of fraud and manipulation. So if you extrapolate this logic to VCC futures that are commodity futures contracts, one can say that the CFTC, in combination with SROs, self-regulatory organizations and exchanges, have authority to some extent to sort of conduct due diligence over some registries because they are delivery points for VCC futures contracts. And by no means I want to challenge the work of the registries, but what I want to say is that I think if there is some due diligence done in combination, can be the CFTC or SROs or both, I think it gives market participants that extra confidence that there is governance in place, that there is a governance in place that will minimize unethical or prohibitive conduct, that there are procedures in place that will describe how these credits are transferred and retired. So there's a sense of security from the market participant perspective that they are using good, reliable carbon credits. And the last area that I think it's important to focus on is establishing good governance throughout the market value chain. And ISDA is actively involved in the work of the Integrity Council for Voluntary Carbon Markets, ICVCM, which was convened last year and is responsible for developing a blueprint for this market. We support the work of ICVCM and join in their commitment to set and enforce definitive global threshold standards, drawing on the best expertise available in order to ensure high-quality VCCs. And again, the work of ICVCM is very important for us as an organization that is going to be drafting documentation, standard documentation for voluntary carbon markets. It's important for us to include reference carbon credits that are of the highest standards and quality. So I'm going to stop here, and I'll be happy to take any questions later on. And thank you for your time, and I look forward to the continued discussion.
Thanks, Bella. And for the rest of our speakers, we need to shorten down a little bit just so that we make sure everybody has enough time and that we have maybe a few minutes at the end for questions. I think we've had some really good comments so far. Our next speaker is Linda French. She's the Executive Director of the ESG Policy and Regulations, Sustainability and Global Government Relations at JP Morgan Chase & Company.
Great, thanks, Janet. And thank you to the Commission for having us here today. So I'll just start off with framing up how JP Morgan participates in the voluntary carbon markets, and then move to making kind of 3 high-level observations on what we're seeing as the voluntary carbon markets are continuing to develop. So how JP Morgan participates: we're a buyer of offsets. We have an ongoing commitment to maintaining carbon neutrality for our operational carbon footprint. And to meet this commitment, we first prioritize improving energy efficiency and sourcing renewable energy, and then purchase high-quality carbon removal offsets to address any emissions that we're not yet able to eliminate. And I think it's important to reiterate here that, as we've heard from others, I mean, our view also is that offsets are not a substitute for decarbonization. We're using offsets as part of a broader strategy where we have targets, publicly disclosed targets, to reduce our operational emissions year over year, and only then are we using high-quality carbon removal offsets to address the remaining unavoidable emissions. And so our observations today are going to be kind of from that perspective as a buyer, but in addition to acting as a buyer, various parts of the firm also participate in voluntary carbon markets in different capacities. So investing, new fund structures, and providing finance and advice to clients. And then we also expect to start trading voluntary carbon markets products later this year, with reviews and due diligence ongoing. So 3 high-level observations. First, as we've heard from many others today, market development of standards for different tiers, different types of offsets is going to be essential for scaling voluntary carbon markets. As a market participant, we have a very strong interest in scaling voluntary carbon markets for high-quality offsets that have a concrete environmental impact. We currently do extensive due diligence against a stringent set of criteria that we use to assess the quality of carbon credits, and those criteria inform not only our evaluation of the credits that we purchase for our own business, but also guide our overall perspective on how the carbon markets should evolve to help meet global decarbonization goals. Second observation is that we're seeing the market work through a number of challenges as it's continuing to develop, but overall we're pleased to see the progress that the market is making. And many of these challenges are oriented around the standardization that needs to happen to achieve scale, while also maintaining credibility and integrity and a focus on quality. A lot of market participants have been slow to enter exchange-traded carbon markets because we don't yet have definitive standards for different tiers or types of offsets. And there's currently like a gap between the offsets represented by standardized standardized contracts versus the character of the underlying demand from firms that are buying offsets for their own use, like JP Morgan. Although that is something that, we expect that to change as the market kind of grows and develops further, and happy to get into more detail on the panel discussion on some of the challenges that we're seeing. Last I guess to continue on that, overall, we think the market is headed in the right direction toward convergence and consensus on standards, and the fundamentals of the market are robust. There's not a concentration of buyers or sellers. You have a lot of diverse views and biases and objectives, which is a great foundation for a market. And there's also a robust and growing ecosystem of service providers that are competing to provide a better service to developers in the broader market. And I think a number of us today have mentioned the task force on scaling voluntary carbon markets, which has done a great job of identifying the structural kind of issues here, and then that important work being taken forward by the Integrity Council for the voluntary carbon markets. And we're seeing strong market support and anticipation for the forthcoming core carbon principles. And more broadly, just a huge amount of interest from the market and capital flowing in. So all the pieces are there. We're in a phase now where the market's continuing to work out a lot of those structural issues, and we're seeing progress. So last observation is that this market is fundamentally global, and international coordination is going to be incredibly important to avoid regulatory fragmentation that would inhibit scaling of voluntary carbon markets. We're not just seeing interest in the US, we're seeing broader global interest in scaling voluntary carbon markets from London to Singapore to Hong Kong, among others. And the global nature of the market is fundamental to the product itself. So there's a real risk here that uncoordinated regulatory efforts will increase fragmentation and actually inhibit the scaling that needs to happen. And we think that the CFTC has an important role to play in leading globally to ensure that there is that effective interface with other markets, with other regions, with other regulators, so that there's kind of seamless oversight over a globally fragmented market.
Thanks so much, Linda. Our next speaker, Iivu Kearney, we bring her up there, Assistant General Counsel with Neuberger Berman, a private asset management firm.
Hi, everyone. I thought my name might be a struggle, so it's Aoife. I'm Aoife.
That's much better. Thank you.
These Irish names, they're tricky for non-Irish people to pronounce. So firstly, I'd like to say thank you very much to the Commission for hosting this event on this expanding and exciting sector. I've really enjoyed listening to the other panels, and it's really heartening to see such a huge level of interest, and also lots of convergence between the speakers in terms of their views on what the path forward is. So it's really great to be involved in this conversation, and thank you for the invitation to participate. In terms of kind of what I'd like to see done, or how I see the market developing, I know that there has been a huge development in the market, and how it's becoming more standardized than perhaps it was, Janet, as you referred to 20 years ago. But I would also kind of think as well of, let's say, Mary referred to carbon cowboys, and Sean was speaking about the Wild West. So I think it's fair to say that there's some room for improvement or work to be done on building market participants' trust in carbon offsets. And when I think of that, I think of what do we need to do to make sure that those trust levels are where they need to be, and I should have prefaced that by saying that there's been a huge amount of work done by the private sector, which needs to be and will be leveraged off. But given the scope of the growth that's expected and that we're already seeing in the carbon markets, I think that it's a great time for the public sector and its considerable resources to get behind helping to progress. Oh my goodness, my speaker wasn't down. Excuse me, I hope that the sound quality is better now. That they can get behind progressing voluntary carbon markets on their journey to get them where they need to be, so that investors and market participants feel comfortable, and indeed increased regulatory monitoring and guidance also helps build upon and protect the good actors, for example, those that were presenting in the first panel and all of that great work that they're doing. And it also limits the market's vulnerability to potential bad actors, because of course this is a growing area with growing economic opportunities. So that's always something to be mindful of. In terms of the move forward, I would say that, I think that greater standardization is really key. And I would leverage off the point that Linda was making in terms of enhanced convergence of international standards and interoperability, because we see, I'm based in Ireland, and let's say in the EU, we see that ESG regulation standards, best practice, it's coming thick and fast, and while that's excellent and it's really helpful, we need to make sure that we have standards that once adopted in one jurisdiction will work in another, because we need to respect the global nature of this market, and that's what makes it work. I would also say as well that I would really put emphasis on transparency, and I think we can agree that the data is not exactly where we would like it to be. So greater transparency and more disclosures, I think would facilitate a better quality of disclosure ultimately to end investors, but also would help facilitate a more robust due diligence process by companies that are investing in carbon offsetting projects, so that that they are very comfortable that they have the level of disclosure they need to be as robust as they we would expect them to be in their due diligence. And when we're speaking about transparency, I think every speaker today has made the point that they view carbon offsets as one part of a multifaceted approach to tackling climate risk, and that it's not something that should be used in isolation. And leveraging off that point, I would say that where a company is just using carbon offsets and isn't taking other steps to reduce their carbon emissions, then that's a scenario in which you could say that they were failing to mitigate long-term climate risk. And when we're talking about transparency, that's something that would be it would be interesting to know, how are they using their carbon offsets, and what part of their overall climate strategy is that playing. So I guess in summary, essentially, I'd like to make it as easy as possible for investors to identify a genuine carbon offset, and by genuine I mean one that satisfies the permanence and additionality criteria, and that investors can confidently invest in the knowledge that, as has been said multiple times today, it's doing what it says on the tin. So I'll just hand back to you, Janet.
Thanks, Effie, and thank you for your grace as I butchered your first name too. Our next speaker is Darcy Bradbury, Managing Director, Head of Global Public Policy at the D.E. Shaw Group. Darcy, off to you.
Thank you, and thank you to the chairman and the commissioners for inviting me. It's been terrific to hear people all day who are so engaged and knowledgeable about these issues. The D.E. Shaw Group manages more than $600 billion in investor assets globally across a wide variety of types of assets, including highly liquid assets like futures, energy, and carbon, less liquid assets, and we have a whole group that has developed renewable energy facilities for the last 15 plus years. given our role in the markets primarily as an investor, and since this convening is being held at the CFTC, I wanted to sort of drill down a little bit, give some data and some high-level thoughts about what makes a derivatives market more attractive to investors. And I also want to highlight the importance of what the CFTC officially calls speculators, those who invest or trade assets not as producers or users, so not iron miners or steel factories, not farmers or bakeries, but investors in firms like mine that manage assets on behalf of investors. So for a market to be efficient so that farmers and steel makers who need to hedge against price risk can transact anytime they need, efficiently, so for with low transaction costs and at prices that reflect broad market views, a market needs investors like my firm. Any individual, mining firm or a bakery might only need to transact in markets a few times a year to hedge their risks of changing prices. And they may not know where to find counterparties. We've heard a lot about these very innovative over-the-counter markets, but many participants and people who are attracted to these markets won't really know where to find them. Hence the value of centralized derivatives markets that the CFTC supervises so well. And so a liquid, efficient market attracts investors like my firm who will invest regularly, not just around a crop cycle or a new factory coming online, and who use robust data to develop hypotheses about where the price of any commodity is going. Not surprisingly, given everything we've heard today, the US voluntary carbon markets don't really meet those tests yet. They're growing, and I certainly applaud the focus and effort we've heard in the prior panel. Very impressive, but realistically, I think we have to understand we're in the early stages of this. And in fact, even the more developed compliance markets in Europe are not as liquid as most of the futures markets that we trade. And in the US, the two regional contracts, which attract the most volume, are, and this is my trader's technical term, are sparsely traded. So I got some numbers from our traders a few days ago, and using one of the most tracked contracts traded on ICE, and apologies to my friends at CME, the December 22 contract, the European EUA contract has open interest of about 378 million contracts, which is equivalent to about 30 billion euro notional. And the average daily volume is not quite 22 million. In contrast, the two regional contracts in the US, where there is no national compliance contract, are much smaller with quite low average daily volume. The REGI, the regional contract, has open interest of about 62 million contracts, and the average daily volume is under 100,000 per day. So that's, while the California contract is bigger with open interest at 174 million notional amount, maybe about 5 billion, but the average volume is still only about 500,000 contracts. So the bottom line, in the US, emitters are mainly procuring contracts directly from auctions or the OTC transactions that we heard about earlier, not using the derivatives markets. The development of a national market, and one that is large enough to support more routine trading, which the efforts described today will hopefully create, will be needed before the farmer and the manufacturers will really be able to use carbon derivative markets to effectively hedge their risks. And my last point is about sort of stability, predictability. Certainly energy markets move around a lot, and unusual events like the war in Ukraine or a COVID surge are not predictable. But normal flows of supply and demand can be analyzed, and we can develop forecasts. This will be harder to do until the voluntary markets grow and transactions become more regular and routine, and you can see correlations. And to be frank, the intense policy interest in these issues, it doesn't always help. For example, The European Commission recently proposed a pretty significant intervention, a plan to raise $20 billion from sales of their EUA holdings that impacted the market for compliance contracts significantly. That may be a very sound public policy decision on balance for the EU and its citizens. I don't want to suggest otherwise. But if the policy goal, or if one policy goal, is to develop a robust, efficient market for carbon credits, this kind of sudden change makes investors less likely to commit capital. It's just less predictable, less stable. So I'm confident that the CFTC, I know these commissioners, I know a lot of the staff, I am confident you can do a lot to inform policymakers about how to build an efficient and sustainable market that can be part of the global solution to address climate change and facilitate private sector efforts by all of us to take action. And certainly we look forward to being part of those market-based solutions. So thank you.
Thank you so much, Darcy. And our last speaker for this panel is Alexia Kelly. And there she is. Alexia is the Director of Net Zero Plus Nature at Netflix.
Good afternoon, everyone. Thank you so much for really an excellent day of discussions. It's been great to listen in and hear so many insights from both new and old friends. And thank you to the CFTC for the invitation and for convening this event today. For those of you who I haven't met, I'm Alexia Kelly, the Director of Net Zero Plus Nature at Netflix. As many of you know, Netflix is a relative newcomer to the sustainability space. We formally established our sustainability program in October of 2019, but are working to make up for our late entry with what we hope is both speed and ambition. In March of 2021, we announced our climate program goals under the Net Zero Plus Nature umbrella, which includes a Science-Based Targets Initiative validated science-based target of 45% absolute reductions below 2019 levels across both Scope 1 and 2 by 2030, and our Net Zero Plus Nature target by the end of the year. I'm very pleased to say that 18 months into our program, we are on track to deliver on our science-based target, and we've implemented a wide range of internal emission reduction projects and initiatives to rapidly reduce our own emissions, which many folks today have noted should be of primary importance and focus for companies. These efforts delivered approximately 14,000 metric tons of avoided emissions last year alone. And we did this by engaging across our entire operation and supply chain. So we worked with our utilities, our landlords, our streaming partners to encourage them to switch to renewable energy. We swapped in renewable diesel, we trialed electric vehicles, we replaced diesel generators with mobile batteries and hydrogen power units, and we bought sustainable aviation fuel. But as someone who can attest firsthand, decarbonizing companies who operate in the real world is going to take significant time, effort, and investment. I can't just wave a magic wand and make fossil fuels disappear from my supply chain, which means that we see a really important role for voluntary carbon markets in enabling us all to collectively deliver higher climate ambition. We've made an ambitious commitment to be fully net zero across all three scopes by the end of this year. And we've based that on what we call a yes and approach to climate action, firmly grounded in what the science is telling us we must do today to avert the most catastrophic impacts of climate change, reduce our own emissions, and fully offset our footprint through investment in high quality carbon removal and retention projects. In 2021, we screened more than 150 million metric tons of carbon credit projects and selected a high quality portfolio of 17 methane mitigation and nature-based projects that restore mangroves, improve forest management practices, increase soil carbon sequestration, and protect and preserve irrecoverable carbon stocks in tropical and temperate forests. Over time, we're increasingly focused on removals, but for now, we include a mix of both removals and avoidance because that's what the science tells us we need to do to avert the most catastrophic impacts of climate change. These 17 projects delivered and we retired more than 1.5 million tons of mitigation and provided much needed financing directly to the communities where they originated. More than 70% of our portfolio was also certified under the Climate Change Community and Biodiversity Standard. In addition to delivering mitigation outcomes, these projects strengthen vulnerable and disadvantaged communities. They protect biodiversity, they increase food security, they protect drinking water, they generate new jobs and educational opportunities, and they provide critically needed climate resilience to some of the world's most vulnerable communities. One of the projects we invest in protects the headwaters, for example, of a community of nearly 1 million people. Those are typically not quantified or included in the carbon credit evaluation process, but they are significant co-benefits that should not be forgotten. We have also put in place an extensive due diligence process because while the market has come a very long way in the last 15 years, there are still bad actors out there. And that's one of the things that we believe enhanced transparency and engagement across the market can help us address. So we've implemented a 5-step process that really enables us to dig into the details, ensure that credits are meeting all of the key quality criteria, including additionality, including baseline projections, direct sampling wherever possible, avoidance of double counting, as well as the additional community benefits, governance and gender impacts and resilience benefits that we spoke about before. We then conduct expert due diligence and engagement directly with the project developers wherever we can, and with impacted communities where possible. We're working as well with a wide variety of digital and remote sensing technologies to enhance monitoring, reporting, and verification. And we generally require and only purchase from the recognized quality standards in the market. We've detailed all of this work, including our 2030 decarbonization transition plan, in our SASB compliant ESG report, and encourage you to take a look if you're interested in any further details. We currently engage in a wide variety of market transactions, predominantly over-the-counter spot market purchasing to procure these credits, but we're increasingly entering into bilateral deals and longer-term offtake agreements with developers, as well as making early investments in projects and trusted developers and nonprofits in order to secure rights to a high-quality future supply of credits to deliver on our annual net zero transition targets. Additional transparency and standardization in the market is coming and is very welcome, particularly under the efforts of the Voluntary Carbon Markets Integrity Initiative. You heard from Mark and many others earlier today, not to be confused with the Integrity Council for Voluntary Carbon Markets, which is really focusing on the quality on the supply side. So we're looking forward to continued conversations and the work together to ensure that carbon markets can play a credible role in the net zero transition for corporations and governments alike. Thank you very much.
Thanks, Alexia. And I'm so glad that you talked a little bit about the co-benefits because I don't think those have been emphasized enough. I know from a project developer's perspective, our clients are often asking us about, well, what are the extra benefits? Does it help nearby communities? Are there any schools that can go in and visit those projects? So I think the co-benefits are an element of these projects that rarely gets mentioned. So do the commissioners have any questions for the panel? Okay, I think we have just like 2 minutes. So in a quick round robin, if you could each give one recommendation to the commission on what their involvement could or should be in this market, but we need to be very quick because we only have 3 minutes. So Mark, why don't you give a quick start? Mark, you're on mute. I hate that.
So do I. I'm sorry, it's late in the evening in the UK, so forgive me. My one recommendation would be that if we want the voluntary carbon market to grow and serve the public purpose that I mentioned earlier, then it needs to be built on trust. And trust will only arise if there is full transparency that allows us to scrutinize what's going on, for buyers to know what they're buying, sellers to know what they're selling, and the public to know what is being claimed. So I would really ask the Commission to focus on ensuring the maximum transparency possible that allows all those things to happen. And that's how we will grow both a liquid and high integrity market.
Bella, one thing.
My one recommendation would be for the Commission would be to take stock of the existing regulatory authority that it has and to make sure that it can use it efficiently and effectively when it comes to VCC markets and to see if there's an opportunity to bring more transparency and consistency into VCC markets.
Thank you. Linda?
And we'd like to see the CFTC play a leadership role globally, just to ensure that coordination and interoperability is happening, because we think that's going to be absolutely essential to be able to scaling voluntary carbon markets.
Effie? Are you still there? There she is.
I'm still here. So I'm going to cheat and put two topics together. So I'm going to say like transparency, but also convergence of international standards so that the same thing means, so a disclosure means the same thing in one jurisdiction as it would do in another.
It seems like one. Darcy?
Yeah, I guess I would encourage them to talk more about the existing contracts, get more information out to market participants. I mean, maybe this is an unfair thing to say, but if we spent half as much time talking about carbon contracts as we do about crypto some days, we might all be a little better off. I learned a lot of things today, and I spent a fair amount of time doing research before this panel, and I think more people could benefit from that education.
Somebody said in an earlier panel there was a crisis of confusion. I think that's true. Alexia, you have the final thought.
No pressure. Transparency, integrity, harmonization.
Thank you to our panel. I think you've heard from all how important this market is, how there is room for improvement, and we appreciate the time that you had for us.
Thank you, Janet. We are now going to shift to part 2 of the last panel of the day. And as folks transfer to their seats, I'm going to introduce our moderator. So we have Angela Churik Calhogue, who joined EDF in April 2022 as the Executive Vice President for Impact, using inclusive processes and economic approaches to achieve ambitious climate solutions that deliver equitable benefits to people around the world. She joins EDF from the World Bank Group, where for the past 5 years she has led the Carbon Pricing Leadership Coalition, a voluntary partnership of governments, businesses, civil society organizations working to advance carbon policy on the global agenda. Before joining the World Bank, Angela spent a decade in senior roles in the Swedish government as a negotiator to the United Nations Framework Convention on Climate Change and led the European Union's team that negotiated adaptation, loss, damage, and capacity development issues. For 2 years, Angela worked at the International Renewable Energy Agency in Abu Dhabi, where she developed and coordinated an agency-wide strategy on climate change issues. A native Kenyan, Angela is passionate about climate solutions that improve human well-being globally and in particular in the developing world. Welcome. Thank you.
Okay. Okay, thank you. Good afternoon, and I really appreciate the invitation to be here and join you today. At the outset, I just want to say that this panel will end at 4:10, and we will still do our utmost best to wind up at 4:15. So we will have ample time to have this conversation. So a couple of words first about the Environmental Defense Fund, which I will assume that most people have come across here, at least in the United States. EDF, or Environmental Defense Fund, is a global NGO where we center our work on climate change and people. We've been dedicated to environmental justice and local communities, and it was established about 50 years ago. And one of, should I say, the trademarks of EDF is the fact that we use science and economics to identify practical solutions to the world's greatest environmental challenges. So our work falls into 3 broad pillars. We have just gone through an organizational refresh where we have reflected on the relevance and impact that we can make at a time when we really do need urgent climate action. And the main pillars of our work fall into 3 categories: stabilizing the climate system, strengthening the ability of people and nature to thrive, and supporting people's health through work with healthy communities. And this translates into programs such as the Global Clean Air, Climate Resilient Food Systems, Climate Resilient Fisheries, Natural Climate Solutions, and Clean Energy. When it comes to markets, EDF has been working in this space for many years. We believe that, of course, for markets to be effective, they need to operate at scale. They need to be inclusive and have high standards of integrity. And I think that has been discussed significantly today. They need to be effective and accountable. And of course, there also needs to be predictability to ensure that we're able to plan for the long term. We have a number of initiatives. I think there's been mention of two that we're very actively involved in: the Integrity Council for the Voluntary Carbon Market and the Voluntary Carbon Market Integrity Initiative. And the reason is because we believe when looking at integrity issues, we need to look at all aspects across the whole spectrum of actions relating to the market, from the demand side to the supply as well. Two recent initiatives that are relevant to mention in this discussion. One is a carbon credit quality initiative that we just started together with Öko Institute in Germany as well as WWF. And through this initiative, we're working to set out quality objectives for carbon credits. And we've developed a comprehensive methodology to score credit quality. And I'd be happy to share more information later on that. And the second one is we launched a guide together with 8 other, environmental organizations, local communities, and indigenous people groups, looking at what constitutes good when it comes to tropical forest investments. So this Tropical Forest Carbon Integrity Guide is really meant to be able to give some clarity, especially to those businesses that are seeking to go and engage within the sector. I won't go too much into more on what we're doing, since I know we have a group of very exciting panelists who will speak to us about their activities. And maybe to get us going, I'd like to turn to Chuck Connor, who's the President and CEO for the National Council of Farm Cooperatives. Chuck?
Well, thank you, Angela, and Chairman Behnam and Commissioners. Thank you for the opportunity to speak at this important gathering today on behalf of farmer-owned cooperatives and the more than 2 million farmer members across the country that we represent. NCFC is a founding co-chair of the Food and Agriculture Climate Alliance, which consists of 80 organizations that represent food, agriculture, and forestry value chain. And I would note, Angela, as well, that EDF is also a founding member of that very alliance. FACA is committed to ensuring climate policies that impact the food and agricultural sector that are voluntary, market and incentive-based, and policies that help rural economies and the communities better adapt to climate change. Farmer co-ops are at the center of responding to consumer demands and private sector commitments to reduce emissions and grow green supply chains. As trusted advisors to their farmer owners, they are positioned to support producers' participation in carbon credit programs by providing timely planning advice, assisting with data collection, and providing crop production services that complement carbon markets. Several of our members have recently initiated programs in this space. They have formed partnerships with third-party carbon purchasers to help their farmer members access voluntary carbon markets. While their objective is similar in that their farmers receive credit and compensation for adopting and maintaining climate-smart agricultural practices, each initiative does vary in its approach. For example, Land O'Lakes Truterra launched its inaugural carbon program in 2021, offering cash payments to farmers for carbon sequestration practices. In the first year of the program, Truterra paid over $4 million to farmers who sequestered approximately 200,000 metric tons of carbon. For 2022, Truterra is offering farmers 2 different options to get involved in the carbon market space. The program allows farmers who have adopted sustainable practices since 2019 to be rewarded for their stewardship. In addition, they are offering a new program, the Truterra Carbon Market Access Program, to farmers who are just beginning these selected practices. This program acknowledges the reality that transitioning to climate-smart practices does take time and investment. Also last year, another co-op, Growmark, announced a partnership with Indigo Agriculture, where the co-op's retailers will help farmers evaluate, enroll, and implement climate-smart farming practices. While you heard greater detail about Indigo's program on the last panel, Growmark and its farmers will leverage Indigo's capabilities for measuring and verifying on-farm environmental impacts at scale. This will help translate the results of farmers' efforts into new sources of revenue for those farmers. Finally, CHS Inc. recently announced a collaboration with Bayer Crop Science's Carbon Program. This carbon retention practice program rewards growers for implementing and maintaining cover crops and conservation tillage practices on a per acre and per practice basis after verification of these practices. The focus is on providing value for practices growers choose to use. I believe co-ops will continue to play an essential role in assisting farmer members to explore and implement carbon credit programs. Just like the existing services that are tailored to each farmer's operation, having different carbon offset options will help expand producer participation in these markets. Several challenges remain, however. For example, how do we incentivize a greater number of producers to enroll acres in carbon programs? This will require increased economic return beyond what does exist today, given the investment cost to participate in these programs. Further, carbon markets generally only reward producers for new and enhanced practices. This leaves out producers who have already adopted climate-smart practices but aren't in any of these markets. Work also remains within the agricultural industry to understand the best practices when it comes to monitoring, measuring, reporting, and verifying sequestered carbon and emissions reductions at the farm level. Private sector innovation and market development should be encouraged in that process. Sound public policy will also be important, and I commend the U.S. Department of Agriculture for recently announcing over $1 billion of funding for pilot programs to promote climate-smart agriculture and market development. As these transactions and cash markets develop, I believe that the forward contract exclusion applies. These markets should not inadvertently be captured by the regulatory regime that is designed for derivatives. CFTC, I would say, may also want to consider appointing a liaison to USDA to gather and share information with them, given Secretary Vilsack's involvement in this market already. And I understand there's precedent for doing this type of thing in the cattle market as well. I also encourage the Commission to host future roundtables specifically targeted at the agricultural industry, given the progress that we can make here. So thank you again, Mr. Chairman. Thank you, Angela, for having me as part of this panel.
Thank you very much. I think we'll just move straight on to the next speaker, and this is Shelby Swain Myers, who is an economist with the American Farm Bureau Federation.
Yes, thank you for the opportunity to be here to share the agriculture producer perspective for voluntary carbon markets. The American Farm Bureau Federation is the largest general farm organization in the U.S., and we've existed for over 100 years as a nonpartisan grassroots organization with membership in all 50 states plus Puerto Rico. Farm Bureau prides itself on being the voice of agriculture. My name is Shelby Swain Myers, and I'm here on behalf of the American Farm Bureau President, Zippy Duvall, a farmer from Georgia, as well as our board of directors and our over 6 million farmers and ranchers across the U.S. and Puerto Rico. I spent the last year on the road talking to growers about the opportunities and challenges in voluntary carbon markets. AFBF, we've given over 90 presentations across various states, geographies, cropping and grazing systems. And American Farm Bureau views our role very simply as being an objective voice for growers, to not provide an endorsement, but provide education. There are over 14 programs, as well as monitoring, measurement, reporting, verification platforms that growers can participate in. That's quite a few to sort through. They come with various contracts, contract commitments, as well as data provisions that are unfamiliar and not written for growers. We focused on, as American Farm Bureau, we focused on ag sustainability and the story that we have to tell, being a partner at the table for what we do. You know, agriculture is highly productive and highly efficient. For every one input that we use, we produce 2.78 times that amount in productivity. Not to mention, we are consistently about 10% of the U.S. greenhouse gas emissions, and in 2020 reported a greater than 4% decrease in our greenhouse gas emissions. When you combine it with our land use change, and forestry, which represents about a negative 12% share of greenhouse gas emissions, agriculture sector emits negative 2% greenhouse gas emissions in the U.S. Our ability to sequester greenhouse gas emissions puts us at the forefront of these discussions as a key supplier. But it does not come without barriers, and I'm going to get to that here in a second. As Chuck mentioned, an Environmental Defense Fund is also a part of this. The Food and Ag Climate Alliance was an unprecedented group that came together of farmers, forest owners, food sector, state government, and environmental advocates to provide 40 recommendations related to agriculture, sustainability, and climate. The 3 objectives that we supported those 40 recommendations with were voluntary market-based incentives, science-based outcomes, and promoting resilience in rural economies. At the end of the day, it's to do no harm to agriculture. So this primarily because agriculture is a key supplier of credits, both insets and offsets. And it's important that growers are protected and enabled to participate in these markets. While these markets are seen as a diversified revenue stream for growers, they're just one of the many voluntary market-based incentives that exist in the private sector. And it comes with many barriers. For one, verification. We've talked a lot about third-party verification and audits, and that comes with costs as well as major data obligations that growers are asked to meet, not to mention the on-farm reporting that's required in order to comply with those verification. There was also a mention of new practices that are the only ones that qualify in these markets, the concern of additionality, and then a grower must pick up a new practice or add in addition to the practices that they already are implementing on their farm, which inhibits the role of early adopters to participate in these markets, which many growers are already doing. I would note that USDA will have a new survey-based data set of conservation practice adoption soon to come. They did a survey over the spring to get a better snapshot of where early adopters are across the U.S. Another barrier that exists are financial barriers. And Mr. Frederick acknowledged this in the last panel. It's not inexpensive to pick up conservation practices. There's significant time and investment as well as risk associated with doing that. And while there is payment associated for these credits, it is not enough economically to offset the investment costs required. I appreciate the comments that were made about infrastructure because there's incredible technical support needed, including an upgrade of rural broadband that will need to come in order for growers to participate as suppliers in these markets. It also comes with a significant education trial and error, managing your risk through this and having opportunities to do this at a low-risk environment, considering agriculture is one of the riskiest businesses out there. There are long-term impacts that come with signing these long-term contracts for growers, and that needs to be taken into consideration, as well as the part that's been mentioned about permanence and how long we maintain the permanence into the soil. I mentioned I spent the last year on the road listening to growers, and many of the questions that I get can be summed up into this list. How will farmers be paid, and is there an opportunity for that payment to grow? Will carbon ever become a commodity, or will the carbon-reducing commodity be what's traded? And I think that's key to mention is the climate smart commodity or the carbon itself as a commodity. How will farmer and on-farm data be protected? We live and work on our farms and ranches. We raise our families there. That's an important piece of the puzzle to make sure that on-farm data stays protected to the individual. What is the liability of the grower? And what are the contract obligations that we are meeting, including the long-term commitments interacting with the business associated? And finally, who can I trust with my livelihood? I think that's a very important piece to this puzzle because farms are not just businesses, they are livelihoods. Agriculture is working to do its part to mitigate greenhouse gas emissions, but every farm and ranch is different. It's an individual business and it's an individual small family business. Farmers are price takers, both for inputs and for the products they produce. Farming comes with a huge amount of risk, with Mother Nature serving as both your friend and adversary. Growers need a seat at the table that provides flexibility and autonomy to make the right decisions that are best for their farm. Thank you for the opportunity to present our remarks today.
Thank you very much, Shelby, and I think you make a very good point of the importance of not losing sight of the context within which markets will be operating. I'll turn now to Tyson Slocum, the Director for the Energy Program with Public Citizen.
Thank you so much. Mr. Chairman, thank you so much for your leadership on this and so many other issues. Commissioners, thank you so much for your engagement and attention to this important issue. And Abigail, there were an awful lot of speakers today, and I know that was an awful lot of work, so thank you. So I'm Tyson Slocum. I direct the Energy Program with Public Citizen. We are a national public interest research and advocacy group representing the interests of household consumers. Mark Twain once quipped, don't let facts get in the way of making a good argument. And I agree that voluntary offsets have an important role to play in combating the climate crisis. But I keep coming back to the statement uttered by the individual from the State Department earlier who questioned, how do we verify that the underlying carbon offset is real? And I haven't yet been convinced through all of the different procedures and discussions that we have the procedures in place to ensure the integrity that these underlying offsets are in fact doing what they're claiming to do. And I think we really need to address those facts before this market grows as it's expected to. And this market is growing, as we've heard from earlier speakers, because of this rush by so many corporate and other stakeholders in our society to issue net zero commitments. And as we heard from government officials and others, some of those commitments have a lot of impressive detail to them, and others read a lot more like it was put together by a public relations department. And so it is incredibly important that offsets be verified if they're going to play a meaningful role. And there's an important aspect here that hasn't been discussed yet here today, and that is the inherent conflict between voluntary offsets and other potential solutions to the climate crisis, namely regulatory initiatives. So let me explain. If you are pursuing a voluntary offset, it can only be credible if it is not required. So if there is a regulation in place mandating that activity, well, then that voluntary offset is no longer valid, right? So if, let's say we're dealing with methane emissions and we've got a voluntary offset program to try and mitigate methane emissions, and then the US federal government enacts a methane reduction regulatory program, all of a sudden that voluntary offset market isn't very effective, right? So what that means is that it immediately creates this tension where participants that have vested time and money into voluntary offsets are likely going to be active lobbyists opposing regulatory and other solutions to the climate crisis, even if those other solutions are more cost-effective and efficient at achieving emission reductions. And so I am concerned by this inherent conflict, and I think that needs to be addressed. But getting to the point of this panel, which is addressing what is the CFTC's role, clearly addressing fraud and manipulation. It's interesting to me that the global crime-fighting entity Interpol literally issued a report on the massive potential for fraud in the voluntary offset market several years ago. And that's for a number of reasons, but in part because of things we've heard today. It's a very different type of commodity from everything else, right? It's not very tangible like corn or crude oil, and that makes it more of an opportunity for fraud and manipulation. The U.S. Department of Justice, just a few months ago in December, issued a fantastic analysis of lessons learned from widespread fraud in the renewable fuel market in the United States and its potential applications to fraud in the voluntary offset market. A very important read that I will contribute as part of follow-up comments by the deadline. But there, the Department of Justice highlighted just how widespread, varied, and diverse the fraudulent schemes were in the renewable fuel market, that there was so much fraud that fraud at many times was driving the market price in the trading markets. Right? There was one example in the Department of Justice report from just a few months ago where they highlighted a biofuel facility that had literally been built, but the folks that built it were running out of cash and they determined that their operations were uneconomical, but that they proceeded ahead with cashing in over $50 million of RINs, of renewable identification numbers, all with their own serial numbers. They said that they were producing this renewable fuel when in fact they hadn't been. And the EPA, even though it had direct oversight, did not have an enforcement program. There was nobody going to these facilities. You can view them from the air, from a satellite, and while some of those technologies are good, what I'm not hearing enough is the need to have on-the-ground monitoring to ensure that facilities and programs are doing what they're saying they're going to do. And that brings me to the last point, and what the Commission could take away here, is I am concerned that the protocols for assessing the validity of carbon offsets are being done by market participants. And I understand that there's a lot of good intention, a lot of good work, but there are vested interests that are playing an active role in shaping those protocols and those standards. And that creates inherent conflicts of interest, no matter the best intentions of all of us. And it would be far more prudent to have a completely removed standard setting process that does not actively include vested interests who are actively engaged or are financially invested in these carbon offset markets. And so I think going forward, the Commission can think about, in addition to just general fraud and manipulation oversight, but considering what minimum standards would be required for the listing of products on futures exchanges to ensure that the standards are not set through industry self-regulation, but through independent means, and that there are clear enforcement verification standards. I'm not hearing enough detail about how these things are verified and enforced. Thank you so much for your time. I appreciate it.
Thank you very much, Tyson, and thank you for raising issues that do need to be taken into consideration. I'll just pick on one of the last points you made, mainly because it was a concern I know even in my previous capacity we did raise around who is setting the rules of the game. But a lot has happened in the last 8 months. And if you look at the Integrity Council as an example, and I'll just pick that as one of them, the diversity of voices, not just market players. We're getting in governments, we're getting in indigenous people and local communities, we're bringing in the academics, bringing in institutions like the EDF into that conversation, mainly because at the end of the day, it's a meeting of minds that will make the market work. So I think that concern is something that we are all taking very seriously and are working with. And really, even though we do hear a lot from the market players, I think even just as your previous speaker was talking about the work with agricultural communities and the farmers to educate them is really part of that bigger picture. And I think it's something that we will continue to strive to do. Sorry to take time and abuse my prerogative as a moderator on that. I'd like to now turn to our colleague who's joining us at a late hour from the UK, Jeff Schwartz, who is a Vice President for Low Carbon Strategy, Regulatory Affairs, and Partnerships with BP. Jeff's been in this space a long time, and good to see you joining us this evening. Jeff, over to you.
Good afternoon, and good to see you, Angela. Can you hear me okay?
Yes, we can.
Great. Good afternoon, Chairman Behnam and Commissioners Johnson, Goldsmith, Romero, Mercier, and Pham. Thank you for inviting BP to participate in today's Voluntary Carbon Markets Convening. I am BP's Vice President for Low Carbon Strategy and Regulatory Affairs, and I'm also a board member of the Integrity Council for Voluntary Carbon Markets. I want to start by stating that BP is committed to constructive dialogue with the Commission relating its potential role in promoting fair and orderly trading in the futures and derivatives markets that arise from the voluntary carbon markets. BP's ambition is to be a net zero company by 2050 or sooner and help the world get to net zero as well. We are not waiting to get into action. We have set short-term targets and aims for 2025 and 2030, and since February 2022, our aims are to be net zero across our operations, production, and sales by 2050 or sooner. We support the use of carbon offsets or allowances by companies, countries, and society in enabling the world to get to net zero and meeting the Paris goals. Effective compliance and voluntary carbon markets for high-quality carbon credits are important to finance these activities. We expect that global demand for carbon credits is likely to grow as more companies use them to achieve their climate-related goals. So we intend to continue to offer carbon credits and offsetting solutions to our customers to help them meet their own goals. However, we do not plan on using or relying on offsetting to meet our 2030 net zero aims. We consider that it makes sense to account for carbon credits directly related to our business. For example, where carbon credits are bundled with the energy we sell, and looking ahead, we plan to do so. BP participates in both the voluntary carbon markets as well as compliance markets, some of which allow for the use of offsets to achieve their policy objectives. Within BP's trading and shipping business, we have a low carbon trading business, which plays a vital role in connecting BP and our customers to carbon pricing through our activity in the world's compliance and voluntary carbon markets. We've been active in carbon markets as far back as 2001. BP Products North America offers compliance offsetting and voluntary offsetting products and sources carbon credits from carbon offsetting projects certified by third-party standards around the globe. And BP Energy Company is a provisionally registered swap dealer with the CFTC, and it offers physical and financial products to the market to mitigate risks, including compliance offsetting and voluntary offsetting products. BP Energy Company's swap dealer business includes developing structured financing and hedging solutions for our companies in need of innovative deal structures. And it's here that BP must tap into less liquid markets, and many times must warehouse some of that risk in our own portfolio due to a lack of liquidity in those markets. BP supports the CFT's role in promoting fair and orderly trading in the futures and derivatives markets, including those markets arising from voluntary carbon markets, and in protecting these markets from fraud and manipulation. BP applauds the Commission's decision to seek public comments on carbon offsets and encourages more market transparency. We see a need for the CFTC to, one, regularly review the integrity of established exchanges for financial instruments arising from the voluntary carbon markets to help ensure market integrity and increase liquidity. And two, to increase transparency to promote greater investor confidence in the voluntary carbon market, which will lead to greater price discovery and prevent fraud and manipulation. However, we would caution against adopting forms of regulation that have the effect of limiting market participation. Finally, I would like to share with you two asks for standardization, transparency, and market integrity in the voluntary carbon markets. One, we support the CFTC's role in regulating futures and derivative products that are tied to global voluntary carbon markets, and we see that there is a need for greater market standardization in order to help these markets reach a larger scale. and we would encourage the CFTC to coordinate with global regulators in order to harmonize efforts to enhance transparency and integrity. And two, in its role in regulating exchanges, the CFTC should ensure sufficient transparency exists in the financial markets tied to the voluntary carbon market in order to discharge its mission to prevent fraud and manipulation. Thank you so very much for allowing BP this opportunity to describe its business and interest in voluntary carbon markets. Thank you again for your leadership.
Thank you very much, Jeff. And now we'll move on to our last panelist. That's Michael Lemon, Vice President, Environment, Land, and Government Affairs, excuse me, at Holcim US.
Thank you, Angela, Chairman and CFTC commissioners and the staff for organizing today's symposium. I serve on the executive team of Holcim US. I have about 20 years of experience in the cement, roofing, aggregates, and concrete business. My background is specifically in business and manufacturing, and not in the financial markets. So instruments and some of the terminology we use today is not part of my lingo. So excuse me if I get some of the terms of art wrong. I appear here today to share with you how Holcim is working to be a net zero company, and how your work in overseeing the integrity of the carbon markets and instruments can have an impact on our company, on American manufacturing, on U.S. competitiveness, and our ability to meet climate targets set for us by the Paris Climate Accords. For those of you that don't know Holcim, we are a global leader in innovative building solutions. We operate in the U.S. as Aggregate Industries, Lafarge, Holcim, Firestone Building Products, and Geocycle. So those are the operating businesses. We operate in 80 countries, have about 70,000 employees around the world, and have 4 primary business lines, those being cement, ready-mix concrete, aggregates, and roofing. In the U.S., we have about 350 active manufacturing sites in 43 states and have about 7,000 employees. And our customers count on us to deliver in the building material space solutions for structural integrity, sustainability, and resiliency. To help us build progress for people on the planet by delivering better quality, innovative building materials that enable greener cities, smarter infrastructure, and improve living conditions for people around the world. And as part of that, we became the first building materials company to adopt a net zero pledge. Our journey to net zero will not be easy. For those that don't know, cement is a very energy intensive business. It's trade exposed. The industry is at high risk for carbon leakage, and unverified credits and deceptive market practices only hinder our efforts to decarbonize. And for Holcim, we're not simply talking about or looking at buying credits in the voluntary market to offset our actions. Our journey to net zero is driven by science. We're the first company in the building material space to have a net zero roadmap, 2030, 2050 targets that have all been independently verified by the Science Based Targets Initiative. And these targets require us to cut our emissions across our value chain, including Scope 1 emissions, Scope 2 emissions, and Scope 3 emissions. So it's all about mitigation and mitigation with transparency. And as part of our net zero journey, we're actively working on innovative products and solutions that include low carbon cement, low carbon concrete. We have a goal of recycling in the US 10 million tons of material that's basically taking the road after we're done with its useful life and reusing it, and using things like 3D printing to build the homes of the future. And in the US as well, we're working hard to decarbonize the business. So we're working to reduce our Scope 1 emissions by upgrading our plants, by fuel switching, by utilizing carbon capture. We're working on our Scope 2 emissions by investing in the development and deployment of renewable energy, including wind farms and solar. And we're working to reduce our Scope 3 emissions principally by biofuels and electric vehicles. What we're not doing is we're not making those emission reductions by using offsets. As the gentleman from BP spoke, offsets are not part of our net zero strategy. It's not to say that offsets aren't necessary or a useful tool to achieve net zero, but they should not serve as the main building block for a company's decarbonization efforts. As you've all heard today, voluntary carbon markets are expanding as corporations seek to offset their greenhouse gas emissions by paying someone else to reduce theirs. The CFTC and related agencies need to ensure that all carbon markets are fair, transparent, and actually deliver on the long-term carbon reductions offered by the carbon markets. Regulators must also ensure that the credits are used to avoid meaningful decarbonization efforts. We need to ensure that there's a level playing field for all and that credits are used as a complementary tool for deep decarbonization, but not as a way to bypass it. Finally, the CFTC and related agencies must also work to ensure credits are not used to deliver misleading claims of climate-friendly products that hurt innovation and hurt the deployment of true low-carbon products. So thank you again for the opportunity to testify today, and I'm happy to answer any questions at the end of the panel.
Thank you very much. And I must say it's been very encouraging to hear consistent messaging coming from all of you, as also had come from the previous panel. I'd like to open the floor for some questions, and maybe I'll start and see if some of the commissioners have any questions or reactions. Okay. Other participants? It's the end of a long day, so I know. Okay, so I will turn back to the panel. There's been a lot of the recommendations that are coming through around transparency and integrity, the need for coordination, the need to make sure that the conflict between regulatory measures and the market are well addressed, that the key players are well informed and educated so that they understand the ramification of the market and their participation. What would you take, are there any other key recommendations that you would like to highlight, or what would be that one main recommendation that should be addressed at the outset that we should be putting forward to the commissioners? It could be in addition, or it could be an emphasis of something you've already picked up, and from also what you've heard through the day.
I'll try first. I will just say it is the basket of transparency issues as it relates to bringing more farmers into the fold on this. You know, agriculture is such a high-risk business, and the entire sector is about controlling that risk. And you know, the uncertainty that comes through, you know, a lack of full transparency, excuse me, is just going to be a discouragement for farmers to participate. And obviously, I think we have an opportunity here. This is why so many of our members are now playing in this space, and they weren't just a few short years ago. It's coming, but to really get the kind of performance that we expect through farmers' participation, you've got to give them the tools to know with certainty what is involved here, because they simply cannot and are not going to take on additional risk, you know, in a carbon market. They have too much already.
Okay.
I just noticed a very interesting disconnect between some elements of, you know, the first panel, which was highlighting, you know, standards and, you know, quality standards for offsets, where I heard from multiple speakers that we can't have a top-down solution, that we need to allow for different types of standards between, for example, North and South, in order to allow for innovation to bloom. But then from the demand side, I was hearing the complete opposite. I was hearing about the need for standardization. I was hearing about the need for one set of standards. And so it seems like this is something that needs to be rectified, particularly if the folks working on, developing the protocols and the standards are speaking much differently than the folks on the demand side. And I think that we've got to have some more consistency there, or at least understand why there are those differences.
Angela, if I may, I think the voluntary carbon market is one in which it's not as liquid as many other markets today. So we would encourage the CFTC to look at all ways to encourage regulation that would encourage greater market liquidity. At the same time, we're operating in a world of bottom-up approaches under the Paris Agreement. And so we're going to be operating in a multiplicity of various voluntary carbon markets, whether that's in the US or Europe or Japan or wherever. And so there is a need for the CFTC to work with other regulators around the world to encourage best practice and to try and harmonize those regulations wherever possible. And I think the work of the Integrity Council on voluntary carbon markets will be really key here, because the Integrity Council is going to come out with some very key recommendations later this year. And I'm sure, as the commissioners have heard already today, there's going to be a lot of interesting work that can help guide them in their work from the Integrity Council going forward. So again, I would say encourage standardization, transparency, market harmonization, but at the same time, do so in a way that doesn't hamper the growth of market liquidity.
I would echo many of the recommendations that Chuck made on behalf of the farmer cooperatives, but as well as add that growers that I've talked to, farmers and ranchers, have asked for flexibility in particularly across the geographies and cropping systems that they have, as well as the autonomy to make the decisions that's best for their farms and ranches and their family situation, their business situation, their risk tolerance, if they will. And then in finding the way in which they get paid for the full environmental benefit that they're generating. There's a lot riding on their shoulders and the practices that they're implementing, and to cut them short would be sorely unfair for the revenue potential that we're talking about in the market that is here. So finding ways that they are fully compensated for the environmental benefit they are generating would be a high priority as well.
Maybe I'll just offer one additional comment, and that is, the financial markets today and our shareholders, for the most part, expect from companies like Holcim mitigation to be at the forefront. And when we have discussions about taking a product where you can take it to 30 to 70% lower carbon content, but to get to the last part, you would have to use offsets. We end up with issues around integrity of the offsets and transparency, and we generally get criticized when we even talk about that. So there's a lot of room for improvement that you've heard all day long today within that space, before we're able to use that as a credible mechanism to get to zero carbon products.
Thank you very much. I will not make an attempt to summarize, because I know this is part of the whole that the day has been, with a lot of valuable insights on areas that the commissioners can take into consideration as they look into this issue further. So I'd like to thank the panelists very much for your insights and your contributions, and I'll pass back now to Abigail.
Thank you, Angela. So we are going to turn now to closing remarks, and I'm going to start with Commissioner Pham, if you have any remarks.
No, thank you. We're actually just thank you to everybody here in the room. The discussion was very interesting and informative, and I really appreciated the great discussion here today.
Thank you. Commissioner Mercier?
To echo what Commissioner Pham said, thank you all for being here. Really do appreciate your time commitment, and I did want to just highlight part of what Shelby said in her opening remarks about the fact that when you really look at the carbon emissions percentage of our agriculture producers and agriculture in general, it ends up being a net negative. And I don't think that story is told enough. And I'm glad that you shared that with us today. So thank you.
Thank you. Commissioner Goldsmith Romero?
Well, there's a lot to think about. I mean, we have to be very thoughtful and deliberate, and we have to think about the standard setters, the supply side, the demand side, how to do enforcement, how to bring transparency, liquidity. This was incredibly helpful. I think this is just the start of an ongoing dialogue, and I certainly invite anyone who wants to send me or my office things to read and these slides and other things. I'd be happy to continue this conversation, make sure that we're doing things very thoughtful and deliberately. Thank you, Abigail. Thank you, the chairman.
Thank you. And then Commissioner Johnson?
Thank you so much, Abigail, and everyone who worked tremendously hard to bring this program together. Thank you, Chair Behnam, for your leadership earlier in your tenure as a commissioner in sponsoring the MRAC and bringing a very important report to bear, and for your continued leadership in this space today. We are grateful to you as members of the commission for your leadership, and I'm thankful for how you've brought so much brilliant information together for our consideration.
Thank you. And now Chairman Behnam.
Thanks, Abigail. Not much else to say, but I do really want to thank everyone. This is a tremendous day. And as my colleague said, certainly, the start of a longer dialogue. But I think Commissioner Pham noted this morning, right, these events for us, we had one last week as well. They're long days, but this is how we make better, more informed decisions. And a lot of constituents that we don't typically deal with, but given our markets and the breadth and the scope of the users of our markets and the issues at play, making sure that we have a diverse set of viewpoints is extremely important. I do want a special thanks to Kelly, who I don't know if she's still on. It seems like a long time she was moderating ago, but also Nat as well, Eric and Janet, and of course Angela for moderating. My colleagues, of course, for their support and their interest in this issue. And then most importantly, David and Abigail. I think you can all appreciate how hard this is to pull off, and they did a really great job. For many, many months, we were thinking about this, so thank you to them. So we're here, we're available. We really appreciate this conversation. I think there's a lot to take away, a lot to learn, a lot to think about relative to our role within the U.S. government, the larger initiatives within carbon reduction and reducing emissions, and what role voluntary carbon markets can play in that effort, knowing full well both the risks and opportunities. But given our experience in markets, our expertise, I certainly think that we're going to take a hard look, especially with what I mentioned earlier today, an RFI going out. Welcome more feedback and comment on what you recommend and suggest our role should be. So with that, everyone have a great evening, get home safe, and of course, thank you for your service and your time to give to us today. Thank you.